Hello guys, so in this video we are going to be seeing the new and unique questions in law for your CA Inter September 26 exams. Alright, we will be covering the questions from four resources: your September 26 RTP, both your September 26 mock test papers and the May 26 question papers. See, when you look at your mock test papers, the descriptive questions, they are more or less copy paste of the Jan 25 question paper. So wherever there was a repetition, I did not bring those questions. I am discussing with you in this session only the new and unique questions from these four resources. So I was able to arrive at 35 such new questions. These 35 questions we will discuss, okay? And major focus is going to be on case-based MCQs. We will be doing descriptive questions as well, but however, there will be major focus on the case-based MCQs. Alright, so these are the first 2 points I wanted to let you know. This video will be for around 4.5 to 5 hours, alright? And I need this much time because I'm not just discussing the answers with you in this video. Like, I'll tell you what I've done. Like, for example, let's say we have a question on sweat equity shares. Now, I'm not straight away taking you to the question and telling you, this is the answer. No. Instead, the whole style will be a little different in this video, where I first give you reminders of the concepts involved in the question, okay? I first discuss the concepts with you and then we discuss the question, alright? That way, you will be benefiting a lot more than just telling you straight away what the answer is, alright? And one more thing, just like DT, even in this video, I've arranged the questions chapter-wise so that in case you want extra help only in one specific chapter, you can straight away go to the timestamp for that particular chapter and finish it then and there. All right, and the PDFs, both the PDFs, the questions PDF and the solutions, this classroom notes where I have done all the discussion, both I will share with you in my Telegram channel itself. So that's it guys. In fact, I'm very excited about how helpful this video is going to be for you. I've put in a lot of effort, making this classroom notes with all the reminders and all, and I'm very sure it's going to be so worth it, because when you're done with this entire video, you will have that kind of satisfaction that yes, at least the concepts that were involved in this session, at least these concepts I am thorough and I'm ready for the exam. Alright, so that's it guys. We'll start the questions right after this. Stay till the very end. Take breaks wherever you think it is needed. Take breaks, but come back and keep a target and finish off this video today itself. Alright guys. So starting off with our very first question, this is relating to kinds of companies. Now in this question, we will be touching upon two concepts: Section 8 companies and one-person company. Before we read the question, let me give you a quick reminder of the two concepts. Reminder number 1, Section 8 companies, can they distribute dividend to the shareholders guys? No. See, Section 8 companies, they are generally formed without any profit objective. But by chance, they happen to make some profit. They have to use that profit to promote their charitable objectives only. Can they use that profit to distribute dividend to the shareholders? No, that is prohibited. Section 8 company is prohibited from distributing dividend to the shareholders. Reminder number 1. Reminder number 2, can a one-person company be incorporated as a Section 8 company? The answer is no. One-person company cannot be incorporated as a Section 8 company. We've learnt this as well. Now come on, let's have a look at the question. Let's see what exactly are they asking us. So the question says, Dhruvika is a social worker. To promote tribal art and culture in southern Rajasthan, she planned to incorporate a company, purpose of which was not only to promote tribal art but also to generate income for the tribal people. So her whole objective, why is she creating this company, is to promote tribal art and to generate income for tribal people. These are her objectives. People residing in the area are well versed in making of bamboo items, terracotta, leather goods, handmade jewelry, textiles, etc., etc. But however, due to poor marketing, their products could not reach the buyers. The tribal products are in great demand among the people. Dhruvika thought of providing the marketing platform to such local producers by selling the products through the e-commerce platforms. So, unnecessary information. Point is that she wants to start a company. Why? Because she wants to promote tribal art and she wants to generate income for tribal people. Okay. The question is saying she discussed her plan with some of the prominent artisans of the tribal area and invited them to be members of the proposed company. And she planned to distribute the net profits equally among the members as a goodwill gesture. Are you understanding? She is making those tribal artists as a members of the company, and she is having a plan that whatever net profit that company makes, that net profit will be distributed equally to the members of the company. Now they're asking you, referring to the provisions of the Companies Act, discuss whether Dhruvika can be granted a license to incorporate a company under Section 8. See, we know very well, if we want to incorporate a company under Section 8, we first of all need a license from the central government, and central government has delegated that work to the ROC. We know all of that. But however, here Dhruvika, she is planning to distribute whatever profit that company makes to the members of the company. That is not allowed. So because of that reason, will she get the license to incorporate the Section 8 company? No, she will not get the license, because Section 8 companies are prohibited. They are not allowed to distribute dividend to the members. By chance they make profit, they are supposed to use that profit to promote their own charitable objectives, but they are prohibited from distributing dividend to the shareholders. So her intention of making the company, one of her objectives is that she wants to distribute the dividend. That will not be allowed, therefore license will not be granted to her. Then comes the next question. In case the artisans are unwilling to be members, can Dhruvika incorporate a 1% company under Section 8? This also we saw already over here. Can a 1% company be incorporated as a Section 8 company? No, this is not allowed. 1% company cannot be incorporated as a Section 8 company. See, we had learned two things. Number one, we had learned that a 1% company cannot be incorporated as Section 8 company. Also, we had learned that 1% company cannot be later converted as a Section 8 company. So, neither can you originally incorporate it as Section 8 company, even that is not allowed. Also, later converting 1% company to Section 8 company, even that is not allowed. Okay, so that is it about your first question about the two types of companies. Now, come on guys, our second question is relating to our share capital chapter. The second and the third question both. The second question is relating to sweat equity shares, and the third question will be relating to debentures. So let's look at the concepts involved first. I'll give you a quick reminder, then we will enter into the question. Okay, this second question over here is all about sweat equity shares. So some 3 to 4 points under sweat equity shares. Point number 1, see, a company gives sweat equity shares to whom? Company gives these shares to directors or employees of the company. Why? What is a company getting in return from the directors and employees? Company is getting in return from them either know-how, or the company is getting intellectual property rights, or the company is getting some value addition in whatever name called. So come on, answer my questions now. Company is giving sweat equity shares to whom? Directors or employees. Who is directors or employees? They're either directors or employees of the company, or directors or employees of the holding company, or directors or employees of the subsidiary company. Now, why is the company giving them sweat equity shares? What is the company getting in return? Either know-how or intellectual property rights or value additions. Now, what are these value additions? Value additions are nothing but actual or anticipated economic benefits. Once again, they are actual or anticipated economic benefits. Point number 1. Then comes my point number 2. What is the maximum limit? How many sweat equity shares can the company issue in a year? There are two limits. We have the per annum limit and we also have the overall limit. The per annum limit is 15% of paid up equity share capital or issue value rupees 5 crore, whichever is higher. And your total overall limit is we have two total limits, one for startups and one for non-startups. For non-startups, your overall limit is 25% of paid up equity share capital. So we have per annum limit and we have our overall limit. Our per annum limit is 15% of the existing paid up equity share capital or issue value 5 crore, whichever is higher. And the total limit, the overall limit is 25% of paid up equity share capital. Then comes my third reminder. If the company wants to issue sweat equity shares, it first of all has to pass a prior special resolution. Now that special resolution has a validity period. Do you remember what the validity period is? Validity period is 12 months, guys. Now validity period means what? It means within this 12 months period, the company is supposed to allot the sweat equity shares. Now what if the company is unable to allot the sweat equity shares within this 12 months period? Then that special resolution will lapse and the company will have to once again pass a special resolution to issue the sweat equity shares. Okay, so 3 reminders. Point number 1, company is issuing sweat equity shares to directors or employees of the company, holding company or subsidiary company. Reminder number 2, in return, what is the company getting? Know-how, intellectual property rights or value addition. What is value addition? Nothing but actual or anticipated economic benefits. Then what's the maximum limit? We have two maximum limits, per annum limit and overall limit. The per annum limit is 15% of the existing paid up equity share capital or issue value 5 crore, whichever is higher. And the total overall limit is 25% of paid up equity share capital. And then we learned if the company wants to issue a sweat equity share, company has to pass a prior special resolution which will have a validity period of 12 months only. Now keep these reminders in your mind and now come to the question. The question says AB Tech Solutions Limited, a non-startup company, it's not a startup, it has paid up equity share capital of 20 crores. So I'll keep making a note. This company's paid up equity share capital is 20 crore rupees. Company wants to issue sweat equity share worth 4 crore to the Chief Technology Officer for providing expert and specialized technical know-how and developing proprietary software that is expected to generate significant future economic benefits for the company. Let's try to interpret paragraph by paragraph. No tension. It's all simple, guys. See, company is not a startup company. Company has paid up equity share capital of 20 crores. It wants to issue sweat equity shares for 4 crore rupees. To whom? To CTO. Now, the CTO is an employee of the company. Why is the company giving him these sweat equity shares? What did he give in return to the company? He has given in return to the company know-how, and some proprietary software which will generate significant future economic benefits. So he has given some software which is going to generate future economic benefits. So in return, the CTO is giving know-how to the company and some value addition. So in return, company is going to give him sweat equity shares worth how much? Worth 4 crore rupees. Okay. Then the question says it is also mentioned by the company that the consideration value of sweat equity shares is not included in the normal employment contract entered in the case of CTO, which means whatever sweat equity shares company is going to give is in addition to his existing contract, and this is the only issue of sweat equity shares. Why have they given this? See, the earlier statement may not be very relevant, but this statement is definitely relevant. The question is saying this is the only issue of sweat equity shares, which means when we compute the total limit, this is the only issue of sweat equity shares. We don't have existing sweat equity shares in the company. This is the only sweat equity shares which the company has issued. Okay. Company passed a special resolution for the issue of sweat equity shares on 1st Jan 25. Now, this special resolution will be valid for only 12 months. So, we passed this resolution on 1st Jan 25. So, it will be valid only till 31st December 25. So, within this period, company must complete the allotment of sweat equity shares. Company has complied with all the conditions necessary for the issue of sweat equity shares. Shares are proposed to be issued at fair price determined by registered valuer. This is also okay. Allotment is planned to be made on 15th February 26. Is this okay? We just saw our special resolution is valid only till 31st December 25, guys. Within this date, company must complete the allotment, but company is planning to allot only on 15th February 26. This is after the validity period. So, if the company wants to issue the sweat equity shares only on 15th February 26, then again a special resolution will be required because this special resolution will lapse by then. Okay, now what are they asking us? With reference to the provisions of Companies Act, answer the following. Whether the proposed issue of sweat equity shares is valid with respect to the maximum limit and the purpose for which the shares can be issued. So, two things. Is the maximum limit complied with? Is the purpose complied with? Then they're asking you whether the special resolution made in Jan 25 remains valid. This we have already concluded that no, the special resolution will lapse. It has a validity period of 12 months only. So therefore the company will have to once again pass a special resolution if the company wants to allot sweat equity shares on 15th February. So this question is fine. Let's target this one now. In the first question, they're asking you two things. Number one, is the maximum limit condition complied with? And number two, is the purpose fine? See, purpose we've already discussed. The company is giving sweat equity shares to the employee because in return we got from him know-how and value addition. So even the purpose is fine. Now the only thing that we have to check is the maximum limit. Come on guys, this is where it gets interesting. There are two maximum limits, right? The first one is your per annum limit, and then we have the overall limit. We will do them one by one. What's your per annum limit? Per annum limit is the sweat equity shares which we are issuing should be within 15% of the existing paid up equity share capital or 5 crore rupees, whichever is higher. So 15% of 20 crores, 15% of 20 crore will be 3 crore. So 3 crore or 5 crore, which is higher? Of course, 5 crore will be higher. Now company is planning to issue how many sweat equity shares? Company is planning to issue for 4 crore rupees only, which is within 5 crores. So therefore, I can say per annum limit is fulfilled. So as per the per annum limit, company can issue sweat equity shares worth 5 crore rupees maximum. Company is issuing 4 crore rupees worth shares only, which is within 5 crore. So per annum limit is fulfilled. Then we have one more limit. We have the overall limit, the total limit. The total limit for non-startups is 25% of the paid up equity share capital, guys. So the paid up equity share capital is 20 crore. This into 25% will be 5 crores. So overall, total put together, all the years put together, company can have maximum 5 crore sweat equity shares only. 5 crore rupees worth sweat equity shares. Company clearly says that before this, the company has never issued sweat equity shares in the past. Remember, we read over here that this is the only issue of sweat equity shares. And this sweat equity share issue is for 4 crore rupees, which is within 5 crore rupees. So my per annum limit is also fulfilled. My overall limit is also fulfilled. Definitely, my company can go ahead and issue these sweat equity shares. So 3 things they asked us. Number 1, is a maximum limit condition fulfilled? Yes. Per annum limit is 5 crore, but we are issuing sweat equity shares for 4 crore rupees only. Overall limit is 5 crore, but we are issuing sweat equity shares for 4 crore only. So the limit criteria is fulfilled. Then is the purpose fulfilled? Yes. We are issuing sweat equity shares because in return we are getting know-how and value additions. So even that is as per section 54. Then what about the special resolution? By 15th February 26th, the special resolution will lapse. No problem. Company, you can once again get a special resolution passed, and then you can issue the sweat equity shares. Okay, this was your question number 2, all about sweat equity shares. Now come to question number 3. This is a very interesting question, guys, from debentures. Now let me give you a reminder of the provisions first. First, tell me what's the maximum tenure of debentures. Like when the company issues debentures, company cannot issue irredeemable debentures. Company can issue redeemable debentures only. So the redemption period can be maximum what? Maximum 10 years only. Alright. But however, you know very well, if the company is raising money through debentures for infrastructure projects, then your maximum tenures can be even up to 30 years. Please remember, these are maximum limits. The tenure can be less than this also. These are only your maximum numbers. So the general tenure is maximum 10 years. But if the company is raising money through debentures for infrastructure projects, there your maximum tenure can be 30 years. Point number 1. Point number 2, if the company is issuing secured debentures, then the company has to give some collateral. Company has to give some asset as security. Company has to create a charge on some asset. Now that asset can be movable asset or it can be immovable asset. The movable asset can be movable asset of cash. That's how I've taught you. Movable asset of C for company, A for associate company, S for subsidiary company, and H for holding company. So the movable property can be movable asset of cash, company, associate, subsidiary, and holding company. And if it is immovable property, this immovable property can be situated anywhere. It can be wherever situated, which means it can be situated in India, outside India, doesn't matter. Okay. Second reminder. Then comes a third reminder. Debenture redemption reserve concept is there. No. 10% of the outstanding debentures company has to transfer from its profits into DRR account. Now, this debenture redemption reserve concept is not applicable to all companies. If you remember, I had taught that entire table to you and we had concluded at the end that this concept of DRR is applicable only to other unlisted companies. That was the final conclusion. So, is the DRR requirement applicable for listed companies? The answer is no. Whether a listed company is issuing debentures by public issue, whether the listed company is issuing debentures by private placement doesn't matter. Whether it is publicly placed debentures, whether it is privately placed debentures doesn't matter. For a listed company, DRR requirement is not applicable. So 3 reminders I have given you. Reminder number 1, for debentures, maximum tenure possible 10 years. But if the company is raising debentures for infrastructure projects, 30 years. Then if the company is issuing secured debentures, company has to create a charge on the asset. That asset can be movable also, immovable also. The movable asset can be movable asset of cash, company, associate, subsidiary, holding. And if it is immovable asset, it can be situated wherever in the world, doesn't matter. Then is DRR requirement applicable for listed companies? No. Whether publicly placed debentures, whether privately placed debentures, doesn't matter. For listed companies, DRR concept is not applicable. I'll remind you once again, in our conclusion, we had seen that DRR concept is applicable only for other unlisted companies. Now keep these 3 reminders in your mind and now come to the question. The question says, Syra Projects Limited SPL is a listed public company engaged exclusively in setting up, execution, and financing of long gestation infrastructure projects. So, companies doing infrastructure projects such as highway, port, and metro corridors. Its equity shares are listed on the recognized stock exchange in India. As per the latest audited financial statements, this company has net worth of 1020 crore. So it's a listed company and it is an infrastructure business. Okay. Then the question says, during the year, SPL issued 7,20,000 instruments of 1,000 rupees each, described in the offer document as secured, redeemable, convertible debentures with deferred optional equity conversion feature. No tension. I know for a fact, as soon as you read this, first your heart will skip a beat. But relax. I tell you every time, the calmer you are, the clearer you will think. You read and see, just divide and rule, you will be able to handle it. Company has issued debentures. How many debentures? 7,20,000 debentures. What kind of debentures? They are secured debentures. Then they are redeemable debentures. Of course, guys, they have to be redeemable. Companies prohibited from issuing irredeemable debentures. They are convertible debentures with deferred optional conversion feature. What does this mean? Convertible debentures are of two types: compulsorily convertible, optionally convertible. These are optionally convertible debentures. That's all, guys. You saw, it's simple, right? So yes, no doubt, when you read it for the first time, it does sound like, oh my god, what is this? But read it with a calm mind, divide and rule, you'll be able to handle it. So these are secured debentures, redeemable debentures, optionally convertible debentures. Issue was made by way of private placement to 4 category 2 alternate investment funds, all of which qualify as qualified institutional buyers. See, my company is a listed public company. Just because it's a listed company doesn't mean that the issue of securities has to be by public issue only. Not mandatory. It can make a public issue, it can make a private placement, it can make a rights issue. It's allowed. So this company has made a private placement of these debentures, and company has issued these debentures to whom? To some qualified institutional buyers. Now, what are the terms? Tenure is 16 years. 16 years is fine for you. See, generally tenure has to be 10 years only. But remember, we just now read, company is raising this money for infrastructure projects. So therefore, the maximum tenure can be up to 30 years also. Here it is 16 years only. It is within 30 years. So this is perfectly fine. Then the coupon rate is 8.75% per annum payable annually. Fine. Conversion feature: at the end of the 13th year, the debenture holder may at its discretion convert 30% of the outstanding principal into equity shares of SPL. So the conversion option will trigger only after the 13th year. Security is exclusive first charge on immovable property of the company situated outside India. Second charge on movable fixed assets located in India. So company has given 2 assets as security. The first charge is created on immovable property which is outside India. Not a problem, guys. We just saw immovable property can be situated wherever, not a problem. And the second charge is on movable fixed assets in India. So we can give movable assets, immovable assets, both we can give as security, not a problem. Then the question says, a debenture trustee was appointed, but SPL did not create any debenture redemption reserve. Is debenture redemption reserve required for this company, guys? It's a listed company. For listed companies, anyways, debenture redemption reserve is not required. So company fine only. Anyways, no DRR is required for you. Relying on the following grounds, because it's listed company, private placement, infrastructure company. With reference to the above case, critically examine and answer the following. Whether 16-year tenure is permissible. Yes, it is permissible. Generally 10 years, but infrastructure project can be up to 30 years. Here 16 years only, within 30 years, permissible. Then whether creation of security on assets situated outside India will affect the validity of the debenture issue. No, it will not affect. The debentures will still be valid. The immovable asset over here, which was given as security, is situated outside India. Not a problem. The asset which we are giving as security can be situated anywhere. Not a problem. So even though it is situated outside India, no issues. The validity of the debentures will not get affected. The debentures will still be valid. Then whether SPL is legally justified in not creating debenture redemption reserve. Yes, it's a listed company. For listed companies, whether privately placed debentures, whether publicly placed debentures, DRR concept is not applicable. So company has not created a DRR. So company is justified in not creating DRR. It is not required for the company. Okay, this was your question number 3, majorly debentures. All right, now come to question number 4 from your deposits chapter. This question is a very interesting question. Let's read the question first. Before we read the question, let me give you a reminder first. See, this entire question is about premature repayment of deposits. See, we know very well that even deposits have a tenure. Okay, they have a tenure. After the tenure is over, after that only the company will repay the deposit money. Okay, but however, sometimes the deposit holder, he may ask for premature repayment of deposit. See, premature repayment of deposit is allowed. Premature repayment means the tenure is not over. So before the expiry of tenure, before the repayment period has expired, before that itself, the deposit holder is going to the company and asking for his money back. So you can do a premature repayment like this before the expiry of tenure, but you can ask for premature repayment only after 6 months. Basically, like today, let's say on the 1st of January 2025, deposit was made. Next day itself, you can't go and ask for premature repayment. You have to let the money stay with the company for at least 6 months. After 6 months only, you can ask for premature repayment. So point number 1, can the deposit holder ask for a premature repayment of deposit? Yes. But can he immediately ask? No. He can ask only after 6 months. Okay. Now, in case you ask for premature repayment, then there will be some consequence. The consequence is you will get slightly lesser interest. Now, you will get interest for how long, first of all? You will get interest only for the period for which the deposit has actually run. Like for example, let's say the tenure of the deposit was 26 months, okay, for example, but you asked for premature repayments at 18 months itself. So you will get interest for 18 months. The deposit has run for how long? It has run for 18 months. So whatever period for which the deposit has actually run, 18 months in my example, you will get interest for that 18 months only, not for 26 months. But you will get interest at what rate? So 2 questions. You will get interest for what period? The period is going to be the actual period for which the company has enjoyed your money. But at what rate will you get interest? We will see what is the period for which the deposit has actually run. Now, for this period, what is the applicable interest? That much interest minus 1% is what we will get. Like generally what happens is companies have slabs. Like if the deposit runs for 1 year, we will give 3% interest. If the deposit runs for 2 years, we will give 4% interest. If the deposit runs for 3 years, we will give 5% interest. Like this, generally they have slabs. Even FDs in banks, they have slabs like this. So what we will see, what is the period for which the deposit has actually run? For that period, what would be the applicable interest? That minus 1%, that is how much you will be getting as interest in case of premature repayment. Okay. Now there's a small catch over here. When you're calculating the interest rate, you will see what is the period for which the deposit has actually run. If this period has a fraction, you will see how much is a fraction. If the fraction happens to be within 6 months, then you will ignore the fraction. But if the fraction happens to be more than 6 months, then you will round up the fraction to the next number. You'll understand this point better through this question anyways, but for now, just keep these points in your mind. I'll give you a reminder once again. Point number 1, is premature repayment of deposits allowed? Yes. But can you come and ask for premature repayment immediately? No. You can come and ask for premature repayment only after 6 months. Premature repayment means the tenure of the deposits has not expired. Before that itself, you're asking for repayment. Okay. Then if you ask for premature repayment, there will be some consequence. The consequence is you will get lesser interest. Now you will get interest for which period? You will get interest only for that period for which the deposit has actually run. Basically, you will get interest only for that period for which the company has actually enjoyed your money. But at what rate will you get interest? It depends. We will see what is the period for which the deposit has actually run. For that period, what is the ideal applicable interest? That minus 1%, that much interest rate you will get. Now, when you're doing this calculation, if this period happens to be in fractions, if the fraction is up to 6 months, you will ignore the fraction. And if the fraction is more than 6 months, you will round up the fraction. See, premature repayment of deposit is allowed. Premature repayment means the tenure is not over. So before the expiry of tenure, before the repayment period has expired, before that itself, the deposit holder is going to the company and asking for his money back. So you can do a premature repayment like this before the expiry of tenure, but You can ask for premature repayment only after 6 months. Basically, like today, let's say on the 1st of January 2025, deposit was made. Next day itself, you can't go and ask for premature repayment. You have to let the money stay with the company for at least 6 months. After 6 months only, you can ask for premature repayment. So point number 1, can the deposit holder ask for a premature repayment of deposit? Yes. But can he immediately ask? No. He can ask only after 6 months. Okay. Now, in case you ask for premature repayment, then there will be some consequence. The consequence is you will get slightly lesser interest. Now, you will get interest for how long, first of all? You will get interest only for the period for which the deposit has actually run. Like for example, let's say the tenure of the deposit was 26 months, okay, for example, but you asked for premature repayments at 18 months itself. So you will get interest for 18 months. The deposit has run for how long? It has run for 18 months. So whatever period for which the deposit has actually run, 18 months in my example, you will get interest for that 18 months only, not for 26 months. But you will get interest at what rate? So two questions. You will get interest for what period? The period is going to be the actual period for which the company has enjoyed your money. But at what rate will you get interest? We will see what is the period for which the deposit has actually run. Now, for this period, what is the applicable interest? That much interest minus 1% is what we will get. Like generally what happens is companies have slabs. Like if the deposit runs for 1 year, we will give 3% interest. If the deposit runs for 2 years, we will give 4% interest. If the deposit runs for 3 years, we will give 5% interest. Like this, generally they have slabs. Even FDs in banks, they have slabs like this. So what we will see, what is the period for which the deposit has actually run? For that period, what would be the applicable interest? That minus 1%, that is how much you will be getting as interest in case of premature repayment. Okay. Now there's a small catch over here. When you're calculating the interest rate, you will see what is the period for which the deposit has actually run. If this period has a fraction, you will see how much is a fraction. If the fraction happens to be within 6 months, then you will ignore the fraction. But if the fraction happens to be more than 6 months, then you will round up the fraction to the next number. You'll understand this point better through this question anyways, but for now, just keep these points in your mind. I'll give you a reminder once again. Point number 1, is premature repayment of deposits allowed? Yes. But can you come and ask for premature repayment immediately? No. You can come and ask for premature repayment only after 6 months. Premature repayment means the tenure of the deposits has not expired. Before that itself, you're asking for repayment. Okay. Then if you ask for premature repayment, there will be some consequence. The consequence is you will get lesser interest. Now you will get interest for which period? You will get interest only for that period for which the deposit has actually run. Basically, you will get interest only for that period for which the company has actually enjoyed your money. But at what rate will you get interest? It depends. We will see what is the period for which the deposit has actually run. For that period, what is the ideal applicable interest? That minus 1%, that much interest rate you will get. Now, when you're doing this calculation, if this period happens to be in fractions, if the fraction is up to 6 months, you will ignore the fraction. And if the fraction is more than 6 months, you will round up the fraction. I'll make a small correction. If the fraction is less than 6 months, you will ignore the fraction. If the fraction is more than or equal to 6 months, you will round up the fraction. Okay, less than 6 months, you will ignore. More than or equal to 6 months, you will round up the fraction. This was my second reminder. Now comes the third reminder. Generally, in premature repayment cases, we will reduce 1% interest. But we will not reduce 1% interest in two situations. Situation number 1, the company is making a premature repayment not because the deposit holder asked for premature repayment. No. Company is making a premature repayment by itself. Why? We know, right? For companies, there's a maximum limit that how much deposits they can accept is a maximum limit. So if the company has accepted deposits more than the limit, then to rectify this default, the company will make a premature repayment to come back within the limit. So if the company by itself is making a premature repayment, depositor is not asking for his money back. Company is making a premature repayment so that it can comply with the applicable limit. Then in that case, yes, there is premature repayment, but we will not reduce interest because depositor did not ask for premature repayment. Company itself is making a premature repayment, so we should not punish the depositor by giving him lesser rate of interest. First situation. Second situation, in war cases, emergency cases also. In emergency situations, we will not reduce the 1% interest. Okay. So this was my 3 reminders for you. Now come on, have a look at the question. The question says ABC Limited is an eligible company. Guys, if the company is an eligible company, it can not only accept deposit from members, it can also accept deposits from public. So this company is an eligible company to accept deposits. It has accepted FD of 5 lakh rupees from Mr. R on 1st April 2022. So this deposit was accepted on 1st April 2022. How much deposit? 5 lakh rupees. For a period of 36 months. So the decided tenure is 36 months, 3 years. At an interest rate of 9% per annum. Okay. On 30th November 24, after the expiry of 6 months from the date of deposit, but before the date of maturity, Mr. R is requesting premature repayment. When is he requesting premature repayment? 30th November 2024. First tell me, is this premature repayment allowed or not? You can ask for premature repayment but not immediately. You can ask only after 6 months. The deposit started on 1st April 2022. 6 months will be what? October 2022. But we are asking for premature repayment only in 2024. So definitely we are asking for premature repayment after 6 months. That condition is fulfilled. And first of all, am I right in calling it premature repayment? See, the deposit was accepted on 1st April 2022 for 36 months. 36 months means 3 years. So 1st April 2022 plus 36 months. When will the tenure expire ideally? The tenure will expire on 31st March 2025, guys. And before 31st March 2025, on 30th November 2024, you're asking for premature repayment. So is this premature repayment allowed? Yes, guys. It is before the expiry of tenure, but it is after 6 months. So yes, this premature repayment will be allowed. Then the question says ABC Limited agreed to repay the deposit on the same date. Deposit rate of interest offered by the company for 12 months is 7%, for 24 months is 8%, and for 36 months is 9%. Now tell me, before we continue to read the question, you yourself tell me. In this case, I'm asking you 2 questions. We will get interest for what period and at what rate? We will get interest only for the period for which the deposit has actually run. Company accepted the deposit on 1st April 2022. Ideally, it was supposed to be till 31st March 25. But you asked for premature repayment on 30th November 24 itself. So the deposit has run till when? Only till 30th November 2024. Now this is going to be how long? This is going to be 2 years, and after that, April, May, June, July, August, September, October, November. It's going to be 2 years and 8 months, which means 24 plus 8, 32 months, guys. So we will get interest for 32 months only. But we will get interest at what rate? The rate will depend upon this period, the period for which the deposit has actually run. The deposit has actually run for 2 years and 8 months. I told you, in this calculation you will see if there's a fraction, you will round up. If the fraction is up to 6 months, if the fraction is less than 6 months, you will ignore the fraction. But if the fraction is more than or equal to 6 months, you will round up. So even though it is 2 years and 8 months, you will round up to 3 years. Understanding? 3 years because the fraction over here is 8 months. The fraction is more than 6 months. So because the fraction is more than 6 months, I will round up to the next year. So 2 years, 8 months, I will round up to 3 years. Now see, for 3 years, for 36 months, what is the applicable interest rate? 9%. So 9% minus 1%, 8% interest we will be getting. So we will get interest for how long? For 32 months. And at what rate? At 8%. Okay. Then the question is asking us, calculate the period of deposit and the rate of interest. We just now saw the period of deposit will be 32 months and the interest that my company will give to Mr. R will be 8%. And what is the situation where the reduction of rate of interest is not applicable? This also we saw already over here. Generally, we reduce this 1% interest in premature repayment cases, but there are 2 exceptional cases where we don't reduce this 1%. What are the 2 cases? Number 1, when my company itself is making a premature repayment so that it can bring the total amount of deposit within the prescribed limit. And second situation is in war and emergency cases. Okay. So in these 2 cases, even though the company is making premature repayment, still that 1% reduction of interest will not come into the picture. This was your question number 4 on deposits. Now comes question number 5. This is going to be a nice case-based MCQ. Before I start this, let me give you a reminder of concepts once again. The first reminder, deposit repayment reserve. Tell me the percentage. What's the percentage that comes to your mind? Deposit repayment reserve, 20%, guys. Very simple. We will simply see how much deposits are maturing in the following year. 20% of that the company has to transfer into deposit repayment reserve when, on or before what date? 30th April. Right? So deposit repayment reserve percentage, 20% of the deposits maturing. Then tell me what happens if the company does not repay deposits on time. If the company does not repay the deposits on time, company will have to pay interest. How much interest? Company will have to pay 18% interest. For what period? For the overdue period. Like for example, if the company was supposed to repay debentures or repay the deposits on the 1st of Jan 2025, but company repaid the deposits on the 4th of Jan 2025. So company repaid 3 days late. So for these 3 days, for the overdue period of 3 days, for these 3 days, company will have to pay 18% per annum interest. So if the company does not repay deposits on time, company will have to pay 18% per annum interest for the overdue period. Keyword, guys, be careful. Now this interest, be careful, is applicable for which deposit? It is applicable for those deposits which have been matured and claimed. Matured and claimed deposits. Basically, simple words. Once a deposit period is over, once a tenure is over, once the deposits mature, now the depositor should come and claim his money back. So if the deposits have matured and the depositor has claimed his money back, but the company is not repaying the deposits, then company will have to pay 18% per annum interest for overdue period. Okay, only for matured and claimed deposits. Then there's one more provision which you must have learned in the dividends chapter. You must have learned over there that if the company defaults in section 73 or 74, basically any default if the company does with respect to deposits, then dividend cannot be declared by the company. But once the company rectifies the default, then the company can declare dividend. Here I don't know why students generally tend to get confused. They think company has to wait for 5 years and all. There is no such requirement. Once the company rectifies a default, immediately next day itself, company can issue dividend. Okay. So 3 reminders I have given you. Reminder number 1, deposit repayment reserve. What percentage comes to your mind? 20%. Then reminder number 2, if the company does not repay deposits on time, company has to pay interest. How much interest? 18% per annum interest. For which period? For the overdue period. Now this interest company will have to pay on which deposit? On matured and claimed deposit. Okay. And lastly, if the company does any default with respect to deposit, company will not be able to declare dividend. But once the company rectifies the default, then the company can declare dividend. Okay. That's all, guys. Now come on, have a look at the question. Let's patiently read the story first. What does the question say? Shraddha Metals Limited, an eligible company. It's an eligible company, guys. So therefore, it can accept deposit from members also. It can accept deposits from the public also. It has accepted deposits from members and public. An outstanding amount of the secured deposits for the year ended 31st March 25 was 50 crores. So it's an eligible company. It has accepted deposit from members also, from public also. And the total outstanding deposit in the company is 50 crore rupees. Out of this, 20 crore of the deposits was due for repayment during 25-26. So total deposits company is having 50 crores. Out of 50 crores, 20 crores is going to be due for repayment in the next year. 20 crore is due for repayment. As per the provisions of Chapter 5, company was required to place a certain percentage of deposits maturing during the following financial year in a scheduled bank, in a separate bank account, to be called as deposit repayment reserve account. However, company deliberately avoided the compliance of the relevant provision. Do you agree company has done a violation over here? It is definitely a violation, guys. The company is not putting the money in deposit repayment reserve. See, next year in 25-26, 20 crores of deposits are going to mature. So whatever deposits mature in the next year, company is supposed to put 20% of that amount into deposit repayment reserve. But the company has deliberately avoided this compliance. So company has done a violation over here. For the year ended 31st March 25, that is for financial year 24-25, company earned net profit of 35 crores after providing depreciation in Schedule 2. Apart from current year's profit, company has free reserves 85 crores. So company's current year profit is 35 crores and company's free reserves are 85 crores. Board of directors of the company recommended payment of dividend at 15% per share. Will you allow, guys? See, company has done a violation with respect to deposit. Company has not put money into deposit repayment reserve. So till this violation is existing, company, no, you can't declare dividend. Once you rectify the violation, then you can declare the dividend. Okay. Then Ritika, who had placed deposit of 5 lakh rupees with the company that was maturing on 25th April 25. Ritika sent the original deposit receipt duly discharged on its back to the company along with details of a bank to enable the company to credit the maturity proceeds directly in her bank account. So Ritika is one of the deposit holders. Her deposit is maturing on 25th April 25. So she's claiming her money back. The deposit period is over, the tenure is over. So she's asking her money back. She's sending the deposit receipt along with the bank account details and all. However, the company did not pay the amount on due date. When Ritika served a legal notice on the company through her advocate, company paid her the maturity proceeds on 13th July 25. Company has delayed, guys. Company was supposed to pay on 25th April, but company is actually making the repayment to Ritika only on 13th July. Then there's one more depositor, Rajesh, who had not claimed his matured deposit on that date, but company is not at default. So they've given us information about two depositors, Ritika and Rajesh. With respect to Ritika, company has definitely done a default. Company has repaid late. Company was supposed to repay on 25th April. Company is repaying only on 13th July. So with respect to Ritika, for this overdue period, company will have to pay 18% per annum interest. It is matured deposit also. It is claimed deposit also. She claimed her money back. So when it comes to Ritika, to her, company will have to pay 18% per annum interest for this overdue period. But however, when it comes to Rajesh, his deposit has matured, guys. But did he claim his money? He did not claim his money. The Rajesh had not claimed his matured deposit. So the deposit has matured, but he has not claimed his money. So therefore, with respect to Rajesh, 18% interest will not apply. Understanding? You're getting the point right. My first discussion over here was about deposit repayment reserve. Company is supposed to put 20% of the maturing deposits into deposit repayment reserve. Companies purposely not fulfilling that requirement. Definitely there's a violation. So because there's a violation, we concluded that company will not be able to declare dividend till you rectify this violation. Then the second part of my discussion was we are having two deposit holders over here, Ritika and Rajesh. With respect to Ritika, the company is not repaying the deposit to her on time. Her deposit has matured and she's also claiming her money. She's sending her bank account details and all. She's claiming her money, but the company is not repaying the deposit money to her on time. So to Ritika, company will have to pay 18% interest. But when it comes to Rajesh, with respect to him, the deposit has matured, but he has not claimed the deposit money. So if he itself is not claiming the deposit money, company is not at default. So therefore, company will not have to pay any interest. So if I have to summarize, I am having two depositors, Ritika and Rajesh. So has the company committed a default? With respect to Ritika, yes, company committed a default. Company repaid money to her late. And will company have to pay 18% interest? Yes, company will have to pay 18% interest because company did not repay the deposit on time. The deposit matured and it was claimed. But with respect to Rajesh, he himself has not claimed the money. So therefore, company is not a default. And because company is not a default, I will not ask the company to pay 18% interest. Okay. Now, based on the facts given in the above case, answer the questions. The penal rate of interest payable on the deposit of Rajesh, just now we saw, with respect to Rajesh's deposit, is any interest going to be applicable? No interest is going to be applicable. So therefore, none of these answers are correct. There is no correct answer over here for this question. Incorrect question this is. Actually, they meant to write Ritika over here, guys. For Ritika, how much interest will be applicable? 18% interest will be applicable. But for Rajesh, no interest will be applicable. Then, how much amount is a company required to deposit in scheduled bank in separate bank account called deposit repayment reserve? In deposit repayment reserve, company is supposed to deposit 20%. 20% of the deposits which are maturing. How much deposits are maturing? Remember, total 50 crore deposit companies are having, but only 20 crore is outstanding. Only 20 crore is maturing. So the deposits maturing are 20 crore. That into 20%. So 4 crore. This is what the company will have to put into deposit repayment reserve. Then, decide the most appropriate answer as to whether company can declare dividend on 14th July. On 14th July, can the company declare dividend or not? See, listen, be careful. Ritika's default, if you see, company has rectified on 13th July. So before 14th July, Ritika's default company has rectified. But however, deposit repayment reserve is still not rectified, guys. Company has still not put the money into deposit repayment reserve. That company is purposely deciding not to comply with this provision. So because a violation is existing on 14th July 25, with respect to Ritika, the violation is rectified, but the DRR violation is not rectified till now. So can the company declare dividend on 14th July? Actually, company cannot declare dividend. So what's your correct answer? Answer is no. So it can't be yes, either option C or option D. Option C says company cannot declare dividend till the unclaimed deposit is paid. No, wrong. Unclaimed deposit is with respect to Rajesh. So there Rajesh itself is not claiming his money. So company has not even done any default over there. So that is totally out of the picture. Option D, no, company cannot declare dividend since it had defaulted to comply with the provisions of maintaining required percentage of deposit in deposit repayment reserve and to be kept in a separate scheduled bank. Option D is the answer. We even concluded over here that why company can't declare dividend on 14th July? Reason is DRR violation is still existing. So deposit repayment reserve violation is still existing. So because of this reason, company cannot declare dividend on 14th July. Got the point, guys? So this question was purely about deposits. So firstly, with respect to Rajesh, he has not even claimed his deposit money. So the company is not even a default over here. So no interest company will pay with respect to Rajesh's deposit. Then the second question was about deposit repayment reserve. Very simple calculation. We'll see how much deposits are maturing. 20% of that has to be transferred into deposit repayment reserve account. Then third question, even this was simple. They were asking us on 14th July, can we declare dividend or not? On 14th July, with respect to Ritika, the default company has rectified. But the deposit repayment reserve violation is still existing. So because it's a violation with respect to some deposit provision, till this violation is existing, company cannot declare dividend. But once the company rectifies the default, then next day itself, company can declare the dividend. Okay, this was your question number 5. Now come to question number 6. This is with respect to your charges chapter. Let me give you a quick revision first. Simple 3 points, guys. Point number 1 is about satisfaction of charge, section 82. So in section 82, we have learned that in case a charge is satisfied or in case the company repays the loan, then the company has to intimate ROC about it. So in case of satisfaction of charge or in case the company repays the loan, who should inform the ROC? Company should inform the ROC. And when should the company inform the ROC? What is the time limit? The time limit is within 30 days. So within 30 days after satisfaction of charge, company is supposed to inform the ROC about the satisfaction of charge or about the repayment of loan, as the case may be. Here, if you remember, we also learned that in case the company is unable to intimate ROC within 30 days time, then company can intimate to the ROC within 300 days from the date of satisfaction. But in that case, of course, company will have to pay additional fees. Okay, that was your first reminder. Then comes the second reminder. Entire charges chapter, we have only one punishment. In this entire charges chapter, if the company does any contravention, there's one single punishment, and the punishment is the company will be punished with 5 lakh rupees and the officer in default will be punished with 50,000 rupees. Okay, second reminder. Then comes your third reminder. Generally, ideally speaking, when the charge is satisfied, the company is supposed to inform the ROC. But however, if the ROC has not received intimation from the company, without receiving intimation from the company, if ROC receives, do you remember the keyword? Company is not intimating to the ROC, but ROC receives evidence to his satisfaction. What evidence? Either that the secured debt is repaid, or the charged asset is released from the charge, or the charged asset is not company's asset anymore. Basically, the charge is satisfied or the loan is repaid. Company is supposed to inform ROC, but company did not inform ROC. But ROC, from his sources, he got evidence to his satisfaction. So he himself got to know that the charge is satisfied. Then in that case, what ROC will do? Even though the company has not informed ROC about it, still ROC will himself enter memorandum of satisfaction in the register of charges. Full keywords in section 83, guys. ROC will enter memorandum of satisfaction, and then ROC will issue a certificate of registration of satisfaction of charge, and then ROC will inform the affected parties within how much time? Within 30 days time. Okay, so these were the three reminders I wanted to give you. Reminder number 1, section 82. Under section 82, when the charge is satisfied or when the loan is repaid, the company is supposed to inform about it to the ROC within 30 days. Then, in case the company does any contravention under the charges chapter, company will have to be punished with 5 lakh rupees and officer in default will be punished with 5 lakh rupees. Third reminder, final reminder, in case the charge is satisfied, but company is not informing ROC, but ROC got evidence to his satisfaction from other sources, ROC got to know that the secured debt is repaid or the charge is satisfied or the charged asset is released from the charge or the charged asset is not company's asset anymore. If ROC gets evidence to his satisfaction, then ROC will enter memorandum of satisfaction in the register. ROC will issue certificate of registration of satisfaction of charge and ROC will inform the affected parties within 30 days. Now come to the question. It's a proper descriptive question. Nandan Dairy Product Limited was engaged in the business of producing and selling milk products. It had more than 500 cows at its farm. Company had raised loan from a bank by hypothecating the cows and the charge to this effect was also registered with the registrar. Basically, company has created a charge on the cows. Okay. The company later changed its business model from producer of milk to marketing of milk and other consumer products, altered its objects clause of MOA and filed with ROC. So earlier the company was in the business of producing and selling milk products. Then the company raised a loan from the bank by creating a charge on the cows. Then the company changed its business. Now the company's new business is marketing of milk. It's not going to produce milk, it's just going to market milk now. And it has also altered its objects clause and it has informed ROC about it. Company, in light of the changed objects, sold out all the livestock to the villagers and milk cooperative societies. However, the satisfaction of charge was not filed within 30 days of loan repayment. Story is clear. Earlier, the company was in the business of producing milk products. And for that business, company took a loan from a bank. For that loan, company gave the cows as security. Basically, charge was created on the cows, on the livestock. Then the company changed its business. From producing milk products, it changed business into marketing milk products. Because it changed its business, it made the alteration in the objects clause and all properly it did. Then, because the company is now marketing milk and not producing milk, it does not need the cows. So the company sold the cows. Company sold the livestock to the villagers and milk cooperative societies. Company sold the cows. So which means the charged asset is not company's asset anymore. The asset on which the charge was created, the livestock, is not company's asset anymore. It will result into satisfaction of charge. Company is supposed to inform ROC about it, but company has not informed ROC about it. Then the question says registrar somehow came to know that company has fully liquidated the loan against the livestock raised by it and has also disposed the livestock. So even though company did not inform ROC that the company has repaid the loan, that the company has disposed the livestock, even though company has not informed this to ROC, ROC somehow came to know about it. Okay, now what are they asking us? Who is responsible for filing the satisfaction of charge with ROC? Who is responsible for filing, guys? Company. Company is supposed to inform ROC about satisfaction. What is the punishment for contravention? Punishment we saw. Company will be punished with 5 lakh rupees. Officer in default 50,000 rupees. Then, whether ROC can make entry of satisfaction and release in absence of intimation from the company? Yes. This section 83 that we just now saw. Even though the company has not informed the ROC about the satisfaction of charge, ROC got to know about the satisfaction from some other source. So ROC can simply follow section 83 and ROC on his own, he can enter the memorandum of satisfaction and issue the certificate of satisfaction of charge and inform the parties. Okay, clear? Good question, guys. Nice revision we got through this. Now come to question number 7. This is from your management and administration chapter. Let me give you a revision. 2 small points only. First of all, what's a quorum? Quorum is nothing but the minimum number of members who must be personally present at the meeting for us to validly transact business at the meeting. So what is the quorum? What's the number? In private company, the quorum is 2. In public company, the quorum will depend upon how many members are there in the public company. If the public company has up to 1,000 members, then the quorum required will be 5. If the public company has more than 1,000 members but up to 5,000 members, then in that case the quorum required will be 15. But if the public company has more than 5,000 members, then the quorum required will be 30. So private company 2. In public company, the quorum will fully depend upon how many members are there in the company. In public company, there's no limit, right? We can have any number of members. So if we have up to 1,000 members, the quorum required is 5. If we have more than 1,000 but up to 5,000 members, quorum required is 15. And if we have more than 5,000 members, quorum required will be 30. Okay. And then you also remember, right? Quorum must be present at the meeting within 30 minutes from the appointed time. What if the quorum is not there within 30 minutes of the appointed time? Then the meeting will get adjourned to same day, same time, same place next week, or any other date, time, place which the board of directors will decide. Okay. Now come to the next point. The second reminder I want to give you is about special resolution. See, special resolution means what? Special resolution means a resolution where the number of votes cast in favor is at least 3 times the number of votes cast against. Yes, I know you must have learnt it as 3/4 majority or 75%, but those numbers can't enter my answer paper. The legal terminology, the right way of answering is special resolution means a resolution where the number of votes in favor is at least 3 times the number of votes against. And also remember, if for a particular matter special resolution is required, then in the notice it has to be clearly mentioned that for this particular matter special resolution has to be passed. Okay, so like for example, when the company is issuing notice for the meeting, in the notice we will have the agenda, right? That in this meeting what are all the matters which are going to be taken up for discussion. Now in those matters, for whichever matter special resolution is required, that has to be specifically mentioned in the notice that for this matter SR is required. Okay, so 2 points. Special resolution means a resolution where the number of votes in favor is at least 3 times the number of votes against, and here in the notice it has to be mentioned that for this particular matter SR is required. And also remember, in special resolution the casting vote of the chairperson is irrelevant. Okay, now come on, have a look at the question. The question says there are 7,000 members of Six Sigma Power Zone Limited. Looking at the name of the company itself, I can say it's a public company, guys. Because if it was a private company, the name would have said private limited. It just says Six Sigma Power Zone Limited. So it's a public company, and this company has 7,000 members. Company's AGM was held on 20th August 25. In this AGM, only 70 members were present. When a particular business agenda was being discussed, which was required to be passed on special resolution, 10 members walked out of the meeting room. So understanding, this is a public company. In this company, there are totally 7,000 members. So first of all, can you tell me what is the applicable quorum for this company? It's a public company. The number of members is more than 5,000. If it is more than 5,000, the applicable quorum is going to be 30. And how many members were personally present, guys? 70 members were present, which means quorum is there. Then one matter came up for discussion for which SR is required, but before that matter 10 members walked out. So when 10 members walked out, we still have 60 members. So quorum is still present. You remember, right? Quorum should not only be present at the beginning of the meeting, quorum should be present throughout the meeting. So quorum was there in the beginning of the meeting, we had 70 people. Then later, before one particular matter, 10 members walked out, we still have 60. So we still have the quorum. Then the question says, out of the remaining members present, how many members are present now? 60 members are present. Out of them, 15 voted against the proposal. So 15 of them voted against the proposal and the rest voted for the resolution. So 15 voted against, the balance 45 voted in favor. Chairman of the meeting declared that resolution has been passed as special resolution. Tell me, guys, if voting has happened like this, can I say SR is passed? SR means what? The number of votes in favor should be at least 3 times the number of votes against. How many votes are in favor over here? 45. What is 3 times the number of votes against? 3 times of 15 will be 45. So is the number of votes in favor more than or equal to the 3 times the number of votes against? Yes. So is the chairman right in calling it a special resolution? Yes, he's perfectly right. So everything has happened proper, guys. We have the quorum also. SR is also properly passed. So everything is perfectly fine. So whether the quorum was proper? Yes, the quorum is proper. The applicable quorum over here is 30 and we did have more than 30 members throughout the meeting. Then, what is the voting requirement of passing resolution as special resolution? Just now we learned. Number 1, it should be mentioned in the notice that for this particular matter, SR is required. And number 2, the number of votes in favor has to be at least 3 times the number of votes against. Then they're asking us whether the declaration of chairperson of passing the resolution as SR is valid. Yes, even that was valid. We had concluded over here itself. The chairperson had declared the resolution as special resolution. He's perfectly right. We did the calculation also, we saw the number of votes in favor is at least 3 times the number of votes against. So yes, SR is passed over here. The chairperson's declaration is perfectly valid over here. Okay, simple, straightforward. Now come to the next question, question number 8. This is from your mock test paper of September 26, and this question is majorly about AGM. Okay, let me give you 2 reminders over here. Reminder number 1, what is the time limit to hold the first AGM? I'm not asking you subsequent AGMs, first AGM. For the first AGM, we have a special provision, guys. The first AGM has to be held within 9 months from the date of closing of the first financial year. So from the end of the first financial year, within 9 months, we have to hold the first AGM. Then, can ROC allow extension of time limit for AGM generally? Yes, guys. See, generally, if we are not able to hold the AGM within the applicable time limit, we can go to the ROC and we can request for extension, and ROC will give us 3 months extension maximum, guys. But however, for the first AGM, can we ask for extension? For the first AGM, we can't ask for extension. Okay. So time limit to hold the first AGM is within 9 months from the end of the first financial year. Then generally, in case we are not able to hold the AGM within the time limit, we can go to the ROC and we can ask him for extension of time limit, and he will give us extra time, up to 3 months extra time he will give us. But however, for the first AGM, there is no extension possible. Okay, for the first AGM, no matter how genuine your reason is, no extension is possible. Now come on, have a look at the question. The question says, Sparsh Innovations Limited was incorporated on 10th August 2024. The company's first financial year as per board resolution is proposed to close on 31st March 25. So this company's first financial year is 10th August 24 to 31st March 25. Okay. The board of directors, being preoccupied with initial business setup activities, has not yet convened the company's first AGM even by December 25. So till December 25, company has not convened first AGM. What's the time limit for the first AGM, guys? First AGM, we will see what is the end of the first financial year. End of the first financial year is 31st March 25. From that date plus 9 months. That's going to be 31st December 25. So company has time till 31st December 25. Question says right now it is December 25 and till now company has not held the first AGM. No problem, company. You're very close to the time limit. You have time till end of December. By 31st December 25, hold the first AGM. So the company wishes to know the latest date by which first AGM must compulsorily be held. The latest date is 31st December 25. Then the question is saying separately, the company secretary suggests that since the company is newly incorporated and faced genuine operational difficulties in finalizing accounts, application may be made to ROC for extension of time. No. First AGM, I don't care how genuine your reason is, ROC will not allow extension. For the first AGM, extensions are not allowed at all. What are they asking us? What's the time limit within which Sparsh Innovations Limited was required to hold the first AGM? So the time limit is 31st December 25. Whether the company has already defaulted? No. As of now, there is no default because right now we are in December 25, the question says. So as of now, there is no default, but company, you are very close to the time limit. By 31st December, you have to hold the AGM. Then whether ROC has the power to extend the time for holding the company's first AGM? No. Even though the reason is genuine reason, doesn't matter. For the first AGM, no extension in time limit. Okay. Then come to question number 9. Question number 9 is a case-based MCQ. Very good question again. I'll give you the reminders first, then we will start the question. First reminder, quorum should be present within how much time? Just some time back only I told you. Quorum should be present within 30 minutes of the appointed time. What if it is not there within 30 minutes? Then the meeting will get adjourned to same day, same time, same place in the next week or any other date, time or place which the board will decide. Okay. Then second reminder, explanatory statement, section 1 or 2. You remember when we learn about the notice of the meeting? Right after the notice, we learn about explanatory statement, guys. So this reminder is about explanatory statement. Now, explanatory statement has to be attached to the notice of the meeting. It has to be attached for each special business. So basically, in the notice of the meeting, we will put the agenda, right? That what are all the items which we are going to discuss in the meeting. Now, those items, some of them will be ordinary businesses, some of them will be special business. For each special business, we will have to prepare an explanatory statement and attach it to the notice. So point number 1, is explanatory statement relevant with respect to ordinary businesses? No, it is relevant only with respect to special business. So for each special business, company will have to prepare an explanatory statement and that statement has to be attached to the notice. Okay. Now what is contained in the explanatory statement? As per section 1 or 2, if you remember, there are 4 contents which I taught you in explanatory statement. But right now my discussion is about one of the contents. One of the points is, if this special business with respect to which we have made the statement, if this special business is relating to some other company, and in that other company, our director, manager, promoter or KMP is having shareholding, understanding. So step by step, no tension. Explanatory statement is relating to what? Special business. So if that special business is connected with some other company, and that some other company, our directors, managers, promoters and KMPs are having shareholding interest. How much shareholding interest? At least 2% shareholding if they are having, then this has to be disclosed in the explanatory statement. For example, let's say one of the matters which we are going to discuss in the meeting is about our merger with another company. Now that merger, that item will become a special business. Now for this special business, we'll have to attach an explanatory statement to the notice. Now in that explanatory statement, we will have to mention with that company with which we are proposing the merger, in that company, if our promoters, directors, managers and KMP, if they are having 2% shareholding, then that has to be disclosed in the explanatory statement. Don't misunderstand this. I am not saying that the director, manager, promoter, KMP should not have shareholding in that other company. Like that, I'm not saying. I'm just saying that if they are having shareholding, that too, how much shareholding? 2% or more shareholding if they are having, we just have to disclose. Okay, where? In the explanatory statement. Then, proxies. Now, this particular point, guys, is not really relevant with respect to the questions. Just that this particular point is there in the story. So, I just thought I'll remind you of the provision. Proxies. So who exactly are proxies? You know very well. If there's a member of the company who has the right to attend and vote at the meeting, but if he's unable to attend the meeting, then he can appoint a proxy. That proxy will attend the meeting and will vote on his behalf at the meeting. Okay. Now, can the same person be appointed as proxy for multiple members? Yes, the same person, like one person, can be a proxy for multiple members, but there is a limit. That person can be a proxy for maximum 50 members, and those members put together should not be holding more than 10% of the voting power. So maximum 50 members and all those members put together should not be holding more than 10% of the voting power. But please keep in mind, all this limit will apply only if the same person is a proxy for multiple members. If a person is a proxy only for one person, then this limit will not apply. Okay? If a person is a proxy for multiple members, then only this limit will apply. Now come on, let's read the story and let's see what exactly is given to us. The question says Z Technologies Limited. It's a public company. Okay. It is having authorized share capital of 10 crores and it has paid up share capital 5 crores divided into 50 lakh equity shares of 10 rupees each. So it's a public company. Paid up share capital is 5 crores, 50 lakh shares of 10 rupees each. Company has total 2,300 equity shareholders, each holding equal voting rights. Story is clear. Public company, paid up share capital 5 crores, 50 lakh shares of 10 rupees each, total 2,300 equity shares. So a total 2,300 equity shareholders. So here itself, if I ask you, what is the applicable quorum? What will you say? It's a public company, guys. Public company quorum will depend upon how many members. Remember, just now we revised that. If the number of members is up to 1,000, then quorum will be 5. But here it is 2,300, which is more than 1,000 within 5,000. So the applicable quorum is going to be 15. So 15, minimum 15 members must be personally present at the meeting within 30 minutes of the appointed time. Okay. Then the question says, at a meeting of the board of directors, so at a board meeting held on 1st June 24, board resolved to convene the AGM of the company on 25th June 24 at 11 a.m. at the registered office of the company. So AGM is going to be held on 25th June at 11 a.m. Pursuant to the board resolution, company sent the notice of the AGM on 3rd June to all the members, directors and auditors through electronic mode. Notice stated the date, time, place of the meeting and business to be transacted. So the company is conducting an AGM on 25th June. For that meeting, notice is sent. Subject line of the email mentioned name of the company, type of the meeting, place and date of meeting. Notice was also placed on the website of the company. So this entire paragraph is about the notice of the meeting. Then agenda of the AGM consisted ordinary business and a special business. The special business is relating to approval of a related party transaction with Alpha Systems Private Limited. Are you understanding? So in this AGM, ordinary business is also going to be discussed. One special business is also going to be discussed. What is a special business? This special business is nothing but approval of a related party transaction with Alpha Systems Private Limited. So don't you think the special business over here is involving another company? So if the special business involves another company, we have to be careful. In that other company, if our director, manager, promoter or KMP is having at least 2% shareholding, we have to disclose. So the other entity over here is Alpha Systems Private Limited. Now be careful. One of the directors of Z Technologies Limited held 1,50,000 equity shares of 10 rupees each in Alpha Systems Private Limited, whose paid up share capital was 5 crore 50 lakh equity shares. Now listen, be careful. Total in Alpha Limited, in this Alpha Systems Limited, there are total 50 lakh equity shares. Now, what is 2% of this 50 lakh equity shares? 2% of 50 lakhs will be 1 lakh shares, guys. The director of Z Limited is holding how many shares in Alpha Limited? He is holding 1,50,000 shares. So can I say director is holding shares which is more than or equal to 2% of the paid up share capital of other company? Right, guys, exactly the situation has come into the picture. So this company, my main company is Z Technologies Limited. So this company is holding an AGM. This company is holding AGM on 25th June 24. In this company's AGM, ordinary business, special business, both are going to be discussed. The special business is relating to some other company. In that some other company, our director is having shareholding in that some other company, and that shareholding is 2% or more of the paid up share capital of that other company. In Alpha Systems Private Limited, our director is holding 1,50,000 shares, which is at least 2% of the shares of that other company. Having this shareholding is not wrong, just that this has to be disclosed in the explanatory statement. Okay. Then the question says, on 25th June 24, AGM was called to order at 11 a.m. By 11:30 a.m., 16 members were personally present. So is quorum present, guys? We already concluded the quorum is 15, and here they are saying within half an hour, within 30 minutes, 16 members came. So quorum is fulfilled. Notice of the AGM contained a statement informing members of their right to appoint proxy. You know this very well. In the notice, it should be mentioned that if the members want, they can appoint a proxy. So 42 members holding 3,80,000 equity shares have appointed the same person as proxy. Tell me, can multiple members appoint the same person as proxy? Yes, but there's a limit. Maximum 50 members, and those members put together should not hold more than 10% of the voting power. Here, 42 members have appointed the same proxy. 42 is within 50, so this is fulfilled. But put together, they should not hold more than 10% of the voting power. See, in Z Limited, there are total how many shares? There are total 50 lakh equity shares. So 50 lakh equity shares into 10% is going to be 5 lakh equity shares. But these 42 members put together are holding only 3,80,000 equity shares, guys, which is within 5 lakhs. So one person is appointed as a proxy over here for 42 members, and those 42 members put together are holding only 3,80,000 equity shares. So if you see, both my conditions are fulfilled over here. The number of members is not more than 50, it's only 42, and total put together they are holding only 3,80,000 equity shares, which is within 10%. 10% we worked out is 5 lakhs, but they are holding only 3,80,000 equity shares, which is within 10%. So even this proxy appointment is going to be perfectly valid over here. Okay, then one shareholder holding 6 lakh equity shares appointed a single person as his proxy who did not act proxy for any other member. I told you clearly that this limit of number of members and all will apply only if the same person is a proxy for multiple persons. But in this situation, one shareholder has appointed a single person as proxy who did not act as proxy for any other member. So if a person is acting as proxy for only one member, then these limits and all dustbin will not apply. Proxy forms were submitted in MGT 11 and deposited at the registered office at 10:30 am on 23rd June. If you remember, we had learned that proxy forms have to be submitted to the company at least 48 hours before the meeting. Okay. Now, based on the above case scenario, answer the following MCQs. Before we come to the MCQs, I'll just give you a quick revision of the entire story over here. The company is Z Technologies Limited. It's a public company. It has 50 lakh equity shares, total 2,300 equity shareholders. Quorum is 15. The company is holding AGM on 25th June at 11 am. Company has issued notice and all. This entire paragraph was about the notice. In this AGM, company is going to discuss ordinary business also, special business also. The special business is relating to some other company. In that some other company, our director, Z Technologies director, is having 1,50,000 equity shares. In Alpha Systems, there are total 50 lakh equity shares. 2% of 50 lakhs is 1 lakh shares. So our director, Z Technologies director, is holding 1,50,000 shares, which is more than 1 lakh shares. So therefore, our director is holding at least 2% of the shares of the other company. So this has to be disclosed in the explanatory statement. Then within 30 minutes, 16 members are present, which means quorum is present. Then 42 members have appointed common person as proxy. It is within 50 members, and those 42 members put together don't hold more than 10% of voting power. So the condition is fulfilled. This proxy appointment is perfect. Then one shareholder has appointed one proxy, and that person is not acting proxy for any other person. So if a proxy is if person is a proxy for only one member, then this limit and all will not apply. So even this appointment is perfectly fine. Then proxy forms have to be submitted at least 48 hours before the meeting. Now come to the questions. The first question. AGM included a special business approving related party transaction with Alpha Systems Private Limited, in which one director of Z Technologies had equity shares. Which statement is correct as to the transaction of special business? So about the special business, about the explanatory statement they're asking us, let's see. Company was not required to provide a separate explanatory statement. This is wrong. Any special business, we have to give an explanatory statement. No disclosure by way of statement under section 102 subsection 2 is required, as director's shareholding is less than the specified percentage. This is wrong. The director's shareholding is at least 2%. It is reaching the limit. So therefore, disclosure is required in the explanatory statement. Third point, disclosure by way of explanatory statement under section 102 subsection 2 is mandatory, as director holds more than the specified percentage of shares needed for such disclosure. Perfectly correct. Option C. The director is holding at least 2%, so therefore disclosure is required. Option D says disclosure is necessary only if interested director voted at the AGM. No. Answer is option C. Whether the director is voting or not, your director is holding at least 2% shares in the other company. So you have to disclose in the explanatory statement. Okay. Then come to the second question. Determine the validity of quorum at 11:30 am on the date of AGM. 16 members out of 2,300 members were personally present. We already decided this, that 16 members were present. 16 members were personally present. Therefore, quorum is met. So, quorum is satisfied since at least 15 members are personally present and it constitutes valid quorum. Option A. Within 30 minutes, quorum is present and quorum is 15, but here 16 members are present, so perfectly fine. Tell me, when you're counting quorum, will you count proxies also? We don't count proxies in quorum. Members itself, 16 are personally present, quorum is available over here. Okay, that's it. This was your question number 9. Now come on, let's come to question number 10. From your dividends discussion, let me give you some reminders over here and then we will read the question. For reminder number 1. Time limits with respect to dividend. The first time limit, once a company declares a dividend, the dividend has to be paid or the dividend warrant has to be posted within how many days? Within 30 days, right? Once a company declares dividend, within the next 30 days, the company should either pay the dividend or post the dividend warrant. After posting the dividend warrant, when did the shareholder receive the warrant? I don't care. Point number 1. Then comes point number 2. Let's say 30 days have expired, but the company is still having some unpaid, unclaimed dividend that has to be transferred to the unpaid dividend account within the next 7 days. Let's take one example to understand this better. Let's say on the 1st Jan 2025, company declared dividend. Now within the next 30 days, that is 1st Jan plus 30 days, by 31st Jan 2025, company must pay the dividend or post a dividend warrant. Even after 31st Jan, if the company is still having some unpaid, unclaimed dividend, then within the next 7 days, that is by 7th February 25, company has to transfer the unpaid dividend into unpaid dividend account. Then later the shareholder can claim the dividend from that unpaid dividend account. He can claim the money. Once the money is transferred into unpaid dividend account, that dividend money can stay in the unpaid dividend account for maximum how many years? For maximum 7 years. Within these 7 years, the shareholder can come and claim his money from the unpaid dividend account. If within 7 years also the money is not claimed, then after 7 years, whatever unpaid dividend we have in this account, whatever interest has accrued in this account, everything will get transferred to IEPF. Okay, so once the company declares dividend, within the next 30 days, company must pay the dividend or post a dividend warrant. Even after these 30 days have expired, if the company still has unpaid or unclaimed dividend, then after 30 days, within the next 7 days, company must transfer this unpaid dividend into unpaid dividend account. Once money is transferred to unpaid dividend account, that money can stay in that account only for 7 years. Even in the 7 years, if the dividend is not claimed, then after the 7 years expire, whatever dividend money is there in that account, whatever interest has accrued in that account will all get transferred to IEPF. Reminder number 1. Reminder number 2, if the dividend remains unpaid or unclaimed for 7 years, such dividend and interest will be transferred to whom? Will be transferred to IEPF, just now I told you. Then comes the third point. If unpaid dividend is not transferred to unpaid dividend account within 7 days, I just told you right, once 30 days are over, if you still have unpaid dividend, you should transfer it to unpaid dividend account within 7 days. Now this period, if you violate, that is unpaid dividend, if you don't transfer into unpaid dividend account within 7 days, then in that case company will have to pay interest. How much interest? 12% per annum interest. Okay, if unpaid dividend is not transferred to unpaid dividend account within 7 days, then 12% interest will come into the picture. Then comes the fourth reminder. See, for 7 consecutive years, if dividend is not claimed by the member, understand the situation correctly. Year 1, member did not claim dividend. Year 2, company declared dividend, member did not claim. Year 3, company declared dividend, member did not claim. Year 4, company declared dividend, member did not claim. Year 5, year 6, year 7. For 7 years, continuously, 7 consecutive years, the member is not claiming dividend. Now, in this case, the shares to which this dividend belongs, those shares itself will be transferred to IEPF. Okay, so there are two totally different criteria. When is dividend transferred to IEPF? Once a company puts the unpaid dividend money into unpaid dividend account, now that money will stay in the account for 7 years. For 7 years, if the member is not claiming that money, then that money will go from unpaid dividend account to IEPF. Okay, that is the unpaid dividend account concept. But the shares concept is slightly different. Here, 7 consecutive years, none of the years he has claimed dividend, then those shares itself will get transferred to IEPF. Now, once your dividend is transferred to IEPF, once the shares are transferred to IEPF, can the shareholder have some remedy? After 7 years, the shareholder is waking up and now he is coming to claim his dividend, or now he is coming to claim his shares. Does he have some remedy? Yes. At the end of the day, it is his money. At the end of the day, it is his shares. So he does have remedy. The shareholder can reclaim the language. Be careful about the language. The shareholder can reclaim the unpaid dividend and the shares, both he can reclaim from IEPF. Once dividend is transferred to IEPF, once shares are transferred to IEPF, from IEPF he can reclaim the dividend, he can reclaim the shares, just that he has to follow the applicable rules and he has to submit the prescribed documents, but he can reclaim. Now come on, let's read the question. Apex Infra Limited is a listed public company. Company declared final dividend 12% on equity shares, 10 rupees face value at AGM on 30th September 2017. This is the date of declaration of dividend. The dividend announced, the company announced record date as 5th October, which means whoever is holding shares of the company on 5th October, that person will get dividend. The dividend warrant was posted to the shareholders on 25th October 2017. Has the company complied with the timeline? We learned that once a company declares the dividend, from this day, within 30 days, the company must make the payment or post a dividend warrant. 30th September plus 30 days will be what? 30th October 2017. So by 30th October 2017, company must make the payment or post the dividend warrant. Company has posted the dividend warrant on 25th October 2017, which is within the 30 days time limit. Then the question says Mr. Arjun, a shareholder of the company, did not encash his dividend warrant. Consequently, the dividend amount remained unpaid. It's okay. If dividend money is remaining unpaid, within the next 7 days, it has to be transferred into unpaid dividend account. So 30th October 2017 plus 7 days will be what? 6th November 2017. So by 6th November, Arjun's unpaid money has to be transferred by the company to unpaid dividend account. Company transferred the unpaid dividend amount relating to Mr. Arjun to the unpaid dividend account on 10th November 2017. Company has delayed. You should have transferred on 6th November. Company is transferring only on 10th November. So there's a delay. So because there's a delay, company will have to pay 12% interest. The company will have to pay, guys. We learned, right? If the company does not transfer the money into unpaid dividend account within 7 days, 12% interest will be levied on the company. Then, no claim was made by Mr. Arjun in respect of the unpaid dividend for several years. Further, the dividend declared by the company in subsequent years from 2018-19 to 23-24 also remained unclaimed by him. So, 17-18 dividend also he did not claim. Then 18-19 to 23-24, this dividend also he did not claim. Total 7 years consecutively, dividend he has not claimed. Consequently, the company transferred the unpaid dividend amount and the shares to IEPF. Company has done perfectly right. Company waited for 7 years. He did not claim the unpaid dividend money. So after 7 years, company transferred the unpaid dividend money to IEPF. Also for 7 years, none of the 7 years he came and claimed the dividend. So even the shares company transferred to IEPF. Mr. Arjun was of the opinion that company cannot transfer the shares held by him to IEPF. Wrong. Arjun, you're wrong. You did not come for 7 years. See, for 7 consecutive years, if you do not claim dividend, then company has the right to transfer your shares to IEPF. 17-18 dividend also you did not claim. 18-19 to 23-24, each year company declared dividend, you did not claim. 7 years consecutively, you did not claim dividend. So company is perfectly right in transferring your shares to IEPF. Explain with reference to the provisions of Companies Act, validity of the action taken by the company and remedy, if any, available to Mr. Arjun. So 2 things they are asking us. Number 1, validity of the company's action. Number 2, what remedy does Arjun have? Has the company done everything perfectly, guys? See, the company has posted the dividend warrant within 30 days. But one thing company did not do correctly, the company did not transfer money into unpaid dividend account within 7 days. Remember? We saw that there was a delay. So company just have to pay 12% interest. So I'm assuming over here that company has paid this 12% interest properly. If the company has done that, then the company has not done any violation over here. Company perfectly waited for 7 years. After that only company has transferred the shares and dividend to IEPF. So is the company's action valid? Yes, company's actions are perfectly valid, but they will be valid only if this assumption is fulfilled that company has paid 12% interest for the delay in transferring money to unpaid dividend account. Then what remedy will Mr. Arjun have? Mr. Arjun does have a remedy. He can reclaim his shares and his dividend. Both he can reclaim from IEPF. He just has to follow the prescribed rules and he has to submit the required documents. Then he can reclaim his shares and dividend from IEPF. Okay, this was your question number 10. Good question from dividend. The time limits got revised. Transfer to IEPF got revised, and what remedy the shareholder has, even that you've gotten clarity. Now come on, let's move on to question number 11 from our Accounts of Companies chapter. So before we read the question, let me give you a quick reminder of the concepts involved in the question, guys. Now this entire question is about section 131, which talks about voluntary revision of financial statements. We are not talking about reopening of books. We are not talking about section 130. No, I'm talking about section 131, which is about voluntary revision of financial statements and board report. Here the company is voluntarily revising. So what is a company revising? Company can revise financial statements or company can revise board report. Now, why is the company revising? See, about financial statements, we have all the provisions in section 129. About the board report, we have all the provisions in section 134. So if section 129 or if section 134 are not complied with, which means if the company has not complied with some provision relating to financial statement or board report, then the company can voluntarily decide to revise the financial statements and board report as the case may be. Now, last how many years financial statements and board report you can revise like that? 3 preceding financial years, guys. Like for example, right now, if I am in financial year 25-26, okay, I'll see 3 preceding financial years, which means financial year 24-25, financial year 23-24, financial year 22-23. Any of these 3 years financials or board report I can revise right now in my current financial year. So we can revise the financials or board report of the 3 preceding financial years, 3 years preceding the current financial year. Okay. Now, if you want to do this voluntary revision, of course, board resolution has to be passed. They are internal regulations. But in addition to that, we also require the NCLT's approval. Alright. So we have to submit an application to the NCLT. Now, in that NCLT application, we have to mention all this. We have to mention number 1, which year, which financial year's financials do we want to revise. Then name and contact details of the MD, CFO, directors, CS, officer of the company who was responsible for making the books of accounts, the auditor of the company. So all their details have to be given. Then board resolution passed by board of directors, a copy of that resolution has to be given. Then grounds for seeking revision, that why do we want to revise the financials and board report? The reason we have to inform the NCLT. And in case the directors and auditors, in case a majority of the directors or the auditors have been changed before the revision, then even this has to be disclosed in the application. So 5 simple points have given you a reminder. Point number 1, can we revise the financial statements and board report voluntarily? Yes, the company can voluntarily decide that we will revise the financials and board report. We can revise for 3 preceding financial years, basically 3 years preceding the current financial year. Now, to do this revision, we have to pass a board resolution. We also require NCLT approval. Then we will do this revision only if section 129 or section 134 are not complied with, then only we do this revision. Now, when we submit an application to NCLT for approval, along with the application, all this information we have to inform the NCLT. We have to tell the NCLT for which year we want to revise. Then name and contact details of MD, CFO, directors, CS and all. Then what's the reason? Why do we want to revise? Then to do this voluntary revision, we also require a board resolution. So a copy of the board resolution has to be given to the NCLT. And lastly, if majority of directors or auditors changed just before this revision could be done, if there's a major change in the directors or auditor, then even that has to be informed to the NCLT. Okay, keep this in your mind and now come to the question. The question says, Tarun Synthetics Limited in its financial statements for the year ended 31st March 24. So we're talking about financial year 23-24. So for this year's financials, the company failed to disclose contingent liability pertaining to a suit filed against a company amounting to 2.5 crore for the breach of a contract. So this company, in the financials of 23-24, they did not disclose a contingent liability. In April 25, the competent court decided the matter against the company. As a result, the company was required to pay this amount to the decree holder. Company decided to prefer an appeal against the order. Getting it? So earlier it was a contingent liability. Company did not put about it in its financials. That contingent liability became actual liability of the company because court passed an order asking the company to pay that amount to the decree holder, but company is going to file an appeal. The company felt that the non-disclosure of the contingent liability affected the true and fair view of its state of affairs. Are you understanding? This is the game-changing sentence in the question. The question is saying that because the company did not disclose the contingent liability, the financial statements are not reflecting the true and fair view of the state of affairs of the company. This is going to become a violation of section 129, guys. Section 129 is a section which talks about the provisions regarding financial statements. In section 129, 129, one of the provisions is that the financial statements of the company should reflect true and fair view of the state of affairs of the company. Now, the question says over here that the company feels that because it did not disclose the contingent liability, the true and fair view of state of affairs is not being disclosed in the financials. So, therefore, clearly there's a violation of section 129. So, because of section 129 violation, company voluntarily decided to revise the financial statements and the board report. So, company wants to revise both. Company wants to revise financial statements and board report for the year ended 31st March 24. So, for previous year 23-24, they want to revise the financials and board report, and this company held a board meeting on 15th May 25 to this effect, which means my current financial year is 25-26, guys. Now, in 25-26, I can revise last 3 years financials. 23-24 will come in the last 3 years, so even this is fine. In light of the above facts, answer the following referring to the provisions of Companies Act. Whether the company can voluntarily revise the financial statements and board report. Yes, guys, the company can revise. It is within the last 3 years. Like right now, we are in financial year 25-26 in the question. We want to revise 23-24's financials. We can revise last 3 years financials, which means financial year 24-25, 23-24, 22-23. Any of these 3 years financials we can revise. Company wants to revise 23-24's financials. It is within the preceding 3 years. So yes, company can revise. And one more thing is, generally we do this revision only if section 129 or 134 are not complied with. And clearly over here, 129 is not complied with because the financials are not reflecting the true and fair view. So can the company voluntarily revise over here? Yes, of course they can. Only thing is they have to pass board resolution. They have to make application to NCLT and they should get NCLT's approval. Okay. Then they're asking, state the particulars or details to be stated in the application for making the voluntary revision. Basically, they're asking us the list of the contents in the application. This list we'll have to write in our answer. That's all. Simple question. You got the whole case right. Company had not disclosed contingent liability in its financials. Because of that, the financials are not reflecting true and fair view. So section 129 is violated. So because section 129 is violated, yes, company can revise the financials of 3 preceding financial years, and company requires NCLT's approval. So to get NCLT's approval, company will be submitting one application to NCLT. In that application, all this has to be mentioned. Okay, that's all, guys. Simple. This was question number 11. More or less, it was a theoretical question. They're basically testing our memory, that do we remember these points or not. This is the main part of this question. Okay. Now come to question number 12. Question number 12 is about CSR. Before I start the question, let me give you the reminders. Just 4 to 5 points, guys, but important points. Point number 1, CSR is applicable to which company? It is applicable to every company which has net worth at least 500 crores or turnover at least 1000 crores or net profit at least 5 crores in the preceding financial year. So preceding financial year, any one criteria should be fulfilled. Then for that company, CSR will be applicable. Then my next point is composition of CSR committee. The composition of CSR committee will depend upon, does the company have independent directors or no independent directors. Now if the company has independent directors, then in the CSR committee, we need minimum 3 directors, out of which minimum 1 will be independent director. But if the company does not have independent directors, then in that case we need minimum 2 directors in the CSR committee. Okay. Then minimum how much amount has to be spent on CSR? Very simple question. Minimum we have to spend 2% of the average net profit of 3 preceding financial years. So if my current year is 25-26, 3 preceding financial years average net profit I will find 2% of that. That's a minimum amount which we have to spend on CSR. Then what if the company spends less than the 2% number? If the company spends less than 2%, we will ask the company why. Is it because of an ongoing project or is it not because of an ongoing project? Now, if the company spent less than 2% because of an ongoing project, then in that case, whatever is the unspent amount, the company will transfer it into unspent CSR account, guys. So all those provisions will apply. But however, my discussion right now is, what if the company spends less than 2%, but it is not because of an ongoing project, not connected to an ongoing project? Then in that case, whatever is the unspent CSR amount, the company has to transfer that to some Schedule 7 fund. So number 1, company will disclose the reason in the board report that why why did the company spend less than 2% number? Then whatever is a shortfall, whatever is the unspent amount, that unspent amount has to be transferred to some Schedule 7 fund. Now this amount should be transferred within how much time? Within 6 months from the end of the financial year. Okay, so 4 points. Point number 1, CSR is applicable to every company with net worth at least 500 crores or turnover at least 1000 crores or net profit at least 5 crores in the preceding financial year. Then point number 2, CSR committee composition. If the company has independent directors, then at least 3 directors, one of which should be independent director. But if the company does not have independent directors, then minimum 2 directors. Then minimum how much amount has to be spent on CSR? Minimum 2% of the average net profit of 3 preceding financial years. And lastly, what if the company spends less than the minimum requirement? Then in that case, you will first check the reason. Is it because of an ongoing project or is it not because of an ongoing project? If it is because of ongoing project, then the unspent amount has to be transferred into unspent CSR account. Different set of provisions. But if it is not connected to ongoing project, then first disclose the reason that why the company spent less than 2%. First disclose the reason in the board report. Then the shortfall amount, the unspent amount, has to be transferred into Schedule 7 fund within 6 months from the end of the financial year. Okay, that's it guys. Keep this in your mind. It's a case-based MCQ. Let's read the story now. The question says Arohan Industries Limited is a public limited company manufacturing electrical equipment. It's a public company with over 15 years of continuous operations and steady growth driven by strong market presence and efficient management. During the financial year 24-25, company recorded turnover of 1,150 crore, reflecting robust operational performance. Company is mandatorily required to appoint independent directors as per Rule 4, Company Appointment of Directors Rules. Net profit of the company as computed in accordance with Section 198 is 12 crore rupees. Company's net worth is 620 crore rupees. Understood following? So company is a public limited company. For this company, independent directors are mandatory. They have given for 24-25, they have given the turnover, the net profit and the net worth. Okay. Then net profit of the company for immediately preceding 3 financial years were 21-22 8 crores, for 22-23 10 crores and 23-24 12 crores. So 3 preceding financial years they have given us the net profit number. Then the question says, in view of the above financial parameters, Arohan Industries Limited satisfied the criteria prescribed under Section 135 of the Companies Act 2013 relating to CSR. Accordingly, company constituted a CSR committee consisting of 3 directors, including 1 independent director. Tell me this. Is the CSR committee's composition correct over here? For this company, independent directors are mandatory. So which means in the CSR committee, we must have at least 3 directors, one of which should be independent director. And they've done exactly that, guys. The question says that in the CSR committee, there are 3 directors, including 1 independent director. So the CSR committee is made perfectly over here. Then the question says, consequently, the company was under an obligation to spend the prescribed percentage of net profits towards CSR activities during financial year 24-25. So my current year in this question is 24-25. Okay, so in the current year 24-25, company is going to be spending the prescribed amount of net profit towards CSR. Now, by the way, why CSR? See, CSR will be applicable for the company only if the company is meeting any of these criteria. So my current year is 24-25. So have they given my preceding? I'll have to check all these numbers for the preceding financial year. Preceding financial year will be financial year 23-24. So if you notice, they have given turnover, they have given a net profit and net worth and all, but all this information is for 24-25. I don't need 24-25's information, I need preceding financial year's information, which means 23-24's information. Now 23-24 net worth they have not given, turnover they have not given, but 23-24 net profit they have given. Net profit is 12 crore. So 23-24 preceding financial year net profit is at least 5 crore. Hence CSR is applicable for the company. Till here clear, right? So my company is a public company. Current year is 24-25. For this company, independent directors are mandatory. So therefore, in this company's CSR committee, we have minimum 3 directors, out of which one of them is independent directors. Current year is 24-25. Preceding financial year, that is 23-24, net profit is at least 5 crore. Net profit is 12 crores. Therefore, CSR is applicable for the company. Then the question says, based on the recommendations of the CSR committee, the board approved CSR budget of 20 lakhs. Let's check that. How much minimum are we supposed to spend on CSR? 2% of the average net profit of 3 preceding financial years. My current financial year is 24-25. So 3 preceding financial years net profit I want. 3 preceding financial years will be 23-24, 22-23 and 21-22. See, they've given us a net profit numbers. For 21-22, it was 8 crores. For 22-23, it was 10 crores. And for 23-24, it was 12 crores. So I need to find the average net profit of the 3 preceding financial years, 2% of that. So the minimum amount which the company has to spend on CSR is 2% of the average of these 3 numbers. So average will be simple average, 12 plus 10 plus 8 divided by 3. How much will this work out to? 12 plus 10 plus 8 divided by 3 into 2%. And these amounts are in crores. So 20 lakh rupees is the minimum amount which the company has to spend on CSR. And even they have given us the same number only, 20 lakh rupees. Okay. Then, however, due to delay in implementation of the identified projects, company could spend only 14 lakhs on CSR activities. So company is supposed to spend 20 lakhs, but the company is spending 14 lakhs only. So definitely company is spending lesser than the minimum requirement. The remaining unspent amount did not relate to ongoing project. It is not related to ongoing project. So because it is not related to ongoing project, the shortfall amount of 6 lakh rupees has to be transferred by the company to some Schedule 7 fund when within 6 months from the end of the financial year. Company disclosed the reason for not spending the entire amount in the board report. Good. If the company spends less than 2%, we have to put the reason in the board report. One of the directors was of the view that the unspent funds are needed to be transferred to a special bank account maintained with scheduled bank. No, this is not required. See, the unspent money we transfer to unspent CSR account only if it is relating to an ongoing project. Here it is not relating to an ongoing project. So therefore no requirement of unspent CSR account and all. Whatever is a shortfall amount, we will straight away transfer it to Schedule 7 fund. So instead of unspent CSR account, we will transfer to Schedule 7 fund. So what the board is saying, what the director is saying over here, that a separate account has to be created, a separate bank account has to be created. All that is not required over here. Okay, let's see what are they asking us now. Based on the above case scenario, answer the following MCQs. Number 1. CSR provisions were made applicable to Arohan Industries Limited for financial year 24-25. Because of which reason? Remember guys, my current year is 24-25. Whether CSR is applicable or not, I will have to look at the preceding financial year, which is 23-24. Now for 23-24 net worth number they did not give us, turnover number they did not give us. Whatever net worth and turnover they had given us over here was relating to 24-25 current year. That number was irrelevant for us. So 23-24, only one number we had, net profit number, which is at least 5 crore. Remember, it was 12 crores. So the reason why CSR is applicable in this case is because the preceding financial year net profit exceeded 5 crore. That's the reason. So option A, turnover and net worth, that's not the reason. Average net profit, that's not the reason. It satisfied at least one prescribed financial criterion in the immediately preceding financial year. Yes, there are 3 criteria. We have the word or in between, which means out of these 3, any one criteria has to be fulfilled. So the company satisfied at least one prescribed criteria in the preceding financial year. So because of that reason, for this company, CSR is applicable. Option C. Then comes the second question. In case Arohan Industries Limited was a company covered under 135 subsection 1 but is not required to appoint independent director. If independent director is not required, then in the CSR committee we will have just minimum 2 directors. That's all guys. So come on, let's see which option is correct. Company must mandatorily appoint independent director. No, if independent director is not required for the company, then we can't force the company to appoint independent director. CSR committee can be constituted by 2 or more directors without an independent director. Correct. If for the company independent director is not mandatory, then in the CSR committee we will have minimum 2 directors. That is no independent director. Then comes the third question. As Arohan Industries Limited could not spend the entire amount on CSR, considering the 4 options given below, choose the correct option applicable to the company regarding the unspent CSR funds. Minimum company is supposed to spend 20 lakhs. Company spent only 14 lakhs. So 6 lakhs unspent amount is there. Now this amount has to be transferred to Schedule 7 fund within 6 months from the end of the financial year. It is not relating to an ongoing project, so no concept of unspent CSR account. Straight away we will transfer into Schedule 7 fund, end of story. See which option now. Specify reason for not spending the amount in the board report, yes. Company must immediately open a special bank account, no. No bank account and all required to be opened. We just have to transfer to Schedule 7 fund, that's all. Then option B says, disclose in the board report specifying reason for not spending the amount. Yes, we have to disclose. But is the disclosure alone enough? No. After disclosing, you also have to transfer to Schedule 7 fund. So option B also is incorrect. Option C says, company must, in addition to disclosure specifying the reason for not spending the amount in the board report, should transfer the unspent amount to a fund specified in Schedule 7 within 6 months from the end of the financial year. Yes, guys, you should not only disclose the reason in the board report, you also have to transfer to Schedule 7 fund. So option C. Okay, good question, guys. This was. So number one, the first good morning moment for you over here was that whether CSR is applicable for you or not, you have 3 criteria. Out of the 3 criteria, any one criteria has to be fulfilled. But all the 3 criteria are relating to preceding financial year, not current year. Second good morning moment for you. Yes, in this question, the company spent less than what was required. But if it was not relating to ongoing project, only if it relates to ongoing project, then only we put the money into unspent CSR account. Here it was not relating to ongoing project, so we will simply transfer the unspent amount to Schedule 7 fund within 6 months from the end of the financial year. Okay, and the CSR committee point was simple only. Now come to the next question. We're going to the audit and auditors discussion. Here I have a very interesting question for you. Before I start this question, let me give you a quick reminder. See, this entire question is relating to selection and appointment of auditor. See, the auditor is appointed by the members in the general meeting. But however, it is not so simple also. So what happens is, we have something called as the competent authority. The competent authority selects the auditor and they recommend that auditor to the members in the general meeting. And if the members are okay with that auditor, the members will pass an ordinary resolution in the general meeting and they will appoint the auditor. So no doubt, at the end of the day, who appoints the auditor? The members, but not directly. The competent authority will first select the person and they will recommend the auditor to the members. And if the members are okay with the recommendation, then the members will pass an ordinary resolution and appoint that auditor. Okay. So now this entire discussion right now is about competent authority. So first of all, who is this competent authority? It fully depends upon, in the company, is there an audit committee or not? So if the company has an audit committee, then the audit committee itself will become the competent authority. But if in the company audit committee is not required, then in that case, the board of directors will become the competent authority. This itself shows you that audit committee is not mandatory in every company. So if the company has an audit committee, then audit committee will become the competent authority. But however, it is not so simple also. So what happens is, we have something called as the competent authority. The competent authority selects the auditor and they recommend that auditor to the members in the general meeting. And if the members are okay with that auditor, the members will pass an ordinary resolution in the general meeting and they will appoint the auditor. So no doubt, at the end of the day, who appoints the auditor? The members, but not directly. The competent authority will first select the person and they will recommend the auditor to the members. And if the members are okay with the recommendation, then the members will pass an ordinary resolution and appoint that auditor. Okay. So now this entire discussion right now is about competent authority. So first of all, who is this competent authority? It fully depends upon, in the company, is there an audit committee or not? So if the company has an audit committee, then the audit committee itself will become the competent authority. But if in the company audit committee is not required, then in that case, the board of directors will become the competent authority. This itself shows you that audit committee is not mandatory in every company. So if the company has an audit committee, then the audit committee will become the competent authority. But if the company does not have an audit committee, then the board will become the competent authority. Simple. Now listen, when the competent authority is selecting the auditor, I just told you, right, that the authority will select the auditor and they will recommend it to the members. So when they're selecting the auditor, they will keep in mind 3 things. Number 1, they will keep in mind the qualification and experience of the individual or the firm, as a case may be. Number 2, they will check whether that qualification and experience whether it is commensurate with the size and requirements of the company. All of these are keywords, guys. You can't change them in the examination. So number one, the competent authority will check the qualifications and experience of the auditor. Number two, whether the qualifications and experience are commensurate with the size and requirements of the company. Like for example, let's say there's a person who just qualified, a freshly qualified chartered accountant. Now he has a qualification, but he doesn't have practical experience enough to audit a company like Reliance, let's say. So the competent authority will check whether your qualifications and experience is adequate for the size and requirements of the company. That's the second point. Third point, orders or pending proceedings with respect to professional misconduct before ICAI or any competent authority. So on the basis of these 3 points, the competent authority will select the auditor and will recommend that auditor to the members. Okay. So point number 1, who is the competent authority? Depends. If the company has audit committee, the audit committee, otherwise board of directors. Now when the competent authority is selecting the auditor, they will consider 3 points. Number 1, qualifications and experience of the auditor. Number 2, whether the qualifications and experience is commensurate with the size and requirements of the company. Number 3, what are the orders and pending proceedings against this auditor? Okay. Now listen, this is where the interesting point is. The process for recommending the auditor to the members. I just told you the competent authority will recommend the auditor to the members. Now see, if the competent authority happens to be board of directors, life is simple. The board of directors, on the basis of these 3 criteria, they will select the auditor, and whoever they are selecting, they will directly recommend it to the members, and that's all. If the members are okay with the recommendation, the members will pass an ordinary resolution and that person will be appointed as auditor of the company. But the whole drama comes into the picture if the competent authority is the audit committee. The problem is, if the competent authority is audit committee, the audit committee cannot directly go to the members. The audit committee, on the basis of these 3 criteria, they will select one auditor. Then they will send that recommendation to the board of directors. They can't directly send to the members. So the auditor whom they have selected, the audit committee will send that recommendation to the board of directors. Now if the board of directors is okay with that recommendation, the board of directors will pass on that recommendation to the members, and the members will pass an ordinary resolution in the meeting and they will appoint that person as auditor. Okay. The problem arises, what if the board of directors disagree with the audit committee's recommendation? Like audit committee has recommended Mr. Green to be auditor of the company, but board of directors is not okay with Mr. Green. So if the board of directors disagree with the audit committee's recommendation, then the board of directors will R. 3 keywords. The first are, the board of directors will refer back the matter to the audit committee. Second are, they will request for reconsideration, that is, they will ask the audit committee to reconsider and give some other name, to recommend some other person. And the third are, they will also give reasons that why are they not okay with the recommendation. Okay, so if audit committee has sent a recommendation to the board, and if the board is not okay with the recommendation, the board will refer back the matter back to the audit committee, request reconsideration, and will also give reasons that why are they disagreeing. Now if the audit committee agrees to send another recommendation, great. But if the audit committee refuses to reconsider, that is, audit committee is saying that our recommendation is final, we are not going to give you another name, we already gave you the name of Mr. Green, we will continue with that person only, we will not give you some other name. So if the audit committee refuses to reconsider, then in that case, the board of directors will simply, number 1, they will record reasons that why are they not okay with the recommendation of the audit committee. They will record reasons. And number 2, they will send their own recommendation to the members. Okay guys, so I'll give you one super quick revision of this once again. You will listen to me. So if the competent authority is board of directors, here life is simple. On the basis of these 3 criteria, the board will select an auditor and they will recommend that auditor to the members. If the members are okay with the recommendation, members will pass an ordinary resolution and that auditor will get appointed as the auditor of the company. But however, if the competent authority is audit committee, the audit committee cannot directly recommend to the members, no. The audit committee will first send recommendation to the board of directors. If board of directors is okay with the recommendation, the board of directors will pass on the recommendation to the members. But however, if the board disagrees with the recommendation, then the board will RRR. The board will refer back the matter to the audit committee, request reconsideration, and will also give reasons that why are they not okay with the recommendation. Okay. Now, if the audit committee refuses to reconsider, that is, if the audit committee says that whomever they have already recommended, that is final. If they refuse to reconsider, then very simple, the board will simply record reasons that why are they not okay with the audit committee's recommendation, and then they will send their own recommendation to the members. Okay, that's it guys. Now have a look at the question. The question says Kanchan Finance Limited is a listed company. Since the term of the present statutory auditor is to hold office up to the conclusion of the upcoming AGM to be held on 25th August 26, name of new statutory auditor CA Trilok was placed before the audit committee. Audit committee recommended the name of CA Trilok for consideration of board of directors. So this company is a listed company. The present statutory auditor, he is going to retire on 25th August 26. So we need a new auditor now. So the audit committee has recommended Mr. Trilok to be appointed as auditor. However, the board was not convinced with the recommendation, which means the board is disagreeing with the recommendation, guys. So it referred back the proposal to the audit committee for reconsideration. But members of the audit committee were not convinced with the reasons cited by the board, and they resent the proposal of CA Trilok to the board again. Understood? The board of directors were not okay with the recommendation. They requested the audit committee to reconsider, but audit committee refused to reconsider. They sent back same Mr. Trilok's recommendation only. Board was in disagreement with the opinion of the audit committee. In light of the above facts, answer the following referring to the relevant provisions. Who are the competent authorities that shall recommend the name for appointment? Competent authority we already learned. If the company has audit committee, then audit committee, otherwise board of directors. So this you know. Briefly discuss points the competent authority shall take into consideration before appointing a CA as auditor. So before appointing a chartered accountant as auditor, these are the 3 points that they will consider. This also you will be able to write. Then how will the auditor be appointed in the present situation where the board disagrees? Board is disagreeing with the recommendation. Audit committee is refusing to reconsider. So this is going to be your answer. The board will simply record reasons for disagreement, and then the board will send their own recommendation to the members. Okay. So 3 things they asked us. Number 1, they asked us that who is competent authority? Audit committee or board of directors. Then they asked us what points the competent authority will consider before selecting the auditor. Those 3 points. First point, qualifications and experience of the auditor. Number 2, whether the qualifications and experience are commensurate with the size and requirements of the company. And number 3, orders and pending proceedings. Then the third question, the final question, they're asking us, how will the auditor be appointed in the present situation where the board disagrees? The board is disagreeing and the audit committee is refusing to reconsider. So therefore the board will record reasons for disagreement, and then they will send their own recommendation to the members. Okay, this was your question number 13. Now come on, we have one small question from companies incorporated outside India. Question number 14. Let me give you some reminders first, then we will take up the question. The first reminder is relating to section 381. Section 381 is a section that talks about accounts of foreign companies. Now number 1, this section says that the financial statements of the foreign companies have to be filed with ROC, New Delhi. When should the financials be filed? Within 6 months from the end of financial year. And to the financial statements, you have to attach some statements. Number 1, you have to attach the statement of related party transactions. Number 2, you will have to attach statement of repatriation of profits. And number 3, we will have to attach statement of transfer of funds. So 3 points I've covered over here from section 381. Section 381 says every year the foreign company will have to file with ROC New Delhi its financial statements within 6 months from the end of the financial year, and to those financials we'll have to attach statement of related party transactions, statement of repatriation of profits, and statement of transfer of funds. Point number 1. Second reminder, see, in case the company does not comply with any provision of Chapter 22. Chapter 22 is this entire chapter which deals with companies incorporated outside India. So any provision over here, if it is not complied with, then that company's contracts will still stay valid. But however, that company which has violated the provisions of this chapter, that company will suffer some consequences. That company will not be able to sue. That company will not be able to claim set off. Also, that company will not be able to make counter claims. So 3 points. In case, this is section 393 by the way. Section 393 says if the company violates any provision of chapter 22, then in that case whatever contracts that company has entered into, that will stay valid. But however, the company will not be able to sue, they will not be able to make counter claims, they will not be able to claim set off. So there will be some consequences. Okay, now have a look at the question. Global Trade LLC is a company incorporated in UK. So it's a company incorporated outside India. It has a branch office in India. So it becomes a foreign company, guys. It's incorporated outside India. It has a place of business in India. And I'll assume it is doing business activities over here. So it becomes a foreign company. This company prepares global financial statements as per UK law, follows financial year ending on 31st December. For the financial year 24-25, Global Trade LLC prepared financial statements relating to its Indian business operations, got the same audited by a practicing CA. Perfect. Till here, nothing problematic. However, company filed the financials with the ROC after 10 months from the close of financial year. Gone. There's a problem right here. Company, you're supposed to file with the ROC within 6 months from the end of the financial year. Company has filed after 10 months after the end of the financial year. Definitely there's a violation over here. Company failed to attach other documents of the statements usually attached under the pretext that there were no transactions of that nature. Company did not attach these statements, and the reason the company is giving is because I did not have these transactions. Doesn't matter. Even if you don't have these transactions, you still have to attach these statements. You attach nil statements, no problem, but you still have to attach. It is mandatory. So there's one more violation over here. So first violation, company did not file within 6 months from the end of the financial year. Second violation, these attachments the company did not attach to the financials. Then the question says company further claims that such delay and non-attachment will not affect the validity of contracts. Yes, this is correct. The contracts will not get impacted. The contracts will still stay valid. No doubt the company has done some non-compliance over here. No doubt company has not followed chapter 22 provisions over here, but contracts will not get impacted. However, these consequences will still be there. So examine with reference to the Companies Act whether the claim of Global Trade LLC on non-attachment of documents, is it valid? No, it is invalid. The company is saying we will not attach these documents because these transactions are not there. It doesn't matter. Even if these transactions are not there, you should still attach. You can attach nil statements, but you have to still attach. So non-attachments of document will be invalid. Then whether the claim of company is correct, that it will not be affected in any way, nor it shall affect the contracts entered into by it. See, if the company violates chapter 22, contracts will not get impacted. Contracts will still be valid. To that extent, company is correct. But if company is saying it shall not be affected in any way, that is wrong. There will be some consequence on the company. Company will not be able to sue. Company will not be able to make counter claims. Company will not be able to claim set off. So other consequences will still be there, but of course contracts will still be valid. So two things they asked us. First thing was whether the company's claim that because these transactions are not there, hence these statements are not required, whether this claim is correct or not? No. These are mandatory attachments, still they have to be attached. Second question they asked us, company is saying it will not be impacted in any way. That is wrong. Okay, contracts will not get impacted, but these three consequences will still be there on the company. Okay, this was your question number 14. Now come on guys, I have some very good 5 questions for you relating to LLP Act. Okay, some of these questions will be descriptive and some of these questions will be case-based MCQs, but we have 5 solid questions. Let's do them one by one. The first question over here, before we start the question, let me give you 2 reminders. Reminder number 1 is about LLP's liability. There are 2 points over here. Point number 1, LLP will not be liable if 2 conditions are fulfilled. Condition number 1, partner does some act without authority, okay? And the other party, that is the third party, knows that the partner did not have authority. So if both your conditions are fulfilled, LLP will not be liable. What are the two conditions? Partner has done something without authority, and the other party, third party, knows that partner has no authority. If both the conditions are fulfilled, then LLP will not be liable. Okay. But however, if the other party was not aware, then the LLP will become liable. Point number one, reminder number one. Reminder number two, when a person ceases to be a partner, that is, when a person retires from the LLP, when a partner leaves the LLP, then his retirement, his cessation will be effective only after LLP has informed ROC about it, or if the third party knows that he has retired. So, two reminders. Reminder number one, LLP will not be liable if the partner has done something without authority, and also the other party knows that the partner has done it without authority. If both the conditions are fulfilled, then LLP will not be liable. But however, if the other party was not aware that partner has no authority, if the third party did not know, then LLP will become liable. Second reminder over here, when a person leaves the LLP, his retirement, his cessation will be effective only after either LLP should inform ROC about it, or the third party should know about it. Only then the cessation will become effective. Okay. Now come to the question. V, S and N incorporated an LLP on 1st April 25. LLP agreement was executed but never filed with the registrar. Agreement contained the following clauses. Their profit sharing ratio is given. Only V and S were authorized to enter into the contracts on behalf of LLP. So there are three partners. Only V and S can enter into contracts, which means N does not have any authority to enter into contracts on behalf of LLP. He does not have authority. Only V and S can enter into contracts on behalf of LLP. Any act beyond consultancy services required unanimous consent of partners. The following events took place subsequently. N, without informing V and S, entered into a loan agreement with Quick Bank in the name of LLP for expansion into real estate advisory, which was not part of LLP's usual business. Do you agree N has done something without authority, guys? Because the question clearly says only V and S have the authority to enter into contracts. N does not have the authority to enter into contracts. Still, N has entered into this loan agreement. So clearly over here, N has done something without authority. Then the question says Quick Bank was unaware of the internal restrictions, which means Quick Bank, your third party, the other person, the third party is not aware of the fact that N does not have authority. What did we learn over here? We learned if the partner has done something without authority and the third party knows about it, only then LLP is not liable. But here if you see, the partner has done something without authority, but does the third party know about it? Does Quick Bank know about it? No, they don't know about it. So therefore, will this situation apply? Can I say LLP is not liable? No, I can't say the LLP will be liable. Of course, LLP can later claim damages from N, but however, for now, LLP will be liable. Okay, only if the partner does the act without authority and also third party knows about it, only then LLP will not be liable. But here third party does not know about it, so this condition is not fulfilled, therefore LLP will be liable. Point number one. Point number two, S. One of the partners, guys, S, he retired from LLP on 30th September 25. After his retirement, on 5th October 25, as usual, T Limited entered into a consultancy contract with LLP, believing S to still be a partner, as company had no notice of his cessation. Understood? One of the partners, S, he retired, he left the LLP. But we learned his cessation will be effective only if any of these two happens. Either ROC has to be informed about it, or the third party should know about it. Question doesn't say LLP has informed ROC, so we have not informed ROC. Also, does the third party know about it? Question clearly says over here, T Limited still believes S to be a partner. So T Limited does not know that S has left the LLP. So none of the two situations are fulfilled over here. So therefore, it will be as if S is still a partner. We will treat it as if he is still a partner in the LLP. Okay. Then due to continuous losses, LLP was unable to pay the creditors and Quick Bank initiated proceedings against all partners. Let's look at the questions now. Two questions. Question number one. Whether VSN Consulting LLP is bound by the loan agreement entered into by N with Quick Bank. We already discussed about this. Yes, no doubt, N has done something without authority. When a partner does something without authority, LLP will not be liable only if the other party knows about it. But here, Quick Bank does not know about it. So I cannot say that LLP is not liable. So my final conclusion is that LLP will be liable for this act. Question number 1. Question number 2. Whether S can be liable for obligations arising from the contract with T Limited after his retirement. See, no doubt S retired. After that only the contract was made with T Limited. But I just told you, when you retire from LLP, your retirement will be effective only if either third party knows about your retirement or ROC has been informed about it. But here, neither of the two situations have been fulfilled. So we will treat as if S is still a partner. We will treat it as if he's still a partner. His cessation is not effective over here. So whether S can be held liable for obligations arising from this contract? Yes, S can still be held liable. We will treat as if he is still a partner in the LLP. Okay, so both the points, very important points, you got them. Now come to question number 16. Now question number 16 is about conversion of company into LLP. See, we can convert an unlisted company into LLP. We can convert a private company into LLP. We can convert a partnership firm into LLP. But this entire question is only about converting unlisted company into LLP. So I'll focus on just that. We can convert an unlisted company into LLP. For that, Schedule 4 has to be followed. Now, if the ROC is satisfied that Schedule 4 is fully complied with, then ROC will register the documents and ROC will issue a certificate of registration. Getting it? An unlisted company, first of all, can it be converted into LLP? Yes, it can be converted, but for that we have to follow the process given in Schedule 4. And if ROC is satisfied that we have followed Schedule 4, then ROC will register the documents and ROC will issue a certificate of registration. Okay. Now, once this conversion is done, what will happen? From the date of registration, which is mentioned in the certificate, from that date, the LLP will come into existence, guys. And all the properties, assets, liabilities, obligations, whatever belongs to the unlisted company, everything will now get transferred to LLP. In fact, all the pending cases against this company, even those pending cases will now continue in the name of LLP. And then this old company, this unlisted company, will now stand dissolved and ROC will remove that company's name. That company's name will be removed from the register of companies. Okay, this was your entire reminder with respect to conversion. So yes, unlisted company can be converted into LLP. For that, we will follow the process which is given in Schedule 4. Now, once you follow the process, if ROC is satisfied that you have properly followed the process, then ROC will give you a certificate of registration. In that certificate of registration, one date of registration will be mentioned. From that day, the LLP has come into existence. Now, whatever assets, liabilities, responsibilities, legal cases, whatever the unlisted company had, everything will now belong to LLP. Even the pending cases in unlisted company's name will now continue in the LLP's name. And finally, this unlisted company will now stand dissolved because now LLP will exist. So this company will stand dissolved and the company's name will be removed from the register of companies. That's all, guys. Simple point. Now come to the question. The question says, ABC Aromatics Limited is an unlisted public company incorporated under the Companies Act. It operates in compliance tech space, providing regulatory software solutions. Company has paid up capital of 60 lakh rupees, turnover 1.35 crore, 185 shareholders, 5 directors. Then the question says it has raised secured debt of 20 lakhs from 2 banks. So all this information is about your unlisted public company. All the numbers are given to you. To simplify its governance structure and to reduce compliance burdens, the board has proposed conversion of the company into LLP under the name ABC Aeronautics LLP. So it's an unlisted public company and they want to convert it into LLP. Possible? Yes, possible. All existing shareholders of the company will become partners in the LLP. Company expects that the business operations, client contract, employee structure will continue seamlessly after conversion. Yes, even after conversion, all the assets and liabilities and all the rights and obligations will all get shifted to LLP. Everything will continue smoothly. However, one issue has emerged during the legal review process. Company is facing a regulatory action, a show cause notice under the Companies Act for alleged failure to comply with applicable accounting standards in 2021 has been issued. The proceeding is yet to be concluded. This means some legal issue is going on the unlisted company. Can that unlisted company still get converted into LLP? No problem. This show cause notice, this legal proceeding will continue in the name of the LLP. So no problem. So even though there are pending proceedings, there is no criteria that there's no criteria that the pending proceedings should be closed. Then only you can get converted into LLP. There is no criteria like that. So the company can get converted into LLP, and whatever pending proceedings are there, they will now continue in the name of LLP. That's all. So in this context, management seeks legal advice on the following. Can ABC Aromatics Limited, can it legally proceed with the conversion into LLP under LLP Act, considering the pending regulatory proceeding? Yes, it can get converted into LLP. It has to ensure it follows the Schedule 4 process. About the pending regulatory proceeding, no problem. It will continue in the name of the LLP. Then discuss the effect of registration under section 58. Effect of registration I already told you over here. Once the ROC gives the certificate of registration, in the certificate one date of registration will be mentioned. From that day the LLP has come into existence. All the property, assets, liabilities, rights, obligations of the company will all get transferred into LLP, and then the company will get dissolved. ROC will remove the company's name from the register. That's all. Okay. So this was your question number 16, all about conversion of unlisted company into LLP. Now come to question number 17. Question number 17 is a case-based MCQ, guys. Now I'll just give you the reminders first. Reminder number 1, in an LLP, how many designated partners do we need? We need minimum 2 designated partners, guys. You remember we learned that out of the partners, any 2 individuals will become designated partners. And out of the designated partners, how many of them should be resident? Minimum 1 of them has to be resident. Resident means what? Resident means they must have stayed in India for at least 120 days. So come on, tell me. Point number 1. In an LLP, there must be minimum 2 partners. Out of the partners, minimum 2 individuals will become designated partners. Out of the designated partners, at least 1 of them has to be resident. Resident means must have stayed in India for at least 120 days. Then, when a person becomes a partner in an LLP, after he becomes a partner, the LLP shall inform ROC that so and so has been admitted as a partner. So when a new partner is admitted into the LLP, we have to inform the ROC. Who will inform? LLP will inform within 30 days from the date he becomes the partner. Okay. Now come to the question. Now this question, guys, you can straight away look at the MCQs. Like there are some questions, right, where you don't even have to read the story. Even without reading the story, you can straight away look at the questions and you can straight away answer from there. This is one of those questions. So that's why I'm straight away coming to the MCQs. The first MCQ. As per the provisions of LLP Act, every LLP will have at least 2 designated partners who are individuals. At least 1 of them shall be resident. Correct, guys? Minimum 2 individuals will become designated partners. Out of them, minimum 1 will be resident. Correct only. In the given case, both the designated partners remained out of India for some time. Whether the requirement of resident in India of the designated partner has been fulfilled by them. What is the requirement? What's the criteria for resident? The criteria is 120 days. For 120 days, they must be in India. Now come on, let's have a look at the option. Like option B says 90 days. Not 90 days, guys. 120 days is the criteria. Option C says 120 days may be the correct answer. Option D says 182 days. This is incorrect. Option A says as both partners went abroad at the same time, firm has violated the condition of one partner being physically resident in India. There is no such condition. So option A is definitely wrong. No option B, no option D. Option C says 120 days. Anvika and Ella stayed not less than 120 days in India, hence fulfilled the criteria of resident in India. Yes, option C. Resident criteria is 120 days you must be in India. That's option C for you. Then comes the next question. In Anvika and Associates LLP, Falak, who was an employee in the firm, accepted to join the firm as partner on 15th Jan 2026. So 15th Jan 2026, new partner has been admitted. However, LLP forgot to inform ROC about this new admission of partner. Once a new partner gets admitted, 15th January, new partner was admitted. From this date, within 30 days, we are supposed to inform the ROC. LLP is supposed to inform ROC. But LLP forgot to inform, they are saying. According to LLP Act, what is the time limit within which LLP is required to file a notice? Answer is 30 days. So it is not 15 days. But B, C, D, all of them are 30 days. 30 days from when, guys? 30 days from the date on which he's admitted as partner, which is 15th Jan 26. So within 30 days from 15th Jan 26, option D. Okay, so the first question was testing you about the resident concept. Resident would be a person who has lived in India for at least 120 days. Second question was testing you about the admission of partner. Whenever a new partner is admitted into the LLP, within 30 days, we are supposed to inform the ROC about it. Who is supposed to inform? LLP is supposed to inform. So we saw the date of admission. From the date of admission within 30 days, so option D. Okay, this was question number 17. Now come to question number 18. This is a very important question, guys, from your September 26 RTP. This question is all about compromise and arrangement of LLP. So the very first point, compromise and arrangement of the LLP has to be agreed by partners and creditors. Both of them should be okay with the compromise and arrangement. Partners and creditors who are holding at least 3/4 in value have to give their consent, guys. Point number 1. Okay. Point number 2, reminder number 2, for compromise and arrangement, not only do we need the consent of partners and creditors, we also need NCLT's sanction. But NCLT will approve, NCLT will sanction only if we disclose two things to NCLT. Number 1, we have to disclose to the NCLT LLP's latest financial position. Okay, point number 1. Point number 2, we have to disclose to the NCLT pendency of any investigation proceedings. Basically, if any investigation proceedings are going on against LLP, details about that also has to be informed to NCLT. Only if both of these things are informed to NCLT, only then NCLT will sanction the compromise and arrangement. Okay. Then comes reminder number 3. Once NCLT passes an order sanctioning the compromise and arrangement, that NCLT order, one copy, has to be filed with ROC within 30 days after the order is made. In fact, you should also know this, that the NCLT's order sanctioning the compromise or arrangement will be effective only after that order has been filed with ROC within 30 days. Only then only that NCLT's order will be effective. Okay. Then comes the fourth reminder, the last reminder. After application is made to NCLT, if any suit or proceeding is filed against LLP, then NCLT can stay the commencement or continuation of the suit or proceeding. I'll tell you what this means. See, I know on the face of it looks very difficult, but trust me when I say it, it's very basic. Listen to me, I'll explain it to you. See, once LLP has filed an application with NCLT, which application? Application for compromise and arrangement. Once LLP files application with NCLT, after that, if any case is filed against the LLP, then NCLT has powers. What powers? NCLT can stay that case. Stay that case means NCLT can put that case on hold. NCLT can say, wait for the compromise or arrangement to get completed, only then the case will be proceeded with. Getting it? That's all. So once application is made to NCLT, what application? Application for compromise or arrangement. Once we file that application with NCLT, after that, if any suit or proceeding, that is if any case is filed against LLP, then NCLT can stay that case. NCLT can say that the case will be kept on hold. Only after the compromise and arrangement is completed, after that only that case will be taken up. Okay, that's it, guys. 4 simple reminders. Reminder number 1, LLP's compromise or arrangement has to be agreed by partners and creditors holding at least 3/4 in value. Then we also need NCLT's approval, but NCLT will approve only if we inform NCLT two things: LLP's latest financial position and pendency of investigation proceedings. Then once NCLT passes an order approving the sanction, that order has to be filed with ROC within 30 days. Only then NCLT's order will be effective. And lastly, once we file an application with NCLT, after that, if any suit or proceeding is filed against LLP, NCLT has the power to put a stay on it. Okay, that's all. Now come to the question, guys. We'll read the whole story. We'll understand what exactly happened here. So the question says, Apex Green Energy LLP, engaged in the business of manufacturing solar powered equipment, has been facing severe liquidity constraints due to a decline in demand. On 31st March 26, they owe 8 crore to creditors. They have accumulated losses. Irrelevant information. To revive the business, designated partners proposed compromise and arrangement. Accordingly, one of the major creditors filed an application before NCLT under Section 60. Tell me, guys. Application for compromise and arrangement. Can it be filed by creditors? Yes. It can be filed by the LLP, by the partners, or by the creditors, no problem. So the LLP, so the application has been filed with the NCLT. application for compromise, it has been filed with the NCLT, it has been filed by creditor, seeking an order for meeting creditors and partners. Alright, after considering the application, NCLT ordered separate meeting of creditors and separate meeting of partners. Yes, we already know this. We need consent of partners and we need consent of creditors. At the creditors meeting, creditors holding 78% in value of the debt represented at the meeting voted to approve the scheme. So when it comes to creditors, we need consent of creditors holding 3/4 in value. 3/4 means 75% consent we need. We got 78% consent, guys. This is at least 3/4 in value. This is at least 75%. So when it comes to creditors, yes, our condition is fulfilled. Now what about the partners? Even in partners, here also we need consent of 3/4 in value. At the partners meeting, partners holding 74% in value only accepted. So 74% only, guys. Is it at least 75%? No. So this is the first problem over here, that partners' consent we did not get properly. Then the question says, during the proceedings it was discovered LLP had failed to disclose to the tribunal that an investigation by a regulatory authority was going on. So investigation proceedings we did not disclose to NCLT. So this was not disclosed properly. This is the second problem. So we're having two issues over here. Partners' consent we do not get properly, and also LLP has not disclosed the pending investigation proceedings. So as of now, at this stage, if we stop the question, we will conclude that NCLT will not sanction, guys. As of now, with this much information, NCLT will of course not sanction, because there are two reasons. Even partners' consent we did not get. Also, investigation proceedings we did not disclose fully. So as of now, NCLT will not give sanction. Then the question says, subsequently, LLP rectified the omission by filing a fresh affidavit disclosing the material facts, including the pending investigation. So there were two problems. The pending investigation problem that they have rectified, they have filed a fresh affidavit in which they have disclosed about the pending proceedings. So now only one problem is there. What is that one problem? Partners' consent we have not gotten properly. Then partners meeting was reconvened, and this time partners holding 76% in value we got consent, guys. So now if you see, proper disclosure also we have made to NCLT. The investigation proceedings we have disclosed. Then when it comes to partners meeting, here we got consent of 76% in value, which is at least 3/4. It is at least 75%. So even this is sorted for us. And what about the creditors? Creditors' earlier approval of 78% continues to hold good. So when it comes to creditors meeting, here we got consent of 78% of the creditors, 78% in value. This is also at least 75%. So now if you see, tribunal will sanction, guys. Everything is fine now. On this basis, tribunal sanctioned the compromise. Now just that, once the tribunal sanctions the compromise, within 30 days, we just have to file that order with ROC. Then that sanction order will become effective. So tribunal sanctioned when? On 1st August 26. LLP, however, failed to file NCLT's order with ROC until 20th September. See, the NCLT passed the sanction order on 1st August 26. 1st August 26 plus 30 days will be what? 31st August 26. By 31st August 26, NCLT order should have been filed with ROC. Here it has been 20th September. Still LLP has not filed it with ROC. Definitely there's a violation over here. During the pendency, now listen, look at this one. During the pendency of the application before NCLT, which means when the application was pending, that time, one supplier attempted to continue a recovery suit against Apex Green Energy LLP despite restructuring process underway. Remember, we learned, if the application is made to NCLT and application is pending, at that time if any suit or proceeding is filed against LLP, NCLT can stay the commencement and continuation. So here the application was pending. During the pendency of application, some supplier has filed some suit against the LLP. This suit, LLP will pass an order simply staying the commencement and continuation of the suit. Now come on, have a look at the questions one by one. Look at the first question. Considering the voting results at the first meeting, remember, in the first meeting from the creditors, we got consent from creditors holding 75% in value, but from the partners, we did not get consent in the first meeting. Only second meeting only we got consent. So they're asking us on the basis of the first meeting, what would be the legal position? It would automatically become binding. No, definitely not. Compromise and arrangement will become binding only if NCLT sanctions and we file that sanction with ROC. NCLT itself will not sanction if partners have not approved properly. So first option, definitely no. It would be approved because both creditors and partners have approved it by simple majority. We don't need simple majority. We need 75%. 75% in value should approve. So option B is wrong. It will fail because creditors did not approve it by 80% in value. 80% is not the criteria. 75% is a criteria. So option C is wrong. It would fail because partners representing only 74% in value approved the scheme. Yes, the reason why it will fail is because partners' consent we did not get. We need consent of partners holding at least 75% in value, but we did not get that much consent. So because of that reason, the sanction will not be given. Then comes the second question. Can the tribunal sanction the scheme when LLP failed to disclose the pending investigation proceedings, although it disclosed its latest financial position? Remember earlier, the financial position was disclosed, but the investigation proceedings were not disclosed. So if investigation proceedings are not disclosed, will the tribunal sanction the scheme? No, tribunal will not sanction the scheme. Tribunal will sanction only if we disclose both. We have to disclose the financial position also. We have to disclose pending investigation proceedings also. Only then NCLT will approve. So the answer is no. So it can't be yes. So either option B or option D. Option B says unless all material facts, including pending investigations, are disclosed to the tribunal. Yes. NCLT will not approve unless the pending investigations are disclosed. Option D says no, because compromise and arrangement is not permitted where investigations are pending. There is no such point. Even if investigations are pending, compromise will still be allowed. Only thing is we have to disclose, that's all. So because we did not disclose, because of that reason, NCLT will not sanction. Then comes the third one. Tribunal sanctioned the scheme on 1st August 26. LLP filed the order with ROC on 20th September 26. What was the last date to file, guys? Last date to file we already calculated, 30 days. 1st August 26 plus 30 days is going to be 31st August 26, option C. Then comes the last question. What power does tribunal possess regarding supplier's recovery suit? Remember, application was pending. During the pendency of the application, the supplier had filed a suit. We had learned that in such cases, NCLT can pass an order staying the commencement and continuation of the suit. Which option? Tribunal may stay the commencement or continuation of any suit or proceeding against the LLP until disposal of application. Yes, it's going to be option A. Got it? So this was your question number 18. We saw some nice points with respect to compromise and arrangement over here. The first question was about the first meeting. First meeting, we did not get consent from the partners. So because of that reason, we will not get sanctioned for the compromise. Second question was about the pending investigation proceedings. We did not disclose. Only financial position we disclosed. We have to disclose both, then only we will get sanction. So because we did not disclose the investigation proceedings, because of that reason, we will not get the sanction. Third question was about filing NCLT order with ROC. It has to be filed within 30 days. And the last question was the most important question, your fourth one. This question was about the new suit which is filed. During the pendency of the application, if any suit or proceeding is filed against LLP, NCLT will have the power to stay the continuation and commencement of the suit. Okay, now come to question number 19. Now before we read the question, before we see what exactly has happened over here, let me give you two quick reminders and then we will start the question. Okay, reminder number 1. If the LLP's name happens to be similar or identical to the name of another LLP or to the name of another company, or if it is similar to the name of another registered trademark, then the central government can issue a direction asking the LLP to change its name. Now, if the central government is issuing a direction like this asking the LLP to change its name, then the LLP should change its name within 3 months. Within 3 months from when? Within 3 months from the date of issue of direction. Okay, so what is the situation? LLP has a name. The name is similar to the name of another LLP, or it is similar to the name of another company, or it is similar to the name of another registered trademark. In that case, central government will ask this LLP to change the name, and if the central government asks the LLP like this to change the name, in that case, LLP should change its name within 3 months from the date of issue of direction. Okay, now what if the LLP does not change the name? What if the LLP does not rectify its name? Then what is the consequence? If the LLP does not change its name, then in that case, the central government itself will allot a new name for the LLP. Simple story, guys. Okay, this was the first reminder. Then comes the second reminder. Do you remember in one of the earlier questions I told you that whenever a new partner is admitted, we have to inform the ROC about it within 30 days. Same way, whenever a designated partner is appointed, within 30 days of his appointment, ROC has to be informed. So designated partner's appointment, about this also, ROC is to be informed. Who will inform the ROC? LLP will inform. So LLP should inform the ROC about the designated partner's appointment. Same within how many days? Same within 30 days. So whenever a new partner is admitted into the LLP, about that also we have to inform ROC. Also about designated partner's appointment, about that also we have to inform ROC. And time limit is the same, only 30 days. Okay, that's it, guys. These two reminders. Now come on, let's enter into the question. Now see, when it comes to case-based MCQs in law, many a times without even reading the story, just looking at the MCQs itself, you will be able to give your answer. This is one of those questions. Straight away, let's come to the MCQs. Let's see exactly what are they asking. The first MCQ over here. In the above case scenario, assume central government issued a direction under section 17 on 20th March 2026 requiring Learn Sphere AI LLP to change its name. Understanding? Central government has already issued a direction asking this LLP to change the name. Now within 3 months, LLP has to change the name. When did the central government issue the direction? On 20th March 26. This plus 3 months is going to be April, May, June, 20th June 2026. So by 20th June 2026, the LLP will have to change its name. Okay, so the central government has issued the direction on 20th March 26 requiring Learn Sphere AI LLP to change its name. Direction was dispatched on 24th May 26 and it was actually received by the LLP on 2nd April 26 due to postal delay. Are you seeing how they are trying to confuse you? They are confusing you by giving you 3 different dates, but we know very well that our 3 months calculation will always start from the date of issue of direction. So the other dates are totally irrelevant for us. The central government issued the direction on 20th March 26. This plus 3 months, 20th June 26. So by this date, LLP has to change its name. The designated partners contend that the 3-month period for compliance should be reckoned from the date of receipt of direction. Are they correct, guys? The question is saying that the designated partners are contending that the 3 months period should start from the date of receipt of direction. No, wrong. The 3 months period will start from the date of issue of direction. When did central government issue the direction? 20th March 26. This plus 3 months, 20th June 26, that's going to be the correct date. So tell me, is the contention of the designated partners, is it correct or not? No, guys, it is definitely incorrect. They are saying that 3 months will be calculated from the date of receipt of direction. It is wrong. It will be calculated from the date of issue of direction. Now pick the correct answer, guys. It is incorrect. So it is not correct. It can't be option A. It will be option B, C or D. Option B says incorrect. LLP must comply by 20th June 26. Yes, even we got 20th June 26 when we were discussing. Since a statutory period is reckoned from the date of the direction and not from the date of its receipt. Perfect. Option B. We are going to start the calculation from the date of issue of direction. So the only takeaway for us from the first question over here was that 3 months is calculated from when? It is calculated from the date of issue of direction. Okay. Now come to the second MCQ. The second MCQ says Rohan Gupta was appointed as designated partner on 1st June 2026. LLP was required to inform ROC within how many days? Designated partner's appointment, we have to inform the ROC within 30 days. So 30 days, option B, guys, straightforward. Then comes a third question over here. The bank granted a loan on 25th July 26, relying upon MCA records, which still showed Vaibhav Jain as partner. So basically what happened over here, I'll tell you. This person, Vaibhav Jain, he had left the LLP, guys. He retired from the LLP. He ceased to be a partner. Now, in one of the earlier questions itself, I told you that when a partner ceases to be a partner, his cessation will be effective only after the LLP informs the ROC about it or the third party is aware of it. You remember this? The cessation of partner will be effective only after LLP informs ROC about it or third party is aware of it. Only then the cessation will be effective. If the LLP has not informed ROC also third party is not aware, then in that case we will treat as if that partner who has left the LLP, we will treat as if he is still a partner. Remember this discussion, guys. So that is what this question is about. So Vaibhav Jain, actually he left the LLP, actually he ceased to be a partner, but however this LLP has neither informed ROC about it, and not as a banker, not as a third party know about it. So therefore from the third party's point of view, it will be as if Vaibhav Jain is still a partner. So Vaibhav will not be liable, wrong. We will treat as if he is still a partner. Vaibhav will remain liable only if LLP agreement provides so. No, LLP agreement is irrelevant in my answer over here. Vaibhav may continue to be regarded as a partner vis-a-vis third parties who dealt with LLP without the notice of his cessation. Option C. You getting the point? In reality, he has ceased to be a partner. In reality, he is not a partner. But however, LLP has not informed ROC about it. Also, third party, the bank is not aware of his cessation. So therefore, we will treat as if he is still a partner. That's why option C, Vaibhav may continue to be regarded as a partner. We will continue to treat him as a partner as far as third parties are concerned, because third parties are not aware of his cessation. Okay, then comes the fourth question, the last question. Assume Learn Sphere AI LLP failed to comply with the government's direction to change its name within the prescribed period. What happens if the central government has issued the direction but LLP is not changing its name within 3 months? We spoke about it. In that case, the central government itself will allot a new name for the LLP, guys. So same thing has happened over here. This LLP has failed to comply with the central government's direction. So what will happen now? Automatic winding up of LLP? No, this extreme consequence will not apply. Government may allot a new name and ROC will issue a fresh certificate of incorporation. Yes, option B. So if the LLP does not comply with central government's direction, if they don't change their name, if they don't rectify their name within 3 months, then central government itself will allot a new name. Then ROC will give a new certificate of incorporation to the LLP which contains that new name. Okay, this was your question number 4. So with this, we're done with question number 19. This was a nice mock test paper question. It was a case-based MCQ from your first mock test paper. Okay, now come to question number 20. Question number 20 is another case-based MCQ from another mock test paper, from your mock test paper 2. Okay, again same thing. Before I start the question, let me give you some reminders and then we'll see the story. Okay, so here reminder number 1. See, in an LLP, the partners, they bring in capital contribution. Now that capital contribution can be in any form. It can be in the form of tangible property. It can be in the form of intangible property. It can be movable property, immovable property. It can be money, promissory notes. It can be an agreement to contribute cash or property in the future. It can be contract for services to be performed. Basically, what this shows you is that the capital contribution can be in any form. It is not necessary it has to be money only. It can be in any form. Okay, but in whatever is the form of capital contribution, I don't care. Whatever is the monetary value of the contribution, the LLP will have to find the value of the contribution, and that value has to be disclosed, and that value has to be accounted for in the LLP's accounts. Keywords, guys. So whatever is the contribution brought in by the partner, doesn't matter in what form it is, it doesn't matter. We have to find the monetary value of that capital contribution, and that monetary value has to be accounted for and it has to be disclosed in the accounts. Okay, reminder number 1. Reminder number 2. If the partner of the LLP enters into a transaction with the LLP, are you listening to me? A partner of the LLP enters into a transaction with the LLP. For example, the partner lends a loan to the LLP. Now, this loan, you agree with me, it's like a normal business transaction, guys, between the partner and LLP. Basically, this loan has nothing to do with the fact that he's a partner. This loan is not lent in the capacity of a partner. It's like a normal business transaction with the LLP. So, for these kind of transactions, which are not in the capacity of partner, for these kind of transactions, the partner should be treated like any other third party. The partner will have all the rights and obligations that any other third party will have. What this means is, on this loan, this LLP will have to pay interest. Just because loan is given by the partner doesn't mean no interest. Just like how you will treat a third party transaction, you have to treat this transaction also. So LLP has to pay interest on this loan, LLP will have to repay this loan. Basically, the partner will have all the rights and obligations just like any other third party. So that is the second reminder. Whenever the partner enters into a normal business transaction like this with the LLP, for those transactions, the partner will have same rights and obligations as third parties. So whatever rights and obligations the third parties have, even the partners will have. Okay, you got the point? So two reminders. Now come on, let's have a look at the question. Let's see exactly what happened over here. The question says Brown Solutions LLP was formed in India to provide solar panel installation solutions. Mr. Pradeep, an NRI, considered inducting Mr. Rajiv, who resided in India from 2nd July to 30th October 23. How many days has he been in India? Calculate. See, July, if you see, 2nd July onwards, he is in India. So, total 31 days in July. 31 minus 2 plus 1. Okay, because even 2nd July, I want to count. So, how many days is this going to be? 30 days, guys. So, July 30 days. Then August 31 days. Then September 30 days. And October, he is in India till 30th October only. So, totally, if you add up, Mr. Rajiv is in India for how many days? He is in India for 121 days, guys. 121 days means he is in India for at least 120 days, right? So Rajiv will become a resident. Remember, right? Under the LLP Act, resident means a person who is in India for at least 120 days. So yes, Rajiv is in India for at least 120 days. So therefore, Rajiv becomes a resident. So once again, in this question, we have this LLP Brown Solutions LLP. So Mr. Pradeep, he is an NRI. He is inducting Mr. Rajiv as a partner. He is inducting Miss Jenny, US citizen visiting India on a business visa. Dark Horse LLP, a Singapore registered LLP, and Urban Tech Private Limited, an Indian private company. So all of these are partners in the LLP. How many partners do we have now? We have Mr. Pradeep, who's an NRI. Then we have Mr. Rajiv, who's a resident. Then we have Miss Jenny, who's a US citizen. Yes, even foreign citizens can be partners in an LLP. Then number 4, we have this Dark Horse LLP, which is a Singapore registered LLP, which means it's a foreign LLP. Even foreign LLPs can be partners in an LLP. And number 5, we have Urban Tech Private Limited, an Indian company. Yes, even Indian companies can be partners in an LLP. So total 5 partners we have in this LLP. They jointly decided to appoint Mr. Rajiv and Mr. Pradeep as designated partners. We know that minimum 2 designated partners we need, and both the designated partners have to be individuals. So yes guys, Rajiv and Pradeep, 2 individuals are designated partners over here. We also know out of the 2 designated partners, at least one of them has to be a resident, and we already know that Mr. Rajiv is a resident, so one of the designated partners is a resident. So till here everything is beyond perfect. Now let's see what happened after this. The registered office of the LLP is in Jaipur. It was registered on 12th December 24. 6 months later, Brown Tech Solutions Limited discovered the registration, and believing the LLP's name could cause confusion or dilute its brand, it filed a complaint before the ROC. So just like the last question, even in this question, this LLP's name is identical or similar to the name of another company. There's another company, Brown Tech Solutions Limited, and this LLP's name is similar to the name of this company. Contributions under the LLP agreement, capital contributions guys. Rajiv will be giving 5 lakh rupees cash. Then Pradeep will be bringing in 8 lakh rupees cash. Miss Jenny will be bringing in a patented AI algorithm valued at 11 lakh rupees. Are you noticing? Miss Jenny is bringing in an intangible asset as capital contribution. No problem. Capital contribution can be intangible asset also. Just that its monetary value has to be disclosed and accounted for in the books of accounts. That's all. Then Dark Horse LLP, specialized solar equipment valued at 15 lakhs. So even this partner Dark Horse LLP, even they are bringing in capital contribution in the form of some asset, some tangible asset. Urban Tech Private Limited is bringing in R&D services over 2 years valued at 20 lakhs. Yes, perfectly fine. Even services can be a part of capital contribution. Basically, whatever they have given over here is all different types of capital contribution. Like two partners have brought in cash, one partner has brought in an intangible asset, another partner has brought in a tangible asset, another partner is going to give services over a certain period of time. All of these are valid forms of contribution, just that if the contribution is in kind, we have to just ensure that the monetary value is accounted for and disclosed in the books of accounts. That's all. Okay. Then the question says, Mr. Rajiv, guys, he was a designated partner, right? Without informing his partners, he used LLP's letterhead to contract with Varda Corporation for solar equipment worth 20 lakhs for his own personal use. When Varda Corporation sought payment from the LLP, Rajiv admitted the purchase was personal. So Rajiv, one of the designated partners, he has made a personal purchase in LLP's name. Then separately, client sued LLP for 15 lakhs in damages over a legitimate project handled by Miss Jenny and Dark Horse LLP that went wrong, demanded payment from Jenny's and Dark Horse LLP's personal assets since LLP assets were said to be insufficient. No, if LLP's assets are insufficient, we can't attack the personal assets of the partners, not allowed, because that's a whole main thing about LLP, right? That in LLP, the partners have limited liability. So for LLP's liabilities, the partners cannot be held liable. We'll see this when we come to the relevant MCQs. We'll handle all this. Current position, LLP assets 50 lakhs, existing LLP liabilities 30 lakhs, Varda Corporation's claim 20 lakhs, and client's legitimate claim 15 lakhs. Then for a new project needing 15 lakhs, Miss Jenny lent 5 lakhs to the LLP at 5% interest under a formal loan agreement. Remember, Miss Jenny was one of the partners in the LLP, guys. She was a US citizen. She was a partner in the LLP. Now she is lending 5 lakh rupees loan to LLP at 5% interest. She is lending it to the LLP. So this is going to be treated like a typical third-party transaction. Even though she's a partner, this transaction is not in her capacity as a partner. So for this transaction, we will treat her like a typical third party, and she will have all the rights and obligations that a third party will have, which means she will have the right to get this interest from the LLP. When the loan tenure is over, she will have the right to get repayment of the loan also. LLP simultaneously took a similar loan from Hame Finance and NBFC. So LLP has taken two loans for the project. One loan they have taken from Ms. Jenny, another loan they have taken from Hame Finance Limited. So we have two loans that the LLP has taken. On default, Ms. Jenny claimed repayment priority owing to her fiduciary position as a partner. Hame Finance Limited disputed this. You understood this line. LLP is defaulting, okay. LLP is not repaying both the loans. So Jenny is saying that because I am a partner, I must be getting priority. No, there are two lenders over here, Jenny and him. Both will be treated equally. One is Jenny, one of the lenders is a partner. Him, one of the lenders is outsider. Doesn't matter. Both the lenders will be treated equally. I mean, just because she's a partner, because of that reason alone, she will not get priority. So both the lenders will be treated equally. Okay. So with this, you got a fair idea of the story. So we have 5 partners in this LLP. Some of them are individuals, some of them are companies, some of them are LLPs. It's all fine. Even LLP company, even they can be partners in an LLP. Then we have 2 designated partners. Both are individuals. Out of them, one of them is a resident. All of this was perfectly fine. But then, however, if you remember, another company's name and this LLP's name are similar. So for this reason, central government can issue a direction asking the LLP to change the name within 3 months. Even that point is there in the question. Then they also gave us different forms of capital contribution. We said not a problem. Capital contribution can be in any form, just that it has to be accounted and disclosed properly. The monetary value has to be accounted and disclosed properly. Then after that, one of the partners, Mr. Rajiv, who's in fact also the designated partners, he purchased goods for his personal use in the LLP's name. Then after that, there was one more issue over here. There's a client who sued 2 partners' personal assets. We said that is not allowed. In LLP, the partner's liability is limited. The partners can't be held personally liable for LLP's liabilities. And then after that, they said that LLP has borrowed 2 loans, one loan from Jenny and one loan from this Hame Finance Limited. Whether the loan is from the partner, whether the loan is from third party, both the loans will be treated equally. Okay, now come to the questions. Let's see what exactly are they asking us. Are Mr. Pradeep and Mr. Rajiv a valid choice as designated partners under LLP? Yes, guys, it was perfectly fine. We need two individuals as designated partners. Both are individuals, and out of them, one of them has to be a resident. Rajiv is a resident. He was in India for at least 120 days. So yes, it's a perfectly valid choice. So no is not the correct answer. So either option B or option C. Option B says yes, Mr. Rajiv, having stayed in India for more than 120 days, satisfies the resident in India test. He, together with Mr. Pradeep, an NRI, who faces no bar on being a designated partner, can be appointed as LLP's two designated partners. Perfect. Option B. Rajiv is a resident and two individuals are designated partners. Perfectly fine. Okay. Then let's come to the second MCQ over here. Is Brown Tech Solution Limited's complaint against the similarly named Brown Solutions LLP maintainable, and what is the correct procedure? What is this question about? Remember, LLP's name is similar to the name of another company. So therefore, this company filed a complaint with the central government saying that the name is similar. Now what will happen? Now central government will issue a direction asking the LLP to rectify its name within 3 months from the date of issue of direction. So can this Brown Tech Solutions Limited, can this company file a complaint like this against LLP? Yes, they can. If the LLP's name is similar or identical to the name of another LLP, or to the name of another company, or to the name of another registered trademark. In all the three cases, complaint can be filed against the LLP. So here LLP's name is similar to the name of another company. The company can file a case, they can file a complaint against the LLP. Perfectly fine. So so they're asking us first, is the complaint maintainable? Yes, the company's complaint will be maintainable. So no can't be the option. So it has to be A, B or C. A says within 15 days. No 15 days criteria. We have 30 days criteria only. Yes, Brown Tech Solutions Limited may apply to the central government under section 17, and if satisfied that LLP's name is identical with or too nearly resembles its own, the central government may direct Brown Solution LLP to change its name within 3 months of the direction. Perfect, guys. Option B. So yes, the complaint is maintainable, and number 2, central government will pass an order asking the LLP to change its name within 3 months. So option B. Then comes a third MCQ. How should the partners' varied contributions be recorded for LLP's books of accounts? The capital contributions are in different forms. No problem. Simply find the monetary value and account and disclose it properly in the books of accounts. That's all. So option A, only monetary contributions are recorded. Wrong. Doesn't matter what form of contribution, every form has to be recorded. All contributions, whether cash, property, services or other benefits, whether from domestic or foreign, individual or corporate partners, must be assigned a monetary value and must be disclosed in LLP's accounts in the prescribed manner. Perfect. Option B. All contributions, doesn't matter in what form, doesn't matter from whom, monetary value you have to find and you have to put it in the books of accounts. Okay. Then comes the fourth question, the last question over here. How should Miss Jenny's position as lender alongside Hame Finance Limited be evaluated? Remember, Miss Jenny and Hame Finance both had given one loan to the LLP, and Jenny is a partner. So because she's a partner, she's saying that she should get priority. We said no. The partner and the third party both will be treated equally. These are business transactions of partner with the LLP. For these business transactions, the partner will be treated same as third party. So is Miss Jenny's claim valid? Her claim is not valid. So Miss Jenny's claim ranks lower than Hame Finance Limited. No, not higher, lesser. Both are equal. So option A wrong. Miss Jenny's loan is treated at par. At par means what? Equal. Jenny's loan is treated at par with other creditors as she transacted with the LLP in her personal or commercial capacity under a formal loan agreement. Perfect, guys. Option B. So Jenny's loan will be treated equal to the other third parties. We will treat her loan as a normal third party transaction. It is not in the capacity of a partner. So no priority, no second treatment, nothing. She will be treated equal to third parties. Okay, so these were your 4 questions under this question. This was your question number 20. This was again a case-based MCQ from your second mock test paper. I hope this is clear. So in this question, two new points got covered for us, the contribution point and the business transaction point, and some points got revised for us, like the resident point, then the rectification of LLP's name, that point, they were revisionary points for us. Now come on guys, let's move on to the next chapter. We'll move on into the General Clauses Act. Here also I have a lot of questions for you. Let's take them up one by one. The very first question, question number 21. Before this, let me give you a small, simple, tiny reminder guys. See, section 21 of the General Clauses Act very clearly says that power to issue notifications also includes the power to amend the notifications, vary the notifications, and rescind the notifications, which means, like for example, let's say Income Tax Act has given power to CBDT the power to issue notifications. So if CBDT has the power to issue notifications, it will automatically have the power to amend the notifications, to vary the notifications, and to rescind. Rescind means to cancel the notifications. This is implied. So the power to issue notifications will also automatically include the power to amend, vary, and rescind the notifications. That's all guys, simple point. Have a look at the question. The question says central government under the powers conferred by a central act issued a notification. Who issued notification? Central government. So central government has the power over here to issue notifications. This power was given by whom? This power was given by a central act. Understood? So we have some central act over here, and this central act has given power to central government, power to issue notifications. Now this power will automatically include the power to amend, vary, and rescind. All the three words you will write in your answer paper. Okay. So central government under the powers conferred by a central act issued a notification on 1st April 25 granting tax exemption to a specified class of manufacturers for 3 years. Subsequently, due to misuse of the exemption, government issued another notification on 1st December 25 withdrawing the exemption with immediate effect. Understood? So here, first central government issued a notification giving the exemption, and then they issued one more notification where they are withdrawing the exemption. Can central government do that? Yes. If central government has the power to issue the notification, they also have the power to amend, vary, and rescind the notification. So they also have the power to cancel the notification, even that is allowed. So central government has not done anything wrong over here. They do have the power to withdraw the exemption as well. A manufacturer who already made substantial investments relying on the exemption challenged the validity of the withdrawal on the ground that the original notification could not be rescinded before expiry of 3 years. Wrong. What the manufacturer is saying is wrong. Central government is the one who issued the notification. So central government will also by default have the power to rescind the notification also. Central government has rescinded the notification over here. They have not done anything wrong over here. So what the manufacturer is saying, his statement is definitely wrong. Manufacturer is saying central government, you can't rescind the notification like that. Manufacturer, you are wrong. Central government can rescind the notification. Examine the validity of government's action withdrawing the exemption with reference to the GC Act. The government's action is perfectly valid. The whole question revolves on this particular point only. That's all. Simple question guys. Conclusion, if central government has the power to issue notifications, then central government will also have the power to amend the notification, vary the notification, or rescind the notification. Rescind the notification is nothing but cancel the notification or withdraw the notification. Okay, so what the government has done over here is within its power, it is valid. Now come to question number 22. Question number 22 is about document. Okay, again document under General Clauses Act. Now this is how I've taught you to learn the definition of document guys. Document includes, first of all the definition starts with the word includes, which means it's an extensive definition. Now how did we learn the definition? We will simply ask ourselves 4 questions: what, where, how, and why. When we answer these 4 questions, our definition will be ready. So document includes, first question, what does it include? It includes matter. Now this matter may be written, expressed, or described. First question. So document includes, it includes what? It includes matter. This matter may be written, expressed, or described. Then where? Second question, where? Where is it written, expressed, or described? It can be written, expressed, or described upon any substance. On a piece of paper, it can be online, it can be on a steel plate, it can be written, expressed, or described upon any substance. Then comes the third question. How will it be written, expressed, or described? It will be written using letters, or using figures, or using marks. And fourth question, why do we make the document? To be used for recording that matter. So give me the definition, the final definition now. Document includes matter which is written, expressed, or described upon any substance using letters, figures, and marks to be used for recording that matter. Again, document includes matter which is written, expressed, or described upon any substance using letters, figures, or marks to be used for recording that matter. Okay, this is a definition of the word document. Now come on, look at the question. They are first asking us, what do you understand by the term document? You will write the definition. Then they're asking us, which of the following will be treated as document? Power of attorney. Power of attorney is a document, guys. In fact, this is given in the list of examples itself for you. Power of attorney, it records matter. It is upon a piece of paper. It can be upon any substance, but this one is made on a piece of paper. It is using letters, figures, and marks to be used for recording that matter. So power of attorney will come under document, yes. What about a digitally signed loan agreement stored as an electronic record? See, we learned that in document, the matter can be recorded upon any substance, not necessarily a piece of paper. So if the document is stored as electronic record, which means if it is an online file, if it's a digital file, it will still be considered as document. Document need not necessarily be on paper only, not necessary. It can also be a digital record. It can also be an electronic file. Even this will be considered as document. Okay, this was a small simple reminder for you from your first mock test paper about the definition of document and these 2 points. Document definition, tell me one last time, guys. Document includes matter which is written, expressed, or described where, upon any substance. How, using letters, figures, and marks. Why, to be used for recording that matter. Okay, then come to this 23rd question. This is a case based MCQ. Before I start this question, let me give you some reminders. 2 reminders, guys. My first reminder is about service by post. Your General Clauses Act concept, section 27. Very simple concept, guys. Section 27 applies when we have to send a document by way of post. So if I do these 3 things properly, then in that case we will treat as if the document has been properly served by way of post. Okay, what are the 3 things I should do? By the way, when will this concept apply? This concept will apply whenever I want to send any document by way of post. Okay, so in that case I must do 3 things. Number 1, I must properly address the document. Number 2, I must prepay the postal charges. And number 3, I must post it by way of registered post. So if I have properly addressed the document, and if I have prepaid the postal charges, and if I post it by way of registered post, if I do all the 3 things, then in that case the service will be deemed to be effected, which means it will be as if I have sent the document to you by way of post. It is as if I have sent the post properly to you. Okay, now in the same section 27 discussion, if you remember, we also learned this case Jagdish Singh versus Nathu Singh. Do you remember? So I'll remind you, we had learned over here that in case I have done all these 3 things, then that post, the service of the post is deemed to be effected properly, which means it is as if I have sent the post to you properly. Now in case that same post gets returned back to me with an endorsement of refusal. Endorsement of refusal means if the recipient has refused to accept the letter and the letter comes back to me, if it is returned back to me, we will still treat it as if the notice has been served. Right? So in conclusion, if I do all these 3 things, then it is as if the post has been served properly. Now after I do these 3 things, even if the letter comes back to me, still it is as if the notice has been served properly. This is your first reminder. Then second reminder, in the same General Clauses Act, we have also learnt about measurement of distance. We've learnt unless specifically mentioned. Unless specifically mentioned, how do we measure distance? We measure distance in a straight line, on a horizontal plane. All these are key words, guys. In law, the biggest reason why students don't get the marks is not because they lack conceptual clarity. They'll have amazing conceptual clarity, but the sad state of affairs is such that writing those answers in own words is not fetching you marks. They're looking for these words. If this word is there, if this word is there, if the sentence is there, then they give you the marks. So be careful, please. So unless otherwise specified, distance has to be measured in a straight line on a horizontal plane. Okay, so 2 small reminders. Now come on, have a look at the question. Mr. A is the owner of a residential house and Mr. B is his tenant. Due to continuous default in payment of rent, Mr. A decides to terminate the tenancy. Mr. A sends a notice of termination to Mr. B by registered post at Mr. B's correct residential address. So are you noticing? A has to send a letter to B, a letter terminating the tenancy. A has sent it by registered post, so my third condition here is fulfilled. He has sent to the correct residential address, so which means it is properly addressed, and I'll assume that A has prepaid the postal charges. So A has done all the three, which means I can say that the service is deemed to be affected, which means it is as if A has properly sent the letter to Mr. B. Now what happened? The postal article is returned to Mr. A. It is returned back to Mr. A with the endorsement of refusal refused by the addressee. So the same letter has been returned back to A with an endorsement of refusal, but however, applying section 27 and applying our learning in this case of Jagdish Singh versus Nathu Singh, what will you conclude? You will conclude two things. Thing number one, when A is sending the letter to B, he has properly addressed the letter, he has prepaid the postal charges, he has sent by registered post, which means the service is deemed to be affected. Now, even though the letter comes back to A, even though the letter is returned to A with an endorsement of refusal, still it will be presumed that the notice has been served. So we will treat as if B has received the letter. Okay, Mr. B later challenges the eviction proceedings on the ground that he never received nor read the contents of the notice. No, Mr. B, you can't contend like that. B is saying, I never received the letter. Sorry, Mr. B, we will assume as if you have received the letter. We will assume that the notice has been served to you. So therefore, at this stage itself, I can say that Mr. B's contention is wrong, guys. This is the first part of the question. Then the question says, central regulation made in 2018 prohibits establishment of any chemical factory within 500 meters of a protected wildlife sanctuary. Mr. A applies for permission to set up a chemical factory near the sanctuary. Distance between the factory site and the sanctuary boundary is 520 meters if measured along the road. We don't measure on the basis of road. We measure in a straight line on a horizontal plane. Authority rejects Mr. A's application stating that factory is within the prohibited distance. Mr. A challenges the decision. So there are two questions, 2 points over here. Come to the MCQs now. The first MCQ. As Mr. B has challenged the validity of the notice, in the light of the above facts, which of the following is the most appropriate legal position pertaining to the validity of the notice? We've already spoken about this. The notice which A has sent to B, even though it got returned back to A, we are going to assume as if the notice has been served properly. So, notice is invalid, wrong. Notice is valid, it is as if it is served properly. Notice is valid, refusal to accept registered notice amounts to deemed service. Yes, guys. Option B, notice is valid, refusal to accept, when the tenant refused to accept the notice, it is as if the notice has been served, so it amounts to deemed service. Option B. Then comes the second question. With regard to measurement of distance for the purpose of any central act or regulation made after the commencement of GC Act, correct approach is to measure the distance from the wildlife sanctuary to the proposed factory is, how do you measure distance? Straight line, horizontal plane, not on the basis of a road. Distance must be measured along the motorable road? No. Distance must be measured by the shortest pedestrian route? No. Distance must be measured in a straight line on a horizontal plane unless the regulation provides otherwise? Yes, option C. Okay, so two concepts over here, especially, see the measurement of distance point everybody knows, nothing out of the world over here. But the section 27 discussion combined with this case law is extremely important. I really wanted to do this for you. I hope you've gotten a good reminder. Yes, guys. So when I do all these three things, it is as if the notice has been served. Now, even if you return the notice back to me, still it is as if the notice has been served. So even though in this case, Mr. B in reality did not get the notice, but still we will treat as if he got the notice. It's deemed service. Okay, now come to question number 24. Question number 24 talks about a small simple concept, definition of person under General Clauses Act. The definition of person starts with the word includes, which means it's an extensive definition. Person includes cab. This is a mnemonic with which I've taught you guys. C for company. Then A stands for association and B stands for body of individuals. So person includes company, association and body of individuals, but please don't forget we have the word includes over here. So whatever is given in the definition are only examples of the word person. Okay, now come on, have a look at the question. The question says Bright Future Welfare Association, an unincorporated association of individuals, entered into a statutory arrangement. A member contended that it is not a person under GC Act because it is not incorporated. Tell me guys, what the member is saying, is it correct or not? Member is saying because this association is an unincorporated association, because of that reason it is not a person. Wrong. This is definitely wrong, because we learnt over here that person includes company, association, body of individuals, whether it is incorporated or not. So whether it is incorporated, whether it is not incorporated, both will come under person. So therefore the member is saying over here that it is not a person because it is not incorporated. So definitely what the member is saying is wrong. Even though the association happens to be unincorporated, not a problem, it will still be considered as a person. So which option is correct? Member is correct because only incorporated bodies are persons. Wrong. Member is incorrect. Member is wrong. Association is a person only if it is registered under Companies Act. No, it may be registered, it may not be registered, doesn't matter. Association is a person since the term person under GC Act includes any company or association or body of individuals, whether incorporated or not. Option C. So whether this entity is incorporated or whether it is not incorporated doesn't matter. All of these will come under persons. So option C. So small, simple mock test paper MCQ this was. Now come to question number 25. Here one small reminder I have to give you about two definitions, immovable property and movable property. General Clauses Act defines both. General Clauses Act says immovable property includes land, benefits arising out of land, things attached to the earth, things permanently fastened to anything attached to the earth. So properly the GC Act has defined immovable property. But then when it comes to movable property definition, GC Act is taking a shortcut. GC Act is saying movable property means property except immovable property. Understanding? So basically, we will first check whether the asset is coming under immovable property or not. If it is not coming under immovable property, everything else will become movable property. See, my focus in this question is not on immovable property, my focus is on movable property. You understood the interpretation, right? If anything is not immovable property, then it will automatically become movable. That's all. So come to the question. Ritika pledged her shares in XYZ Limited as security for a loan. During a discussion, one of her friends argued that shares cannot be treated as movable property. So the question over here is, shares, are they movable or are they immovable? Tell me guys, will shares come under these 4 points? Is shares land? No. Is it benefits arising out of land? No. Is it things attached to the earth? Is it permanently fastened to anything attached to the earth? No. So shares is not immovable property, and anything which is not immovable property automatically becomes movable. So shares, I will consider them, I will treat them as if they are movable. So shares are immovable? No. Shares are movable? Yes. Shares are movable property. Why? Because they are not immovable. Correct guys? Anything which is not immovable becomes movable. So shares are not immovable, because of that reason they automatically become movable. Option C says shares are neither movable nor immovable. Wrong. They will be considered as movable. Shares become movable property only after being transferred. Wrong. So my correct answer will be option B. Because shares are not immovable property, they will become movable. So we will always first check immovable property. If it is immovable property, great, story is over. If it is not immovable, we will straight away dump it under movable. Okay, this was your question number 25. Now comes question number 26. Even this question is from a mock test paper, second mock test paper. This question is from section 6 of GC Act, which talks about repeal. I'll give you a super quick revision of repeal first. Throughout this revision, we will keep one common example in our mind. We earlier had the Companies Act 1956. That one was repealed, and in its place, the Companies Act 2013 was reenacted. Keep this one simple example in mind and now listen. The 1956 Act was repealed. After the repeal, we cannot revive anything during the period for which repeal is made, which means once the act is repealed, now it is dead. We cannot revive it again. First point. Second point, the repeal will not affect anything performed under the repealed act. Now, under the 1956 Act, let's say a director was appointed. Under the 1956 Act, let's say a company was incorporated. Under the 1956 Act, let's say some merger happened. Now, whatever already has happened under the repealed act, it will still stay valid. Repeal will not affect anything which is performed under the repealed act. So, whatever happened under the 1956 Act will still stay valid. Then comes the third point. The repeal will not affect any claim, privilege, responsibility, or debt under the repealed act. Under the 1956 Act, let's say the company borrowed a loan. Under the 1956 Act, let's say the company lent a loan. So, whatever claims, privileges, responsibilities, and debts the company had under the old act, they will still continue as it is. Okay. Then repeal will not affect any punishment sustained with respect to an offense committed. Let's say under the 1956 Act, you committed one offense long back, and for that offense, you were given some punishment. Okay. Now, if the 1956 Act is repealed, doesn't mean your punishment is repealed. No, repeal will not affect the punishment. So your punishment will still continue. Let's say the court had awarded you 10 years imprisonment. Now, right now, only 6 years imprisonment is over. 4 years imprisonment is still left for you. And let's say the 1956 Act is repealed. Now, you cannot say that Act itself is repealed, so punishment is also over. You can't say like that. Your punishment will still continue. Repeal will not affect any punishment. And lastly, repeal will not affect any inquiry, litigation, or remedy initiated before such repealing. What this means is the 1956 Act was repealed. Now, before the Act was repealed, before the repeal itself, let's say some case was filed against the company. Now, that case will still continue. Under the 1956 Act, it will still continue. So, the repeal will not affect any inquiry, litigation, or remedy initiated before repealing. So, before the Act was repealed, before that, if any case was filed before the court, that case will still continue under the 1956 Act. Okay. So, 5 points with respect to repeal. Very, very important point. Now, come to the question. Which of the following statements is correct with respect to the effect of repeal? Totally how many statements? Totally 4 statements they have given to us. We have to say which of these statements is correct. Okay. The first statement, where a central act repeals any enactment unless a different intention appears, repeal shall not revive anything not in force or existing at the time at which repeal takes effect. Yes, guys, the statement is correct. The very first point we saw over here, repeal will not revive anything during the period for which repeal is made. So that's what they're saying even over here. Repeal will not revive anything. First sentence is correct. Second sentence, repeal shall not affect the previous operation of any enactment so repealed or anything duly done or suffered thereunder. Basically, they're saying whatever you have already done or suffered under the old act will not get impacted. Perfect, guys. This is nothing but the second point. Repeal will not affect anything which is already performed under the repealed act. So even this sentence is correct. Third sentence says, repeal shall not affect any right, privilege, obligation, or liability. This is nothing but your third point. Repeal will not affect any claim, privilege, responsibility, or debt. So even this point is correct. Fourth point says any legal proceeding or remedy in respect of any such right, privilege, obligation, liability, penalty, forfeiture, or punishment cannot be continued after repeal. Are you understanding? Read again. Legal proceedings or remedies in respect of these right, privileges, obligations and all cannot be continued after repeal. Wrong. We learnt over here that repeal will not affect litigation. The legal proceedings, the cases will still continue under the old act, I told you. So this sentence is definitely wrong, because this sentence is saying legal proceedings will not continue. Wrong. Legal proceedings will still continue. Repeal will not affect legal proceedings. The repeal will not affect any litigation which was initiated before the repealing. So this sentence is definitely incorrect. So my first 3 sentences are correct. So 1, 2, 3, option A. Okay, this was a small reminder of section 6 for you, the repeal related section. Okay, so repeal will not, see, this particular concept is super important, guys, not necessarily from MCQ point of view, but even from a descriptive point of view. They can straight away give you, a straightforward question asking you the effect of repeal. You just have to write these 5 points in your answer paper, that's all. So be very, very strong, very, very confident about this concept. Okay, so this was your question number 26. With this, we're done with our GC Act discussion. Now come on, guys, come to question number 27. This is from your interpretation of statutes. This question is from your September 26 RTP, and this question is all about your Hayden's rule. Okay, let me give you some reminders about Hayden's rule first, and then we will enter into the question. Hayden's rule is something very simple. Hayden's rule will apply when the language in the statute is capable of more than one interpretation. See, if only one interpretation is possible, if only one interpretation is possible, if there is no confusion, then Hayden's rule will not apply. Hayden's rule will apply only if multiple interpretations are possible, then only to eliminate the confusion, this rule will apply. Okay. And by the way, this is one of the primary rules of interpretation. Okay. So point number one, when do you apply this rule? Whenever the statute is capable of more than one interpretation, that is when you apply this rule. Point number one. Point number two, this particular rule says that the court is supposed to consider four matters. On the basis of these four matters, they are supposed to pick that interpretation which will advance the remedy and suppress the mischief. You'll understand this, don't worry. Be a little patient, you'll get it. So, point number one, again, it's one of the primary rules of interpretation. Point number two, we applied this rule only when multiple interpretations are possible. Point number three, this particular rule says the court is supposed to consider four matters, and on the basis of four matters, the court is supposed to pick that interpretation which will advance the remedy and suppress the mischief. Now listen to me. What are the four matters? The first point. What was the law before making the act? Then point number two. What was the mischief or defect or hardship in the earlier law? Then how does the parliament seek to resolve or cure the mischief? And lastly, what is a true reason for the remedy? Basically, in simple words, there was earlier one law. Okay, in this law, there was some problem. That problem is called as mischief. Now, to rectify this mischief, the parliament, the legislature, either they have amended this law itself or they have brought in some new act to in place of this old act. Okay, so there's already a law, and in that law there's some problem, there's a mischief, and to rectify the mischief, to solve the problem, they either amended this act or they brought in a new act. Alright, so now when we interpret this amended act, when we interpret this new act, we also have to keep in mind what was the problem to solve which this new act was created. Understood? It's actually very simple. All this just complicates it unnecessarily, but the basic premise is simple. I'll repeat once again. There was already one law, and in that law there is some problem. That problem is called as mischief. To rectify the mischief, to rectify the problem, to solve the issue, the legislature either amended this act or they brought in a new act. So now, when you're interpreting this new act, you have to keep in mind that what was the problem that was existing before, because the whole objective why this new act was made was to solve this problem. So when you're interpreting this new act, you have to keep in mind that what was the problem existing earlier, to solve which this new act was brought in. Okay, and then lastly, when the court applies the Hayden's case, they will be bound to look at the state of law at the time of passing the enactment. This is nothing but what I told you. When the court is interpreting this new act, they will not interpret it standalone. No, they will keep in mind what was the state of affairs earlier. So they will keep in mind what was the situation at the time when the act was passed. Alright. So totally 4 points I told you over here. Point number one, Hayden's rule is one of the primary rules of interpretation. We apply this rule when the language of the statute is capable of more than one interpretation. Basically, if there is no confusion, then we don't apply this rule. Only when there are multiple interpretations possible, that is when we apply this rule. Point number one. Point number two, this rule says that the court will look at these four matters. On the basis of these four matters, the court will choose that interpretation which will advance a remedy and suppress the mischief. Advance the remedy and suppress the mischief. What are the four things? Number one, what was the law before making the act? What was the earlier law? And in that earlier law, what was a mischief, defect or hardship? And then, how does the parliament seek to resolve or cure the mischief? And lastly, what's the reason for the remedy? So on the basis of these four matters, they will choose that interpretation which will advance the remedy and suppress the mischief. That is, in simple words, when they are interpreting this new act, they will keep in mind what was the problem which was existing earlier. Basically, me what was the problem that was existing earlier to solve which this new act was created. Then they will interpret this new act in such a way that the problem gets eliminated and the remedy gets advanced. Okay, now come to the question. It's an RTP question. It's a very good question, guys. Read it carefully with me. Prior to 2024, the State Environmental Protection Act imposed penalties only on factories that directly discharged untreated waste into rivers. Over time, several industries began outsourcing waste disposal activities to third-party contractors. Although these industries were the ultimate source of the waste, they escaped liability because they were not the direct polluters under the existing law. Understanding? So, as per the State Environment Protection Act earlier, only if you directly discharged the waste into the river, only then you were punished. So here, the main word that you should look out for is this word directly. So as per this particular act, only if you directly dispose the waste into the river, only then you are punished. So the industries found a loophole. What the industries started doing is, they first disposed their waste to third parties, and the third parties only disposed them into the river. So from industry's point of view, they did not directly dispose to the river, so they escaped the punishment. Got the whole point, guys? They started indirectly transferring the waste into the river, and that's how they escaped punishment. To address this issue, the legislature amended the act by inserting the following provision: any person who causes or contributes to the pollution of river, whether directly or indirectly, shall be liable for the prescribed penalty. So the law was amended, and now the law says, whether you discharge the waste directly or whether you discharge it indirectly, if you discharge waste into the river, you will be punished. Okay, so earlier, what was the mischief, guys? The mischief, the problem, the hardship was this word directly. Because of this word directly, industries found a loophole. This was a mischief. To rectify this mischief, to solve this problem only, the legislature amended the act and they said directly or indirectly. That way they are trying to capture the loophole. Subsequently, Green Earth Limited engaged an independent contractor for waste disposal. Contractor illegally discharged hazardous waste into the river. Green Earth Limited contended, since it did not directly release the waste, the amended provision should not apply to it. Wrong, guys. We just learned the Hayden's rule. In this situation also, we have the amended act. When we are interpreting the amended act, we will keep in mind what was the mischief earlier. We will keep in mind what was the problem earlier. So earlier, in the earlier act, this was a whole problem, that we were focusing only on the word directly. So therefore, indirect discharge of waste was not being punished. So to rectify that mischief only, this amendment was made. So we will keep in mind the mischief that was existing earlier, and we will interpret the law in such a way that we advance the remedy and suppress the mischief. So the interpretation that we will give now is that whether you discharge the waste directly into the river, whether you discharge the waste indirectly into the river, doesn't matter. In both the cases, punishment will be attracted. So therefore, Green Earth Limited, you are again doing indirect transfer of waste to the river, so you will be punished. You cannot escape the punishment. Okay, so this is the whole Hayden's case, guys. When you're interpreting the law, you have to keep in mind what was a mischief existing earlier, what was a problem existing earlier, to solve which this new act was made. So you have to keep that in mind when you're interpreting the new act. So same way, when we interpret the amended act now, we have to keep in mind that earlier there was this problem because of this word directly. To solve this problem only, this amendment was made. So we have to interpret the new act in such a way that we advance the remedy and suppress the mischief. Okay, so the interpretation now will be in this case that Green Earth Limited will be punished. Basically, Green Earth Limited has made an indirect discharge of waste into the river, and it is to prevent these kind of evasions only the amendment was made. So therefore, Green Earth Limited, you will be punished. Even indirect discharge of waste into the river also will be punished. So that's it, guys. This was your question number 27. Now come to question number 28. This is where we enter into FEMA. Now question number 28, before I start this one, let me give you a quick reminder from Schedule 3, Current Account Transactions, Schedule 3. So Schedule 3 has those transactions for which we require prior RBI approval. So one of the points in the list is remittance for donations. So if a non-individual is remitting foreign exchange for the purpose of donations, and if this remittance is more than the limit, then in that case RBI approval will be required. Remittance for donations more than the limit, RBI approval will be required. The question now is, what is the limit? The limit is 1% of the foreign exchange earnings of 3 preceding financial years, or $5 million, whichever is lesser. That's all, guys. So if a non-individual is remitting foreign exchange for the purpose of donation, then if the remittance is more than the limit, then only RBI approval is required, and this is a limit. Okay, keep this in your mind. And now come to the question. The question says XYZ Limited is a reputed Indian construction company. It's a company, it's a non-individual. It has its operations in multiple countries. Company has earned foreign exchange $200 million, $300 million, and $400 million during previous 3 financial years respectively. So 3 preceding financial years, the foreign exchange earnings they have given $200 million, $300 million, and $400 million. In the current year, company intended to remit the following at the same time: $4 million as contribution to a technical institution in USA conducting engineering studies in the construction field, $3 million donation to creation of chair in the memory of company's founder in reputed university in UK. So this contribution, this donation, both will come under this donation point. The directors are of the opinion that since not one of the above foreign remittance individually exceeds the limit specified by RBI, no prior approval is necessary. Directors are saying that no prior RBI approval is required. Then the question says, with reference to the provisions of FEMA, determine whether XYZ Limited can make the remittance without prior RBI approval or not. So basically we have to say whether for these transactions RBI approval is required or not. Okay. Before I even proceed with the thinking part, let me give you one small reminder over here. See, you might have a doubt, some of you, that ma'am, okay, for the second point they have used the word donation. We are applying this concept, understandable. But for the first point, they're not even using the word donation. They're saying contribution to a technical institution in US. How is this donation? If you're wondering about that, let me remind you. If you look at Schedule 3 donation point, if you look at the donation point, it clearly gives us 3 transactions in the donation point, guys. The first transaction is creating chairs in reputed educational institution. So this second point over here is also creation of chair only. So the second point is fitting under the first point, creating chairs in institutes. The second point is contribution to funds promoted by educational institute. Third point, this is relevant for us in this question, contribution to a technical institution which is in the same field as a donor company. The company over here is in construction field. And in this first point, the company is making contribution to a technical institution in the same construction field. So this first point, this $4 million point, is fitting under the third point over here. The company is making a contribution to a technical institution which is in the same field as a company. Company is a construction company. It is making contribution to a technical institution which is in the same field as the company. So I'm just showing you that both the points are actually coming under the donation concept over here, because in the donation concept we have 3 transactions, and out of the 3 transactions, the first transaction and the third transaction both are covered in this question. That is why I am applying the donations concept first of all. Okay. Now listen, let us apply the limits. The limits, the first point over here is 1% of foreign exchange earnings of 3 preceding financial years. So 1% of 200 million plus 300 million plus 400 million. This is going to be what? $9 million, right? $9 million or $5 million, whichever is lesser. So what's going to be your limit now? $5 million. So the limit up to $5 million, this company can remit without any RBI approval. If you remit more than $5 million, then RBI approval will be required. Here, this company has remitted how much? They are remitting 4 million, 3 million, total 7 million they are remitting. 7 million, guys, it is more than $5 million. Therefore, here RBI approval will be required. Understanding? So 2 donation transactions we are having. The limit is 1% of foreign exchange earnings of 3 preceding financial years or $5 million, whichever is lesser. $5 million is lesser, but we are emitting $7 million, which is more than $5 million. Therefore, RBI approval will be required. They're asking, can they make the remittance without prior RBI approval? Your answer will be no, they can't make without RBI approval. RBI approval is required. Okay, this was a simple question, direct application of this concept. But the reason why I wanted to do this question for you is, some of you might not have been able to connect this point with the donations concept. That is the whole reason why I wanted to show you that Schedule 3 actually gives us the breakup, that 3 transactions are covered under the donations point, and both of these transactions which they have given to us in the question, both actually come in those 3 points. Okay. This was the first question in FEMA. Now come to the second question. This is from your second mock test paper. It's a proper full-fledged FEMA question, guys. It touches upon concepts which students might find a little difficult in the exam. So listen to me carefully. Two things this concept is touching upon. First is residential status. See, if a person leaves India for three purposes, then that person becomes PROI. I don't care about his 182 days criteria. If you leave India for any of three purposes, you will become a PROI. What are the three purposes? Number one, if you're leaving India for the purpose of employment outside India, or if you're leaving India to take up some business or some vocation outside India, or if you're leaving India for any other uncertain period. So if you are leaving India for any of these three purposes, I don't care about your 182 days criteria. If you're leaving India for any of these three purposes, you will become PROI. Story over. This was your first reminder, guys. Then comes your next reminder, the meaning of capital account transactions and current account transactions. Capital account transaction, don't forget, they are those transactions which will alter your assets and liabilities. If you are a PRI, a capital account transaction will alter your assets and liabilities outside India. If you are PROI, capital account transaction will alter your assets and liabilities in India. So basically, capital account transaction, the basic criteria is that they will alter your assets or liabilities. If you are PRI, capital account transaction will alter your assets or liabilities outside India. If you are PROI, capital account transaction will alter your assets or liabilities in India. Okay. Then what is current account transaction? Current account transaction means any transaction which is not a capital account transaction. It includes payments in the ordinary course of business. It includes payments relating to interest on loan, income from investments. It includes remittances for living expenses of parents, spouse and children. So remittances for living expenses of parents, spouse and children, this is the main point which is relevant in this question. Even this is coming under current account transactions. And then lastly, foreign travel, education expenses and medical expenses, all this will come under current account transactions. And the last reminder, current account transactions are generally freely permitted. Only if they have mentioned in the, only if in the schedules, if they have mentioned that central government approval is required or RBI approval is required or it is prohibited, only if it is mentioned, only then those provisions will be applicable. But if nothing is mentioned, by default, current account transactions are freely permitted. Okay. Like for example, if I do a transaction and if it is not fitting under schedule 1, not fitting under schedule 2, not fitting under schedule 3. See, schedule 1 are the prohibited transactions. Schedule 2 you require central government approval and schedule 3 you require RBI approval. But if I did a transaction which is not fitting under any of these schedule, then the transaction is freely permitted. I don't require anybody's approval for that. Okay. So total 5 reminders I've given you, giving you a revision of the revision once again. Point number 1, if a person leaves India for any of these 3 purposes, that person will automatically become PROI irrespective of the 182 days criteria. Point number 1. Point number 2, capital account transaction. Remember the basic criteria. It alters assets and liabilities. Current account transaction is a transaction which is not a capital account transaction. Remittances for living expenses will also come under current account transactions. If a current account transaction is not fitting under schedule 1, schedule 2 or schedule 3, if it is not fitting under any of the schedule, then by default current account transactions are freely permitted. Okay. Keep this in your mind and now come to the question. The question says Mr. Arjun Verma, an Indian citizen, left India on 15th June 25 to take up employment with a company in Germany. So guys, he is leaving India for the purpose of employment. He is leaving India for one of the 3 purposes. So therefore on 15th June 25, because he is leaving India for any of the 3 purposes over here, he will become PROI. Are you noticing? I did not even check 182 days, guys. You're leaving India for the purpose of employment. That's all, you will become PROI. Then the question says, he had been residing in India prior to that. I don't care. During his stay in Germany, he continued to hold a savings bank account in India and he also remitted funds periodically to his aging parents in Mumbai for their medical treatment and household expenses. Understanding? He is a PROI. Even though he left India, even though he's gone to Germany, even though he's taking up an employment in Germany, he is still maintaining a savings account in India. Okay. And he's remitting funds from Germany. He's sending money to India to his parents in Mumbai for their medical treatment and household expenses. Be careful. Here, it is not outward remittance, it is inward remittance. From Germany, he is sending money to India to his parents. Okay. Then the question says, in March 2026, Mr. Verma decided to purchase a residential flat in Pune for his parents' use. So apart from sending money for their medical expenses and household expenses, apart from that, he is also going to send money to buy a house for his parents. He remitted $200,000 from his Germany bank account to India for this purpose. Around the same time, he also wished to invest in equity shares of an unlisted Indian company through NRO account. So he's trying to do multiple transactions over here. What are they asking us? Examine with reference to the provisions of FEMA what is the residential status of Mr. Arjun Verma under FEMA for the financial year 25-26. From what date does this status change? See, he leaves India for any of the three purposes on 15th June 25. So on 15th June 25, he becomes PROI. Before that, he was PRI, but when he leaves India for any of these three purposes, he will become PROI. First question was simple. Second question, whether remittance is made by Mr. Verma to his parents for medical treatment and household expenses, is it permissible? So first thing they're asking is that remittance permissible or not? And then whether they would be classified as current account or capital account transactions. So two things they are asking us in the second subdivision. Simple only, guys. Both the things that they're asking us is about the remittance for medical treatment and household expenses. So they're not even asking us about this remittance for the flat. They're not even asking us about this buying equity shares and all. They're focusing only on the first para, that Arjun is sending money to India for his parents' medical expenses and household expenses. So they're asking us about this transaction, whether it is current account or capital account transaction, question number 1. And question number 2, whether it is permissible or not. First tell me, is it current account transaction or is it capital account transaction? Capital account transaction will be a transaction which alters your assets and liabilities. Now over here, Arjun is just sending money for his parents' medical expenses and household expenses. So it is not going to alter his assets and liabilities, right? He is PROI. This transaction is not going to alter his assets and liabilities in India. So therefore, it is not a capital account transaction. It will become a current account transaction. In fact, remitting money for living expenses of parents, then remitting money for medical expenses, all this clearly comes under current account transactions. So yes, number 1, it is not capital account transaction because it does not alter Arjun's assets or liabilities in India. So it is not a capital account transaction. It automatically becomes a current account transaction. This is to answer one part of this question. Then they are asking us, is it permissible or not? See, you can't apply LRS and all over here. LRS will apply only if the person is PRI, but he is PROI. So you can't apply LRS and all. And also one more thing, don't forget, here it is not outward remittance. Instead, from Germany, he is sending money to India. So it's a current account transaction. It is not covered under any of the schedules. So if a transaction is not covered in any of the schedules, by default, it becomes a permissible current account transaction. Permissible current account transaction means no approvals are required. Okay, simple, guys. So first they asked us the residential status. So Mr. Arjun's residential status was PROI because he was leaving India for 3 purposes. So on the day on which he leaves India, on that day he becomes PROI. Then their whole focus was on the remittance for medical expenses and household expenses. It is not a capital account transaction because it is not altering his assets and liabilities in India. Arjun is PROI and the transaction is not altering his assets and liabilities in India. So it is not a capital account transaction. It becomes a current account transaction. In fact, we also get confirmation because living expenses, medical expenses are outrightly covered in current account transactions definition. Definitely it's a current account transaction. And one more thing, remember, LRS and all will not apply over here. LRS applies only if the person is PRI. But here you are PROI. So therefore even LRS will not apply. And secondly, it is not outward remittance. Instead, from Germany, he is sending money to India. Now this transaction is not covered in any of the 3 schedules. Therefore, it's going to be freely permitted. Now come on, guys, come to question number 30. But before we read the story, let me give you a reminder. Reminder number 1. The first reminder is from Schedule 2, Current Account Transactions Rules. So Schedule 2 talks about those current account transactions for which we require central government approval, guys. So in those current account transactions in Schedule 2, there is one point with regard to advertisements. So advertisement in foreign print media. Do you remember learning? So if the person is state government or its PSU, and if you're going to draw foreign exchange for advertisement in foreign print media, and if the amount is more than $10,000 and the advertisement is not relating to tourism, not relating to foreign investment, not relating to international bidding, then in that case prior central government approval will be required. See, what are the conditions? Number one, you're making an advertisement where in foreign print media. Condition number one. Condition number two, how much foreign exchange are you drawing for this? More than $10,000. Condition number three, who are you? Either you are the state government or you are state government's PSU. Fourth condition, why is this advertisement being made? What's the purpose? The purpose is not tourism, not foreign investment, not international bidding. Four conditions, guys. If these four conditions are fulfilled, then prior central government approval is needed. Point number one. Reminder number one. Then comes reminder number two. LRS, Liberalized Remittance Scheme. When does this scheme apply? See, the scheme applies when the aggregate of the transactions is within $250,000. So total foreign exchange which you are withdrawing is, if it is within $250,000, then in that case RBI approval is not required. This is what LRS says. But however, what if the aggregate is more than $250,000? If it exceeds a limit, then RBI approval will be required. Whatever is the excess above $250,000, for the excess RBI approval will be required. But however, I hope you remember learning emigration, education, medical treatment. Remember, in LRS you specifically have these 3 points. If you make a foreign remittance, if you draw foreign exchange for these 3 purposes, emigration, education or medical treatment, even if you are drawing foreign exchange more than the limit, even if you're drawing foreign exchange more than $250,000, still RBI approval will not be required if the amount is so required. Like for example, let's say you are drawing more than $250,000 for education purpose, but it is so required by the university. So if it is so required, then in those cases, even though you are withdrawing more than the limit, still RBI approval will not be required. But please remember, this point will be applicable only if you are drawing foreign exchange more than the limit. Then only we will say that okay, even though you are withdrawing more than the limit, still it's okay. It is so required by that particular country for immigration, or it is so required by that particular educational institution, or it is so required by that particular hospital. So in that case, even though you are drawing foreign exchange more than the limit, still it's okay. RBI approval is not required. Okay. So 3 points in LRS. And then one last reminder, guys. If you are a PRI, okay, and if you have some immovable property or foreign currency or foreign security outside India, you are a PRI and you have assets outside India which you had inherited from PROI. Right now you are PRI, you have inherited some assets, those assets are outside India, you have inherited them from PROI. This is allowed. You can continue to HOTI. Remember HOTI abbreviation. You can continue to hold. You can continue to own. You can continue to transfer. And you can also invest from this asset. So if you're a PRI and if you have an asset outside India which you had inherited from PROI, you can continue to hold, own, transfer, invest. No approvals will be required. So 3 big reminders I've given you. Reminder number 1, in schedule 2, you have this foreign print media point. If you draw foreign exchange for advertisement in foreign print media, and if the amount is more than $10,000, and if you are state government or its PSU, and the advertisement is not for these 3 purposes, then in that case, prior central government approval is required. Reminder number 2, LRS, if your aggregate drawal of foreign exchange is within $250,000, RBI approval is not required. But if you draw foreign exchange more than the limit, then for the excess RBI approval is required. But however, if you're drawing more than the limit for these 3 purposes, immigration, education, medical treatment, for these 3 purposes, if you draw foreign exchange more than the limit, then in that case, even though you're exceeding the limit, still RBI approval is not required if the excess is so required by the country of emigration, or if it is so required by the educational institution, or if it is so required by the hospital, then in that case, even though you're drawing more than the limit, still RBI approval is not applicable. But please don't forget, this point will apply only if you're drawing foreign exchange more than the limit. And then the last point, please remember, if you happen to be a PRI and if you have some asset which is outside India, which you had inherited from PROI, you can continue to hold, own, transfer and invest. RBI approval is not required. That's all, guys. Now come on, have a look at the question. The question says ABC Infrastructure and Broadcasting Limited, Government of India PSU. Guys, it's a Government of India public sector undertaking, which means it is a central government PSU, not a state government PSU. It's a central government PSU. It is engaged in infrastructure and satellite television operations, proposed to undertake foreign exchange transactions. Company needed to make a remittance of $18,000 for advertisement in foreign print magazine for brand building and not for tourism promotion, foreign investment promotion, or international bidding. Tell me, for this $18,000, will central government approval be required? That advertisement point, central government approval is required only if you are state government or state government PSU. But here the entity happens to be central government PSU. Therefore, it will not fit under this point, guys. So is any central government approval required for this transaction? No, central government approval will not be required. For the foreign print media point, central government approval will be required only if the person is state government or state government PSU. Here central government PSU, so no approval required. Then the question says, company also needed to pay consultancy fees of $11.5 million to a foreign firm for a highway project in India. It obtained in principle approval from Information and Broadcasting Ministry to make the advertisement and also to pay consultancy fees. So this transaction is about some consultancy fees. And the question says we have also received approval from Information and Broadcasting Ministry for this transaction. So we'll come to this when we look at the MCQs. Then the question says Mr. Rohan Mehta, a director in AIBL and resident in India, proposes during the year to remit $210,000 for his daughter's higher education abroad. So Mr. Rohan Mehta, he is resident in India, so he is a PRI. He is remitting $210,000 and this is for the purpose of his daughter's education abroad. Then he's remitting $70,000. What is this for? Gift to his sister residing in Australia. University where his daughter studies requires tuition fees payment of $150,000 only. The balance being for associated education cost. So total $210,000 he wants to send for education. Out of this $210,000, the tuition fees which is required by the university is $150,000 only. So the balance $60,000 is for other education purposes. Okay. Then the question says, he has not made any other remittances during the financial year. So come on, let's interpret this entire para till here. See, total he has remitted how much? Total he has remitted $280,000. Tell me, for this will RBI approval be required? I'm of course asking about RBI approval because these are clearly Schedule 3 transactions, guys, current account transactions, Schedule 3 transactions. So therefore it will come under RBI approval. But however, because it is Schedule 3 current account transactions, I can also apply LRS over here. Now LRS says if you're remitting up to $250,000, then RBI approval is not required. Here I'm remitting more than the limit. I'm remitting more than $250,000. So therefore, what is the excess? The excess is $30,000. For this extra $30,000, yes, RBI approval will be required. Getting it? So I went step by step. I had asked you the question that whether any approval is required or not. I was asking you specifically about RBI approval because all these transactions are current account transactions and they come under Schedule 3. Schedule 3 comes under RBI approval. But whenever you require RBI approval, you think about LRS first. LRS says if you're remitting up to $250,000, RBI approval is not required. But here I'm remitting more than the limit. Therefore, yes, RBI approval will be required. For the excess, RBI approval will be required. Now here some students will get confused. Some students will think that ma'am, $150,000, it's as per the estimate given by the educational university. Therefore, this amount should not even come into my LRS discussion. Like this, some of you might think. So if you're getting confused like that, let me tell you once again that I will apply this point, okay, that immigration, education, medical treatment, these three purposes, even if the forex drawn is more than the limit, still RBI approval is not required. If it is so required, then RBI approval is not required. I will apply this point only if I draw foreign exchange more than the limit for these purposes. Here for yes, education purpose, I have drawn money, $150,000. But is it more than the limit? No, it is within the limit. This $150,000 is within the limit. So I can't apply this particular point on $150,000. So my simple conclusion is going to be the total $280,000 is what we want to draw as foreign exchange. It is more than the limit. Therefore, for the extra, RBI approval will be required. Okay. Then the question says Mr. Rohan Mehta inherited a property outside India from his resident father, who in turn inherited it from his father. The grandfather of Mr. Rohan Mehta had purchased a foreign property when he was working outside India. So we have Mr. Rohan Mehta, we have Rohan Mehta's father, and we have Rohan Mehta's grandfather. So his grandfather was working outside India. So let's say the grandfather was PROI. So when he was PROI, he had purchased some immovable property outside India, which was inherited by his father, which was inherited by Mr. Rohan. So for Mr. Rohan, this property will become a property outside India, which he has inherited from PROI. So this he can continue to hold, own, transfer, invest. No approvals are required. Basically, this point is nothing but what we learnt over here. PRI, Rohan Mehta, he has some immovable property outside India, which he inherited from PROI. He inherited it from his grandfather. He can continue to hold it. He can continue to hold it. He can continue to own it. No approvals are required. Okay. Now, come on, let's have a look at the questions. If AIBL needs to remit $18,000 for the corporate advertisement in foreign print magazine purely for brand building, not for tourism promotion, foreign investment promotion, or international bidding, choose the correct option. Remember that foreign print media, at that point we had concluded already that central government approval is not required. We concluded it already. The reason was, for the foreign print media point, CG approval is required only if the person is state government or state government PSU. But here our entity is central government PSU, therefore central government approval is not required, we concluded. So which option is correct? Prior approval is not applicable. Then remittance is freely permissible as it is a current account transaction for business purpose. Yes. Option D says remittance is permissible as it had obtained the consent of Information and Broadcasting Ministry. No approvals are required. So option A, freely permissible. Only if the entity happened to be state government or state government PSU, then only approval would be required. Then comes the next question. In light of the LRS, which of the following is correct for the proposed remittance? Even the LRS point, we have concluded that the total amount we're remitting is $280,000, which is more than the limit. So the excess of $30,000, for that we will require prior RBI approval. So let's look at the options now. The entire $280,000 can be remitted without approval. No, we require approval for $30,000. Only $250,000 can be remitted under LRS without approval. Prior RBI approval is required for the excess $30,000. Yes, this is exactly what we concluded. For the excess $30,000, we require RBI approval. Option B. Now come to the last question. Choose the correct option from the following pertaining to the legality of inheritance. Inheritance point, we concluded it is perfectly valid. No approvals are required. We just applied this point from section 6. The inheritance is not valid. Wrong. Inheritance is valid as he inherited from a person who has validly inherited from a person who was resident outside India. Yes, option B. This is what happened in this question, guys. Rohan inherited the asset from his father, who had inherited from his father, who was a PROI. So at the end of the day, our person, Mr. Rohan Mehta, who is PRI, he is having immovable property which he has inherited from PROI from his grandfather, which he can continue to hold, own and all. So therefore, option B, inheritance is valid. Option C, if you see, inheritance is valid only if Rohan Mehta gets approval from RBI. No approval is required. We already concluded that. Option D says inheritance is valid only if both Rohan Mehta and his father get prior approval. No, approvals itself are not required. You are a PRI. You have inherited an asset outside India from your father, who in turn inherited from his father, who was PROI. So at the end of the day, PRI has inherited the asset from PROI. You can continue to hold, own, transfer, invest. No problem. No approvals are required. Okay. This was question number 30. Now come to question number 31. Even this is a case-based MCQ. This is from your mock test paper. So let me give you some reminders first. Then I will start the MCQs for you. The first reminder is regarding current account transactions, Schedule 3. So Schedule 3 current account transactions are those transactions where you require RBI approval, guys. So one of those transactions for non-individuals is about remittance for consultancy services. Now remittance for if you draw foreign exchange for remittance for consultancy services, if it is more than a limit, then in that case RBI approval is required. So now what is a limit? If you are remitting money for infrastructure project, your limit is $10 million per project. For other project, your limit is $1 million. So if you draw foreign exchange to remit for consultancy services more than the limit, if the remittance exceeds the limit, then only RBI approval is required. Okay, so first point, Schedule 3 transaction. Schedule 3, remember we saw the donation point also earlier. Even that was for non-individuals. Even this point is for non-individuals. So if you're a non-individual and if you're remitting money for consultancy services more than the limit, then only RBI approval is required. What is a limit? The limit depends upon consultancy is relating to what. If the consultancy is relating to infrastructure projects, then your limit is going to be $10 million. If it is for other projects, the limit is going to be $1 million. Okay. Then comes the second point. The second point is all about residential status. See, what do we already know about residential status? We know if a person leaves India for 3 purposes, then in that case, irrespective of the 182 days criteria, this person will become PROI. Similarly, one more point now, if a person comes to India for the same 3 purposes, I don't care about the 182 days criteria, that person will become PRI. Okay, so if a person comes to India for the same 3 purposes, that person becomes PRI irrespective of the 182 days criteria. What are the 3 purposes? Same 3 purposes, guys. Either he's coming to India for employment purpose, or you're coming to India for business or vocation, or you're coming to India for any other uncertain period. So, I was telling you 2 points I have to tell you in residential status. This is the first point, that if a person comes to India for 3 purposes, he becomes PRI. You already know if a person leaves India for 3 purposes, he becomes PROI. That you already know. One more point now. If a student leaves India for education, that student will immediately become PROI. This point is mentioned in RBI circular. If a student leaves India for education, he will immediately become PROI. Okay, guys. So 2 reminders I've given you. One is regarding remittance for consultancy services. Remember the 2 limits. Then the second reminder was about residential status. Now come on, let's have a look at the question. Let's see what the story says. Aqua Nova Infrastructure Limited, an Indian project engineering procurement and construction company, was awarded 9,500 crore contract by the government of Tamil Nadu in April 25 for constructing smart multi-purpose dam integrated with AI-enabled flood management system. So basically, it's a construction company, infrastructure company. Okay. To execute the project, AIL engaged Hydro Consult BV, Netherlands, for preparing techno-economic feasibility report, environment impact assessment, and digital twin modeling of the dam project. AIL paid $7 million towards consultancy fees. Consultancy fees, guys, paid by a company, paid by a non-individual. What's the limit? It is relating to infrastructure project. It is relating to building this dam and all. Limit is $10 million. But we are emitting $7 million only. Is it more than $10 million? No. So therefore, for this transaction, no approval is required. Had it been more than the limit, then RBI approval would have been required. Then comes the second transaction. TechSphere Solutions Limited, United Kingdom, for migration of its enterprise resource planning platform from SAP to Oracle Cloud ERP and implementation of AI-based financial reporting modules. AIL paid $2 million towards software migration and implementation services. Even this is going to be consultancy fees. But is this relating to the dam project? Be careful. The first transaction, the question clearly says that this is paid to Hydro Consult BV for techno-economic feasibility modeling of the dam project. It's clearly mentioned that the first transaction of $7 million is relating to the dam project. So which means it is an infrastructure project. That's why I applied the $10 million limit. But the second transaction, if you see, the company is making the payment of $2 million to TechSphere Solutions Limited, but this is relating to migration of its enterprise resource planning from SAP to Oracle. It is relating to implementing AI based financial reporting modules. So, this consultancy fees is not relating to infrastructure, other purpose. It is relating to financial reporting, it is relating to accounting, it is not relating to infrastructure. So, other consultancy fees, your limit is $1 million. Tell me, is it more than $1 million? Yes, guys, $2 million we are emitting over here. It is more than $1 million. So, for this transaction, prior RBI approval will be required. Okay. The first transaction was consultancy fees relating to infrastructure. Amount was $7 million only. It was within $10 million. No approval was required. Second transaction is also consultancy fees but not relating to infrastructure. $1 million limit will apply. Amount here is $2 million, which is more than $1 million. RBI approval will be applicable. Okay. Then the question says, simultaneously, company's chief sustainability officer's daughter, Ms. Shalini Gupta, enrolled in 3-year integrated global management program jointly conducted by IIM Ahmedabad and the University of Auckland, New Zealand. The course structure was as follows: first 2 years at IIM Ahmedabad, final year at University of Auckland under an exchange program. Tuition fees 10 lakhs payable to IIM Ahmedabad, $200,000 paid directly to University of Auckland. So in the final year, she is going to leave India. She is going to go to University of Auckland in New Zealand for the purpose of education. So because she is leaving India for the purpose of education, she will become PROY. Shalini left India on 20th August 25 for New Zealand. Because she is leaving for education purpose, on this date she becomes PROY. During the final semester, she secured employment with a multinational company in Auckland itself. She accepted the offer before completing the course. Then she visited India from 1st September 26 to 30th September 26. For these 30 days she was in India. She just visited India to meet her family, and thereafter she returned to New Zealand on 1st October 26 to continue her employment. Come on, tell me. Tell me about her residential status. Sequence of events is clear. First, she left India for the purpose of education. So when she's leaving India for the purpose of education, I will simply apply the RBI circular and I will say that she's a PROY. Then in New Zealand itself, she got the job. So she's still PROY. Then she's simply visiting India for 30 days. Is she coming to India for these three purposes? No. She's just visiting India and she's going to go back. It's only temporary visit. So this visiting India will not change her residential status. She will continue to be PROY only. So 20th August 25 when she leaves India for education purpose, since that date she is PROY only. Okay, now what are they asking us? Considering the provisions of FEMA, applicable current account regulations, which of the following statement is correct regarding AIL's payments to foreign entities? 2 consultancy payments were made. We concluded for one of them approval was not required, but for the $2 million transaction we concluded RBI approval is required. So AIL can remit $7 million and $2 million without approval. Wrong. For $2 million we need approval. AIL can remit $7 million without approval. Yes. But $2 million requires RBI approval. Correct. Option B. The first transaction, $7 million, this was infrastructure related. It is within $10 million. So therefore, here RBI approval is not required. But the second transaction was not related to infrastructure. Here the limit was $1 million. The amount is more than $1 million. Therefore, RBI approval is required. Okay. Then comes the third question. For the purpose of FEMA, what would be the residential status of Ms. Shalini Gupta? We concluded this also. When she left India for the purpose of education, she became PROY because of the RBI circular. Then she got the job also in New Zealand itself. Then she just visited India for 30 days. She did not come to India for these three purposes. No, she just visited India and she's going to go back. She did not come to India for any of these three purposes. So she's continuing to stay as PRI only. So resident in India? No. Resident in India? No. Non-resident from the date she left India for studies abroad and continues to remain non-resident after accepting employment abroad. Yes, option C. Then comes a fourth question, the last question. Which of the following statements is most appropriate under FEMA? AIL requires RBI approval for both remittances. And Shalini is resident in India because she stayed in India for more than 182 days. No, guys, this statement is not correct. We require RBI approval for only one transaction, the $2 million transaction, and also Shalini is PROI. So, first statement is definitely wrong. Then comes the second statement. AIL can make both remittances through an authorized dealer bank. All remittances, anyways, have to be through authorized dealer bank only. Only thing is, for one of them, we require RBI approval, but anyways, both have to be through authorized dealer bank only. Shalini is treated as person resident outside India from the date she left India for studies abroad. Correct, guys? The day on which she left India for studies, that day itself we called her as PROI. And both the remittances have to be through authorized dealer bank. We can't remit money through any other method. Any foreign exchange remittance has to be through authorized dealer only. Then AIL can make only consultancy payment without RBI approval. Software migration remittance requires approval. Correct. Shalini becomes non-resident only after accepting employment. Wrong. She becomes non-resident immediately when she leaves India for education. That time itself she becomes non-resident. Then both remittances require RBI approval. Wrong. Only one of them requires RBI approval. So my correct answer is going to be option B. Okay. So this is it with question number 31. So here are major reminders were number 1 about residential status, and number 2 this consultancy point. Remember the limits. If the consultancy is relating to infrastructure project, your limit is going to be $10 million. If the same consultancy is relating to anything else, your limit is going to be $1 million. Okay. This was question number 31, guys. With this, we're done with our FEMA questions. Now, I'm starting for you the last 4 questions, and these 4 questions are mixed, which means they touch upon multiple chapters at the same time. Okay. Focusing on question number 32 first. This is from your second mock test paper. Let me give you the reminders first. Now, under section 101, guys, which talks about notice. What is the mode of service of notice? We know very well that the company is supposed to send the notice of the meeting at least 21 clear days before the meeting to all the members. Now, how should this notice be served? The company has 3 options, guys. Either the notice will be sent personally to all the members, or the notice can be sent by post, or it can be sent by registered post, or it can be sent by speed post, or it can be sent by way of courier. And one more option, we have the third option, which is the company can send the notice electronically, which means the company can send the notice by email. But my discussion right now is about the second point. If the company is sending by post or registered post or by speed post or by courier, then to which address should the notice be sent? See, each member will have a registered address. So in case the company is sending the notice by way of post, it has to be sent to the registered address of the member. Now, sometimes what happens is this registered address of the member may be outside India. So, if the member does not have a registered address in India, that is, if the member's registered address is outside India, we don't have to send the notice outside India. So, if the member's registered address is not in India, then the company will request that member to give some address in India. So, the member will supply to the company some address which is in India for the purpose of serving the notice, and to that address company will send the notice. Okay, but again one more problem arises. What if the member does not give this address in India? He has given a registered address is outside India, so we requested him to give some address in India, but he's not giving. Then what to do? In that case, the company will simply give one advertisement in one newspaper which has wide circulation in the neighborhood. Neighborhood means area. In the neighborhood in which the registered office is situated, and that's all. Formality will be over. Okay, so when the company is sending the notice, the company can either send the notice personally or by post or electronically. In case the company is sending it by post, company should send the notice to the registered address of each member. In case that address is not in India, we will request the member to supply to the company some address in India for the purpose of serving of notice. If the member does not supply address like this, then in that case, company will simply give an advertisement in one newspaper which has wide circulation in the neighborhood where the RO is situated, and with that it will be deemed as if the notice has been served to the member. Okay, this is the first reminder which is required for us to handle question 32. Now one more reminder, this is about section 20, which you must have learnt in your MOA AOA discussion, guys. Section 20, which talks about service of documents to the company. This means if any person wants to send any document to the company, then to which address should it be sent, how should it be sent, all that will be covered over here. So if any person wants to send a document to a company, it has to be sent to which address? It has to be sent to the company's registered office address. Then in what mode, how will this letter be sent? It either has to be sent by way of registered post, or by way of speed post, or by way of courier, or it can be also sent electronically, or it can be simply be sent by leaving it at the registered office address. So three options we have. Number one, the document can be sent by way of registered post, speed post, or courier. Number two, it can be sent electronically. Number three, it can be simply left at the RO address. Simple, guys. But there's another basic point I want to let you know about this third method. Imagine I want to go to the company and I want to give a document to the company. So I want to personally go and leave it at the RO address. Now when I go to the registered office address, some person must be available over there who will collect the letter from me on behalf of the company. Basically, when you go to personally leave the document at the RO address, when you follow this third method, then in that case, somebody must be available at the RO address. Some authorized representative of the company must be available at the RO address who will collect the document on behalf of the company. Only then you can say that the service of document was proper. Okay, this will apply only in the third method. Alright, so two reminders I gave you. Reminder number one was about section 101 notice, that in case the company is sending the notice by way of post and all, then in that case company can send the notice only to the registered address in India. If your registered address is outside India, then we will request the member to give an address in India. If it doesn't give, we will simply give an advertisement in one newspaper having wide circulation in the neighborhood where the RO is situated. And your second reminder is, if anybody wants to send a notice to the company, they will send it to the RO address by any of the three modes. But if they are sending it by leaving it personally at the RO address, then somebody on behalf of the company has to be present at the RO address who will collect the document on behalf of the company. That's all, guys. Now come on, have a look at the question. It's an amazing question. The question says Nirmal Enterprises Limited wants to send notice of AGM to all its members. So my company is Nirmal Enterprises Limited. It wants to send notice of AGM to all the members. Company proposes to send the notice by speed post to the registered address of each member and additionally uploads the notice on website. Tell me, guys, is speed post okay? Yes, when we're sending the notice, we have all these options, and in this one of the options is speed post also. Company wants to send the notice by way of speed post, fine, it is allowed. Now one of the members, Mr. Kapoor, who resides abroad and has registered his email address with the company, contends that notice was not validly served on him since it was not sent to him by his email. See, understand, is sending by email mandatory? No, guys, company has three options. Company can send the notice by any of these three options. Company has decided that they will send the notice by way of speed post. Fine, company will send it by way of speed post. Now, just because the shareholder had given his email address to the company, it doesn't mean it is mandatory for the company to send the notice by way of email. No, it is not mandatory. So the shareholder, his contention over here, his contention is incorrect. This shareholder, he is living abroad, so his registered address is outside India. Ideally, he should give to the company some address in India and the company will send the notice to him at that address. Just because he has given his email address doesn't mean it is mandatory for the company to send him electronically. No, it is not mandatory. Okay. Then the question says separately, a legal notice addressed to Nirmal Enterprises Limited was delivered by hand at the RO of the company. So this is a separate matter altogether. Some document has to be delivered to the company. Some legal notice has to be delivered to the company, and it was delivered by hand. Delivered by hand means what? When we want to send documents to the company, we have three options. Leaving at the RO address. This is nothing but delivering by hand. So it was delivered by hand, that is, it was being left at the RO address. But at the time of delivery, the office was found locked and no representative of the company was present to accept it. Remember, I told you this method, this method of personally going and leaving the document at the RO address, this method will be complete only if some person is available at the RO address who will collect the document on behalf of the company. But here the question says that no representative of the company was present to accept it, which means this method was not completed properly. Okay, the sender left the notice affixed to the main door of the registered office. This is not valid method of sending notice. You should either send by post or electronically or by personally leaving it at the RO address. Personally leaving it at the RO address is not complete over here because a person was not available to collect the document on behalf of the company. So the document was not sent by prescribed mode over here. So therefore it's going to be invalid. Examine with reference to the provisions of Companies Act whether company's mode of sending the AGM notice to Mr. Kapoor was valid and whether his contention holds good. We have already discussed this point, guys. His contention is definitely incorrect. Just because a member has given his email address to the company, it doesn't mean it is mandatory for the company to send the notice by email. It is not mandatory. Company has sent over here by way of speed post. Speed post is a valid mode of sending the notice. Only thing is, the member, Mr. Kapoor, he has to give some address of his in India, then the company will send it to that address. Okay, that's the first point, that his contention is definitely invalid. Then comes the second question, whether service of legal notice on the company in the manner described is valid in law. This also we have discussed already. If any person wants to send any document to the company, they can send only by these three modes. Now in this question, if you see, it was not sent by way of post and all. It was not sent electronically also. It was sent by leaving it personally at the RO address. But this method is complete only if somebody is available at the RO address to collect the document on behalf of the company. Nobody was present. So therefore, even this method is not complete. Therefore, the legal notice was not served on the company properly. It was invalid. Okay, so both my answers, it is invalid. Mr. Kapoor's contention, even that is invalid. He cannot force the company to send the notice by email only. Then similarly, even over here, the way in which the legal notice was served on the company, even that was invalid. Okay, this was a very good question, guys. Now come on, let me take you to the 33rd question. This is from your September 26 RTP. It's a case-based MCQ. Let me give you some reminders first. Reminder number 1. Whenever a charge is created, the charge has to be registered, guys. Registration of the charge has to be completed within how much time? It has to be completed within 30 days from the date of creation of charge. Okay, so the first reminder, whenever the company creates a charge on any of its asset, whether floating charge, whether fixed charge, every charge has to be registered. Charge has to be registered within 30 days from the date of creation of charge. Then comes the second reminder, the instrument creating the charge has to be preserved for how many years? Do you remember learning? Instrument creating the charge has to be preserved for 8 years. 8 years from the date of satisfaction of charge. Okay, so point number 1, registration of charge has to be completed within 30 days after creating the charge. Second reminder, instrument creating the charge has to be preserved for 8 years from the date of satisfaction. Then comes your third reminder, amount received from an employee is not a deposit. This third reminder is from deposits chapter. In deposits chapter, you have the list of exclusions, right, which are not considered as deposits. One of those points is amount received from an employee. See, if the amount which we have received, if it is within his annual salary, which means it is not more than his annual salary. So employee has given money to the company and this money is not more than his annual salary and it is as per his employment contract with the company. And lastly, it is in the form of non-interest bearing security deposit. If all these conditions are fulfilled, then whatever amount this employee has given to the company, it's not going to be considered as deposit. It is going to be excluded from deposit. Simple, guys. 3 conditions. Employee has given money to the employer. It is within his annual salary. It is as per the employment contract and it is in the form of non-interest bearing security deposit. If all these conditions are fulfilled, whatever money employee has given to the employer, it is not deposit. Okay, this was the third reminder. And then comes the last reminder, if a quorum is not present within how much time? Quorum should be present within half an hour, within 30 minutes. If quorum is not present within 30 minutes from the appointed time, what will happen to the general meeting? The general meeting will get adjourned. But it will get adjourned to when? It will get adjourned to same day, same time, same place in the next week, or any other date, time, place. Who will decide? Board will decide. Okay. So 4 simple reminders I've given you. Reminder number 1, charges have to be registered within 30 days after they are created. Then reminder number 2, instrument creating the charge has to be preserved by the company for at least 8 years after the satisfaction of charge. Then reminder number 3, if the employee is giving money to the company, if it is not more than his annual salary, if it is as per the employment contract, and if it is in the form of non-interest bearing security deposit, if all these conditions are fulfilled, the deposits chapter will not apply to that transaction. And lastly, if quorum is not present within half an hour from the appointed time, then the general meeting will get adjourned. Okay. So now come on guys, this is actually a case-based MCQ, but this is that kind of a case-based MCQ where I don't have to read the story. I can straight away handle the MCQ with the questions itself. So straight away I'm coming to the questions. The first question over here, Robust Builders and Developers Limited created a charge on its Hisar land on the 1st May 2019. So 1st May 2019 is when the charge was created. It filed form CHG1 on 16th May 2019. So did they file the CHG1 form correctly, guys? See, CHG1 is something that you file when you are registering the charge. It has to be filed within 30 days. So 1st May 2019 plus 30 days will be what? It's going to be 31st May 2019. So by this date, we are supposed to file the CHG1 with ROC. We filed when? We filed on 16th May 2019, which is within the time limit. So yes, the company has done it correctly. So which of the following is correct? Charge was registered within the prescribed time limit of 30 days, hence no penalty arises. Yes guys, option A. Option B says 7 days. 7 days is wrong. 15 days is wrong. Registration of charge is optional. This is wrong. So my correct answer is option A. Then come to the next question. The company repaid the loan on 15th May 25 and Rosalia immediately filed form CHG4. Which of the following is correct regarding satisfaction of charge? Do you remember? This point we had seen in one of the questions long back. Even when the charge is satisfied, when the loan is repaid, that time also we have to inform ROC. Same within 30 days time we have to inform ROC. So company repaid the loan on 15th May 25. So 15th May 2025 plus 30 days. Within this much time the company is supposed to inform ROC about the repayment of loan, about the satisfaction of charge. So which option is correct? Company is required to intimate ROC of satisfaction of charge within 30 days from the date of satisfaction. Yes. Option A, 30 days is time limit. Option B says satisfaction need not be reported. Wrong. Option C says only the bank can file CHG4. No, not the bank. It is the company which is supposed to file. Then option D says satisfaction of charge can be reported at any time before winding up. Even this is wrong. We have a time limit. It has to be informed by the company within 30 days from the date of satisfaction of charge. Okay. This is the second question. Then comes the third question. According to the case scenario, Rosalia filed form CHG1 along with other required documents and the charge was duly registered by the ROC on 16th May 2019. After the term loan was repaid, ROC issued certificate relating to registration of satisfaction of charge in form CHG5 dated 26th June 25. So first the charge was created, then the loan was repaid. The loan was the charge was satisfied. The satisfaction of the charge was registered with the ROC. Keeping in view the relevant provisions, for how long is the instrument by which the charge was created required to be preserved? Just now I give you the reminder. Once a charge is satisfied, once a loan is repaid, we have to preserve the instrument for minimum 8 years. But 8 years from when? 8 years from the date of satisfaction of charge, or 8 years from the date of repayment of loan. So now come on, let's have a look at the options. Let's see which option is correct. They're asking us about the preservation of the instrument by which charge was created. First option says it is not required to be preserved. Wrong. It has to be preserved for 8 years. Option B says it must be preserved for 8 years. Sounds right. Option C says it must be preserved permanently. No, this is wrong. Not permanently. 8 years only. Option D says it must be preserved for 8 years. So B and D both say 8 years. So one of these two options, let's read fully now. It must be preserved for 8 years from the date of issue of certificate in form CHG5. What did I just tell you? I told you it has to be preserved for 8 years from when? From the date of satisfaction or from the date of repayment of loan, not from the date of certificate. So this option is wrong. It has to be preserved for 8 years from 15th May 25. That is a date on which the company made full and final repayment of loan. Yes, we preserve the instrument creating the charge for 8 years. 8 years from the date of satisfaction of charge or 8 years from the date of repayment of loan. It's not counted from the date of certificate. No, it is counted from the date of repayment of the loan. Okay, this was the third question. Then comes the fourth question. Robust Builders and Developers Limited implemented a policy requiring executive level employees to furnish non interest bearing security deposit not exceeding their annual salary under the contract of employment. Tell me, is it deposit or not? Three conditions I told you. Condition number one, it should not exceed annual salary. Yes, it is not exceeding their annual salary. Condition number two, it should be as per the terms of the employment. Yes, it is as per the contract of employment. Third condition, it should be in the form of non-interest bearing security deposit. Guys, all my conditions are fulfilled. Therefore, this money will not be considered as deposit. The whole deposits chapter will not apply to this transaction. It is not a deposit. See which option is correct. Such deposits are treated as deposits. Wrong. Such deposits are exempted from the definition of deposits since they are non-interest bearing, received from employees, and do not exceed their annual salary under the contract of employment. Yes, option B. Option C says employee security deposits are prohibited under all circumstances. No. Such deposits require prior approval of ROC. No. Option B. They are exempted from deposits. Why? They are exempted only because all the three conditions are fulfilled. Okay, so answer is option B. Then comes your next question. The quorum for the EGM of Robust Builders and Developers Limited was constituted by members excluding proxies. Given that the company is a public company, what is the minimum quorum required? What's the minimum quorum, guys? It depends upon type of company. If it is a private company, it is 2. If it is a public company, it will depend upon number of members in the company. See, look at this. I'll show you the relevant information over here. The question says, as on the date of EGM, company has 640 members, guys. 640 members means company has members within 1000. If it's a public company and the number of members is within 1000, then in that case quorum will be 5. 5 members personally present. So option B. You remember the slab, right? We saw it in an earlier question. If the number of members in a public company is up to 1000, then in that case quorum will be 5. If the number of members is, look at this, more than 1000 up to 5000, quorum will be 15, and more than 5000, quorum will be 30. In this question, we have up to 1000 members, within 1000 members, therefore 5 will be your quorum. Okay, then comes your next question, your last question. Assume on 27th June 25, date of EGM, fewer members than required for quorum were present at the scheduled time of 11 o'clock. 11 o'clock is a time for the meeting. At that time, the number of members present was less than quorum. We will still wait for 30 minutes, guys. Even till 11:30, even after waiting for 30 minutes, if the quorum is not present, then the meeting will get adjourned. So meeting stands cancelled permanently? No, it only gets adjourned. So now coming to option B, the meeting shall stand adjourned to the same day next week at the same time and place. And if quorum is still not present within half an hour from the time appointed for that meeting, the members actually present will constitute quorum. Yes, guys, it's option B. See, if quorum is not present within 30 minutes, the meeting will get adjourned to same day, same time, same place next week, or any other date, time, place which the board will decide. Now, in that adjourned meeting also, what if there is no quorum? Then in that case, how many of the members present, that itself will be considered as quorum, and we will proceed with the meeting. That's what is mentioned in option B. If quorum is still not present within half an hour from the time appointed for that adjourned meeting, members actually present, that itself will constitute as quorum, and we will proceed with the meeting. So option B. Okay, this was your question number 33. We had some very good reminders over here. This question was like a combination of your charges chapter, deposits chapter, and the meetings chapter. Okay, now come to question number 34. Another case-based MCQ. This is from your mock test paper, the first mock test paper. Again, I'll give you reminders first, some 5 reminders, and then I will start the question for you. This question is a combination of prospectus chapter and share capital chapter. Okay, reminder number 1. Should private placement offer be given to only existing shareholders? No, guys. Private placement offer can be given to anybody. See, it is rights issue, bonus issue. It is those shares which we offer only to existing shareholders. But private placement offer, it is not necessary that it has to be given only to existing shareholders. There is no such condition. Then second question, second reminder. Private placement offer can be made to maximum how many persons? Maximum 200 persons per annum per security. And when you're counting the 200 limit, it will not include qualified institutional buyers. It will also not include employees to whom we are issuing ESOPs, even they will not be included. And also remember, what if we violate this provision? Like, what if the company makes a private placement offer to more than 200 people? Then what will happen? Then we will treat it as if it is a public offer. So what if it becomes a public offer? Big thing, guys. If you treat it as if it is a public offer, then all the SEBI rules and regulations will start applying. So point number one, reminder number one, is there any rule that private placement has to be given only to existing shareholders? There is no such rule. Second reminder, private placement offer can be given maximum to how many persons? Maximum to 200 persons per annum per security. When you're counting this 200 persons, you will not include qualified institutional buyers. You will not include the employees. And if this is violated, like if the company is giving the private placement offer to more than 200 people, then we will start treating it as if it is a public offer. It will become a deemed public offer. Okay. Then comes my third reminder. The point is, see, no fresh private placement offer shall be made unless earlier offers are allotted and completed or abandoned and withdrawn. No tension, I will explain this to you. Listen to me. Let's say company has made a private placement offer. Now this private placement offer is still pending. While this is pending, company cannot make one more private placement offer. No. The first private placement offer, company either has to close it. How close it? The company will allot the shares and complete the private placement offer. Or if the company is unable to allot, then refund the money and withdraw the private placement offer. So the first private placement offer has to be closed. Only then the company can issue the second private placement offer. Understanding? That is what this point is. No fresh private placement offer shall be made unless earlier offers are either allotted and completed, or company, if you're not able to allot, then refund the money and withdraw the private placement offer. So two options, only either of these two has to be done, then only next private placement offer can be given. Okay. Then comes my fourth reminder. Whenever the company raises money through private placement, whatever money the company has received, that money has to be kept in a separate bank account. Company cannot immediately start using the money. No, money has to be kept in a separate bank account. Only after allotment, only upon allotment, only after the shares are allotted, after that only the company can start using this money. Okay. And this allotment has to be completed within 60 days from receiving the money. In case company is unable to finish allotment within 60 days, then within the next 15 days, company has to refund the money. Okay. So few points over here, important points. Whatever money the company has received on private placement has to be kept in separate bank account. Company can use the money only after allotment. Allotment has to be completed within 60 days after receiving the money. And in case company is unable to allot within 60 days, company should refund within the next 15 days. Okay. And then comes the last reminder. This is from your share capital chapter, alteration of share capital, guys. The alteration of share capital is nothing but your increasing, decreasing authorized share capital, then your subdivision of shares, consolidation of shares, conversion of shares into stock and vice versa, then cancellation of shares not taken up by the public, all that comes under alteration of share capital. Company can alter share capital only if it is authorized by AOA, and also the company requires an ordinary resolution. Only if both these conditions are fulfilled, company can proceed with alteration of share capital. Okay, let me give you a super quick revision of the revision once again, and then I'll take you to the question. Reminder number one, is there any rule that private placement has to be made only to existing shareholders? No, there is no such rule. Then comes second reminder, private placement offer can be made to maximum how many people? Maximum 200 people. But when you're counting this 200 people, you will not include qualified institutional buyers. You will also not include employees to whom ESOPs are issued. Then in case company makes private placement offer to more than 200 people, then it will be deemed to be a public offer. Then comes the third reminder, in case a private placement offer is already pending, company has to close this one, then only company can make a new private placement offer. So the existing private placement offers have to be allotted and completed, or they have to be abandoned and withdrawn. Keywords, guys, be careful. Then time limits, whatever money the company has received under private placement, company cannot use that money immediately. Company has to keep that entire money in a separate bank account. Company can utilize the money only after allotment. Allotment has to be completed within 60 days from receiving the money. If company is unable to allot within 60 days, then company has to refund the money within the next 15 days. And then lastly, in case the company decides to alter share capital, two preconditions. Precondition number 1, it has to be authorized by AOA, and precondition number 2, it requires ordinary resolution. Okay, so these were the reminders. Now even in this question, straight away come to the MCQs. The story is not required. So 1, 2, 3, 4 questions under this. Okay, let's read them one by one. The first question over here. So here in the first question, they have given us an assertion, which means they've given us a statement, and then they've given us a reason behind the statement. So we have to read both of this and we have to see whether it is correct or not. Let's carefully read it. So the statement says Green Volt Renewable Energy Limited, which means it's a public company. This company's private placement offer to 190 persons. 190 is fine, guys. It is within 200. So this company has made private placement to 190 persons during the year. It is not invalid merely because it did not restrict the offer to existing shareholders. Company has not restricted the offer to existing shareholders. Yes, it is fine. In a private placement, we don't have to restrict it to the existing shareholders. So because of this reason, it is not invalid because of this reason. You don't have to restrict the private placement offer to existing shareholders. This statement is perfectly correct, guys. Private placement can be made to any 200 people. Those 200 persons may be members of the company, they may be outsiders, doesn't matter. Then they've given us a reason behind the statement. Section 42 of the Companies Act does not prohibit a private placement from exceeding 200 persons in a financial year, provided the excess persons are QIB or ESOP allottees who are excluded from the count. Interpret the question carefully, okay? The question is saying that the company has made private placement offer to more than 200 persons, alright? But the excess persons, excess beyond 200, are nothing but QIBs and employees to whom we are giving ESOPs. This is perfectly fine, guys. We are allowed to do a private placement offer to maximum 200 persons only. And when we count the 200 persons limit, we don't count the QIBs and the employees to whom we are giving ESOPs. That's exactly what has happened over here. No doubt the company has made the offer to more than 200 persons, but the excess are none other than QIBs and employees. So if I ignore this excess, if I ignore the QIB and employees, then the company has made private placement offer to 200 persons only, which is perfectly within the limit. But you tell me one thing, is the statement and the reason, are they connected? Even the statement is correct. See, even the statement is correct, even the reason is correct. The statement is saying that the company did not restrict the private placement offer to existing shareholders. Yes, perfectly fine. The reason says that total number of persons to whom the company has made the offer is more than 200, but the excess is only QIBs and employees. Even this is fine. Both the statements are fine, but tell me, are they connected to each other? Like, can I say that the company can make private placement offer to persons other than existing shareholders, and the reason for that is this 200 persons limit? They're not even connected to each other, right? So yes, both the statements are correct, but they are not connected to each other. So if you look at the options, both A and R are true, and R is the correct explanation of A. Wrong, they're not connected to each other. Both A and R are true, but R is not the correct explanation of A. Yes, option B. Both are correct, but they're not connected to each other. So option B. Okay, then come to the second question. Before Green Volt makes further private placement offer in the same financial year, examine the following statements. 3 statements they have given to us. Before the company can make further private placement offer, what did we learn? Before that, the existing offers, the earlier offers, have to be either allotted or completed, or they have to be abandoned or withdrawn. Relating to this, okay. Statement 1. A fresh private placement offer cannot be made until allotment with respect to the earlier offer is completed or application money is refunded. Perfect, guys. This is perfectly correct. Company can make private placement offer only if the earlier offer is completed or money is refunded. This is the first statement. Then comes the second statement. Completion of earlier offer automatically authorizes the board to make further private placement offer during the same financial year without complying with any fresh approval requirements. Wrong. See, in private placement in section 42, you must have learned that before the company makes a private placement offer, special resolution is required, approvals are required. So here in statement 2, they are saying that just because earlier offer is completed, now board can go ahead with the second offer without requiring further approvals. No. Before every private placement offer, you require special resolution. Only when it comes to private placement of debentures, there alone you have a particular concept where you can take the approval once and that approval will be valid for the entire year. You have a concept with respect to debentures, but generally in private placement, other than debentures, other cases, other securities, we need special resolution before every offer. Then comes the third statement. Money received towards subscription under a private placement offer must be kept in a separate bank account and cannot be utilized until allotment is made. If not allotted, must be refunded within 15 days of the earlier of the closing date of the offer or 60 days from the receipt. Perfect, guys. Company can use the money only after making allotment. Allotment should be completed within 60 days. If company is unable to allot, company should refund the money within the next 15 days. Then comes statement 4. So this was a statement 3, now comes statement 4. Once earlier private placement offer is completed, Greenvolt may treat the residual unsubscribed portion of that offer as automatically carried forward and combined with a new offer without issuing a fresh private placement offer letter. No. Once the earlier private placement offer is completed, the unsubscribed portion will simply lapse. You cannot carry it forward and all. So which statements are correct? Statement 1 and statement 3 is correct. So option B. Then come to the third question here. Greenvolt's board resolves to increase authorized share capital from 4 crore to 8 crore. When you increase or decrease the authorized share capital, this will become alteration of share capital, which we spoke about over here. A director objects, stating that this cannot be done without approval of NCLT since it amounts to alteration of capital clause of the MOA. No guys, we only require it to be authorized by AOA and we require ordinary resolution. We don't require NCLT approval for alteration. NCLT approval is required only for reduction of capital, not for alteration of capital. Assuming the company's articles do not currently authorize such an increase, which of the following correctly evaluates the director's objection? You understood? The company's articles do not currently authorize the alteration. If the articles don't authorize, then you can't do the alteration. You'll have to amend the articles. You'll have to make sure the articles authorizes the alteration of capital, then only company can proceed with the alteration. So option A says director is correct. Wrong. Director is incorrect. NCLT approval is not required. Director is incorrect. A special resolution is not required. Ordinary resolution only is required for alteration of capital. Director is incorrect. Company must first amend articles. Correct. Then pass an ordinary resolution of the shareholders followed by the requisite ROC filing. Yes. Option C, guys. First amend the articles. Make sure the articles authorizes the alteration. Then pass ordinary resolution. Then go ahead. Option D says director is incorrect. Increase in authorized capital requires unanimous consent of creditors. No creditors' consent is not required. So option C. Okay, then come to the last subdivision. Greenvolt Renewable Energy Limited proposes to accept deposits from members. All of the following statements are incorrect except one. Identify the statement that is not incorrect. Basically, we have to identify the correct statement. So, this company wants to accept deposits from members. See guys, it's a public company. Can a public company accept deposits from members? Any company can accept deposits from members, whether it's a private company, whether it's a public company, any company can accept deposits from members. So option A says acceptance of deposits from members is barred outright for every company. Wrong. Deposits from members can be accepted. It is not barred. Wrong. Then deposits from members may lawfully be accepted, but only if the company complies with the conditions laid down under section 73 and company's acceptance of deposit rules 2014. Yes, correct. If the company wants to accept deposits, it has to follow section 73 and it also has to follow the rules. Then option C says no company can accept deposit from members unless it first secures NCLT's approval. You don't need NCLT's approval to accept deposits. Then option D says amount received from members as deposits are in substance indistinguishable from share capital and therefore attract no separate compliance obligations. Terrible. Deposit money is separate, share capital is separate, they are not one and the same. So your correct answer will be option B. Company, when it accepts deposit, it has to follow section 73 and it also has to follow the rules. So that's it, guys. This was your question number 34. It was from your mock test paper. It was a nice combination of prospectus chapter, private placement, share capital chapter, alteration of capital, and now a little bit of deposits. Okay. Now come on, let's move on to our last question, our final question, which is also a case-based MCQ from your mock test paper, from your second mock test paper. Let me give you the reminders first and then I'll come to the question. Reminder number 1. Whenever the company wants to change its name, it requires central government approval and special resolution. So to change the name of the company, we require central government approval and we require a special resolution. But however, if the change in the name of the company is because of conversion of company, like for example, earlier the company was a public company, so the name of the company was Level Up Limited. Now what happened is this company is getting converted into a private company, so now the new name of this company will be Level Up Private Limited. So if you're noticing, the name of the company is changing, guys. Earlier it was just Level Up Limited, now it is Level Up Private Limited. So the name of the company is changing, and this change is because of conversion of company into one form from one form into another. Generally, for name change, we require central government approval and special resolution. But however, if the name change is just because of conversion of company, in such cases, central government approval will not be required. Okay, so you got the point. Generally, when we change the company's name, we require central government approval. But however, if the change is only on account of conversion from one form to another, in those cases, we don't require central government approval. Reminder number 1. Reminder number 2. Once a charge is registered, any person acquiring the property shall be deemed to have notice of the charge. Do you remember section 80 where we spoke about constructive notice, deemed notice of the charge? Once the company creates a charge and once it is registered with the ROC, now we will assume that the whole world has gotten to know about the charge. So any person who is acquiring the property, the company does not have to inform that person that, hey, on this asset charge is existing. They don't have to inform. It is implied, it is deemed that every person now knows about the existence of the charge, deemed to have notice of the charge. Okay, and then third reminder, last reminder from your management and administration chapter, the very first section, section 88, which talks about the register of members and all. In section 88, we have learned that once the board approves the allotment or once the board approves the transfer, from that day, within how many days should the entry be made in the register? Like for example, let's say I purchased shares in the company. So therefore my name has to enter into the register of members. Within how many days should my name enter into the register of members? Within 7 days. Okay. So 3 reminders. Reminder number 1, if the name change is just because of conversion, then central government approval is not required. Reminder 2, Section 80, deemed notice of charge. This concept says that once a charge is registered, we assume that everybody has gotten to know about the charge. Everybody is deemed to have notice of the charge. Now later third parties cannot complain that company, oh, you did not inform me about the charge. They can't complain like that. And the third reminder, the last reminder, entries have to be made in the register of members within 7 days. Okay. Now come on, let's come to the question. I just want to read the first part for you and then I'll take you straight away to the questions, okay? The question says, Manappuram Limited is leading construction company of India. It's a public company, guys. We just have the word limited in its name. It's a public company. In 2022, the company decided to convert itself into a private company due to strategic reasons and changes in shareholding. Public company is getting converted into private company. After passing special resolution and altering its AOA, company formally became a private company and its name changed from Manappuram Limited to Manappuram Private Limited. Company secretary advised the board to file Form INC 24 with central government. The company's name has changed because of conversion of public company into private company. In this case, do we require central government approval? We don't require central government approval. So the company secretary is saying that, this form INC 24 has to be filed with the central government with respect to this name change. This is incorrect. We don't need any CG approval and all in such cases. Now straight away come to the question. In filing form INC 24 with central government, is it mandatory for this name change? No, it is not mandatory. No doubt, generally in name change, we do require central government approval, but this is just a case of conversion of a public company into private company. In such cases, we don't require CG approval, so nothing has to be filed with central government. So is it required to file it with the central government? The answer is no. So it can't be yes, not option A, not option C, either B or D. Option B says no, because the change of name results solely from company's conversion from public to private under section 14. A fresh certificate of incorporation reflecting the new name is issued by the ROC on approval of conversion without a separate name change application. Yes. Option B. Option D says no, provided the company files fresh MOA within 30 days. All that requirement is not there. Option B, it's simply a name change because of conversion from one form into another. We don't have to get the CG approval over here. Option B. Then comes the second question. The question says, the company sells the Delhi plot to Kalyani Limited, but the property carries ABC Bank's existing registered charge. Understanding? So there's this company, Manapuram Limited, and there is this another company, Kalyani Limited. Kalyani Limited is the buyer. This company, Manapuram Limited, is selling to Kalyani Limited a property. Now, on this property, a charge is already existing. Alright, and the question says it is a registered charge. So, because it is a registered charge, there is no responsibility on Manapuram Limited to inform the buyer about the existence of the charge. The company does not have to inform the buyer. Why? Because once a charge is registered, Section 80 kicks in, and because of Section 80, we assume that every person is aware of the existence of charge, deemed notice of the charge. So therefore, this company does not have any responsibility to inform the buyer about the existence of charge, not required. Now this charge, this asset with the charge will become the property of Kalyani Limited. So the question says the charge lapses automatically. No, the charge will not lapse. The property along with the charge will go to the buyer now. Then the option B says Kalyani Limited takes the property subject to the existing charge. Yes. Registration under section 77 operates as constructive notice to every person dealing with the property and must have the charge satisfied or released or obtain the bank's consent before or after completion. Yes, perfect. Once the charge is registered, section 80 comes in, and because of section 80, we assume as if every third party already has deemed notice of the charge. We assume as if every third party has constructive notice of the charge. So the company does not have responsibility of informing the buyer that, like this on this asset charge is existing. No need to inform. It is implied that the third party is already aware of it. So option B. Now come to the third question. What amount must Manapuram Limited deposit in deposit repayment reserve given that 6 crores out of 12 crore deposit mature during that year? We've already seen this in an earlier question as well. We will see what is the amount of deposits maturing, that into 20%. This is what has to be transferred into deposit repayment reserve. This is going to be 1.2 crore, option C. Then comes the last question. By what date was Manapuram Limited required to update register of members for private placement allotment approved on 1st March 26 and buyback approved on 15th April 26? Within 7 days, guys. So 1st March plus 7 days is going to be 8th March 26. Similarly, 15th April 26 plus 7 days is going to be 22nd April 26. So by these dates, the register of members is supposed to be updated. Register of members, remember the time limit is simple. Within 7 days, the register of members has to be updated. Okay. So which option? 8th March and 22nd April. Option A, guys. 8th March for allotment and 22nd April for the buyback. That's it, guys. With this, we are done with all the new and unique questions across 4 resources: your May 26 question paper, your September 26 RTP, and both your September 26 mock test papers. Yes, I know this video turned out to be a little lengthy, but I did not want to do it in a manner in which I just keep telling you the answer and I keep moving on. I did not want to do it like that, because then there's no value add. I wanted to do this whole method where, I give you the reminder of the concepts first, and I'm very sure this method, this style would have helped you immensely intensely, at least the concepts which we've spoken about, we spoke about those concepts fully. So that way, when you're revising next, before your exam, or now during your last few days, when you revise now, I hope at least these concepts which we've covered now becomes a little better for you. Yes, guys, that's it. With this, I think I'm good to close this video. I hope you've reached here till the very end, and I hope you're content. In fact, I hope you're as content as I am after making this video. Thank you, guys. Bye bye.